Everybody, welcome to Chat with Traders, episode 169. I'm pleased to be able to share this episode with you. I feel as though it's a really solid interview or conversation with
stunning.
Jack Ma.
How are you planning
Jack
to
is someone who I would
tough
consider to be a
enemies
very
here?
talented futures trader, and he lives here in Sydney. Jack has traded prop for about 5 years now, and this year he's taken on a great commitment to form something bigger than himself, Minter Capital. It's a firm of his own which actually leverages the resources and the infrastructure of another firm, being Genesis Trading. And right now, Jack is currently mentoring and financially backing 4 developing traders who he sees potential in. So this is a topic you'll definitely hear more about later in the episode. Jack's way of trading is what he describes as an infantry style. He trades the Australian 90-day bank bills by continually working structures around his expectations of where the yield strip is going to be without being too exposed to outright risk. He also trades Australian 3-year and 10-year government bonds, but mostly during the contract expiry, or the period known as rolls. As always, we discuss many things: prop trading, strategy, developing skill, psychology and mindset, competition, and plenty more. But the exciting part about all of this is if you would prefer to watch the conversation rather than just listening to the audio only like you currently are, you can find the video on the Chat with Traders YouTube channel. And as this is the last episode of 2018, I would like to say to you, have a nice Christmas. Make sure to enjoy some time away from the screens. And of course, thank you for continuing to support Chat with Traders throughout the year. Now, enjoy the episode with Jack. He's a good dude who I respect, and I'm sure he'll be doing this for many years to come. I'm actually very interested to follow along with his progression and see where he takes things from here. Anyway, folks, on with the episode. Here we go. Please welcome Jack Ma. Yeah, it's coming through.
Cool.
All right, man. Well, let's just make do.
Great. Mate, why not? We're on table tennis table.
Yeah.
This is how we roll.
Yeah, I don't think it's too obvious in the camera.
Nah, it's good. It's fine.
Anyway, man, let's just start the way we normally do and talk a bit about how you actually got into trading. So where did you start out?
It came down to, I was in banking for about 6 years prior to that, in sort of the commercial banking. So I worked at ANZ, Westpac, and I've always had sort of a interest in the markets, right? I've moved from commercial banking through various different divisions until I got to where I thought I wanted to be, which was the so-called equity division in Westpac. It was more of a product-based role. There weren't any real trading or market-based. So I pretty much walked out of that job because I was unsatisfied. I sat down to myself and went, what do I actually want? I started listing the things I want, and went from being remunerated properly or according to your contribution, freedom of time, freedom of location, and no red tape. And kind of actually came down to either becoming a celebrity or trading. So I guess I went with that, and then I just started looking. And back then the old Genesis Allium, that they had they were on Seek, they had a job application, and I went for it.
Okay. And had you done any trading on the side, like while you're doing this?
Yeah, I have. I was doing CFDs, just probably pop a couple grand into the account. Did sort of everything, from FX to gold to index. Blew up 2 accounts. I pretty much was like, I don't know how to trade. But, I was happy to actually get the opportunity at Allium because, I think working at a professional firm, getting trained up alongside other people trying to make this living, and they're all committed to it. And this is not some sort of spend a bit of time at home, in the afternoon or at night, after your daytime job. It gets you quite motivated. And, that actually helped me a lot.
Yeah, okay. And so those 2 accounts that you blew up while you were just trading on the side, was that any real money? Obviously it was real money, but was it just a couple grand?
Yeah, one was 3, one was 5.
Okay.
So it wasn't crazy, but I guess I did take it seriously, even for the amount of money that I was trading, in the sense that, because for me it was, if I blew this up, it's really bad on my own sort of mentality as well.
Of course. Well, that's what I wanted to ask you actually, is why you made the decision to go into prop trading. Like, obviously you could have continued as a retail trader, but you made a decision to actually look for a prop firm which was hiring at the time or taking on new traders. What advantages did you see of actually going down the prop trading route?
It actually is different to what I expected to be. I initially thought, I went back and looked at how I blew up my accounts. I thought, well, it's pretty clear I don't know what I'm doing. And I was here to learn knowledge and, go, wow, there are people who's made it in a career. They should be able to teach me. It turned out actually to be something different, but also in a good way to help me. Coming to a prop firm, what it does is it sets you up in the right mentality to be successful. You're now treating this as a full-time job. You're committing your entire day into it. There are like-minded people next to you. It's less about the knowledge, which is important, but more about sort of how you approach it, which I think is probably more important to becoming a successful trader than some crazy, strategy or system that you find somewhere.
So when you started, did you go through a training program of any sorts?
Yeah, I did. I would say it's very rudimentary in a sense that it's more about learning what we trade, right? So at Allium, we traded interest rate futures. Very few, I think, retail traders get to trade that or even look at that market. So you got to learn what the bills market look like, what the bonds market look like, how it even works. Very sort of basic knowledge based, and a sort of a strategy that I would say is very basic. Most of the learning, and this is the important part, which I learned about coming to a prop firm, is from yourself. You developing yourself, and that's without someone telling you that's the way to go. It feels wrong. Like other things, you feel like you should consult, all the experts and get all the knowledge that you want. But it's more so actually training based. It's a trading skill based. That's I guess the main thing I learned going to a prop firm.
And so when you started, did you start with like a group of other new traders as well?
Yeah. So the program at Allium was they have an intake, go through a training program, which is also an assessment, right? So at the end, people start falling off during the course or get fired. They take on, say, 4 to 5 at the end of that course.
Okay. Now, obviously, just, I guess, going back a couple steps, when you applied for this job, or it's not really a job, is it?
No.
There's no salary.
No.
Which is something else I want to ask you about.
Sure.
Obviously, there's a lot of people who are going to apply for that sort of role. How come you got given the opportunity, or how come they picked you out of everyone who kind of applied? Like, did you have any skills or anything which you think appealed to those who were in charge of the hiring?
And this is probably a slight controversy. My honest opinion about prop shops, right? Now, there's two types. There's types such as Optiva, Tibra, those guys, right, where they pay a very high starting salary to grads, so they have a very, I guess, tough recruitment process. My opinion is it's actually not very hard to get into a prop shop, provided you're the right kind of person. Now, that means sort of, you're competitive, you are, driven, you're not scared of taking risks, right? Now, that sounds like everyone should have it, but, people say they're competitive, but, it's the actions that really count. And people can tell after the interview, especially during that 6-week program, because you're going to fall over. You don't know what you're doing in this market. You're going to get crushed. And how you react to that is that shows the true character. So in that respect, I don't think it's very hard. And I think I had the right personality for this sort of a role. I wasn't scared of having no salary. I was, I'm happy to take risks. And I'm very competitive, I guess.
So how did you set yourself up to go into prop, like with regards to not having a salary? Obviously, you'd been in banking for about 6 years or so, where you were getting a salary each week or each month, and now you're going into prop trading where you literally eat what you kill.
Yeah.
Did you have generous savings to fall back on, or
that was pretty much
job?
it. As I did my research into this industry, and I realized, I wasn't naive. I was like, I'm not going to make money that first year. You're learning how to do. If I do, great, right? But you can't really plan for that. I saved up, a lot during my 6 years of working, I was actually going to buy a house. I'm not sure which one's doing better, the property or my trading career, if I bought it 7 years ago. But no, so, you know, I had a lot of savings to put me through, and I was willing to, you know, go, I can probably live 4 years without any pay.
Yeah, okay.
So, and that allowed me to, you know, to actually move forward in this industry.
Yeah. Now, you said that you were at Alliom.
Yep.
That was Mark Gardner's firm, right?
Yes. Yeah.
Okay. So Mark Gardner is someone who has previously been on the podcast. Listeners all know that, episode 132. What were some of the things you picked up from him? Was he, I presume he was probably one of the guys who was quite influential to you early on, and is particularly as a mentor as well. Was that the case?
Yeah, that was the case. I was just going to say, so, I mean, he's obviously been involved in a firm, and there was two parts of my trading career that was, you know, sort of related, or working very closely with him. One was when we had a group of traders together that sort of, he formed this group for us. And that really helped a lot. That's driven most of my sort of philosophy about how trading should be. It's a lonely job, right? If you know, there's no salary, right? There's not really much of a teamwork. Everyone's trading their own books. So having somewhat of a team environment, even just for the sake of, you know, having someone to bounce ideas off and having that casual banter when, you know, you're bored or the market's dead or you're just not having a good day trading, it's really important, you know. So that original group, that was really important for me. And then later on, Mark became my mentor officially in a one-on-one basis. And I think, you know, a lot of the things, the most important thing I think I learned from is just an attitude you're going to sort of bring to trading. You know, it's very easy to blame things. You can blame the market, you can blame, you know, the slow system, you know, internet speed, whatever. People find something to blame. And we have one motto in the group that Mark brought up. It was called "Be Better." And that literally answers pretty much every question you have. You know, why did you lose money? Well, instead of trying to find something to blame, be better means, okay, look at it. How could you have improved it? And if you keep having that mentality going into every trade that you screw up, that, you know, you're going to be a much better trader.
No doubt, yeah. Obviously, you've got to take responsibility. And that's like Mike Bellafiore always says, you can be better tomorrow than you are today.
Yeah.
So how did you go during that first year? You said before that you were willing to, you know, you had enough savings that if a couple of years went by and you didn't make any money, you would be okay. But how did you actually end up going during that, let's say, first year?
Yeah, that's a very interesting story because there's two ways you can look at it. One way is in the first 6 months, I'd say I did really well. I pretty much didn't have, I was one of those guys who started making money straight away. I figured out one specific strategy very early on and I just abused it. I mean, in a good way, right? And I kept going. So I clipped up very fast during the first 6 months relative to, you know, sort of what the typical rate people, you know, increase their trading size with. And, you know, at that time, I thought I was doing really well. What I later learned is for people, especially in their first year, they need to focus more on becoming a better trader than making money. Because later on, the market changed and what I used to do stopped working, and I had to learn the hard way, sort of how to make money again. And that's something that it's easy to forget about because, you know, people come into trading and all they think about is how to make money, you know, how to generate that income. And it's not about that. This is a marathon. You know, you're here. If you don't have 3 to 5 years planned, I would say to people, you know, don't worry about it. Yeah.
So how come what you were trading stopped working? Like in your words, you said it stopped working. How come?
I can be very specific. So when I first started, there was a lot of random orders in the bills market in Australia, right? And by random, I mean people paying offers or selling into bids that are really stupid. You know, these are probably not other prop traders. These are most likely, you know, either investment banks or funds who has some sort of a daily VWAP target, right? They don't really care about individual fills. They have a system that just does, you know, maybe it's a TWAP system, right? Just every 10 seconds or every minute, drop some into whatever price. Now, we trade intraday, right? And for that, I'll say intraday arbitrage or scalp, right? So we're only trying to make a tick or two per trade in the bond bills market. So whereas they have a bigger view of the whole day, we'd get filled on a bit, and if we can sell the one tick higher, that's our entire goal. So I just, came in and queued every single price, up and down. Obviously, I was very diligent in managing so I don't get run over on them, but I was literally waiting for the system to, fill me for free and then just quickly get out of it.
So were you on both the bid and the offer?
That's right. So I'd queue probably four down, four up from the market. So if wherever we move, I've got an order there that could get filled by a lucky system.
Okay, so if you get filled on the bid, then you're just hoping it's going to come back. And
well, usually when I get filled on a bid, it usually be like a crazy bid. There might be 10,000 lots there. The offer will be choice. No bids or offers there. So I'll be the only person trying to sell. And usually there's enough randomness in the market for me to rotate that, which is take for a point.
Okay, and it's probably also worth pointing out, like if you're doing this in bank bills, the range on any given day is quite small.
Oh, very small, yeah, bank bills. So it sounds crazy to just go for one single ticks, but bank bills, even in the old days, you're looking at 4 to 5 to 6 tick ranges on a non sort of tier 1 data, or if there's just nothing crazy happening in the world, right? Nowadays, it's even smaller. You're talking about 2 to 3, sometimes 1.
Yeah, that's crazy. That's going to sound really insane to some people listening to this.
Yeah.
Who are like very unfamiliar with that market.
Yeah.
So what happened? Like, how come? Like you said, you were trading that way for about 6 months or so, and then you had to change things up because you stopped making money doing that.
A couple of things came into play. One, there were less free orders. I think the executors, in the investment banks or the funds, they started getting a little bit smarter about how they execute. And the other thing is our market became sort of more people joining. There was more algos who would be much faster than you at getting Q at a price. So a couple of things made that. And also, as you trade bigger, the random clip sizes that fill you, they're pretty small. It's quite hard to get a big clip away. Hope on lucky fills. So all these factors together made me not that profitable anymore. Also, it's very hard to go become a better trader. If you talk of all those, say, some of the biggest traders you've interviewed, that is definitely not what all they do, right?
Right, yeah. And you said also that you got clipped up quite quickly.
Yep.
Which, for anyone listening who might not understand that terminology, it just means that your risk limits were increased.
Yep.
And you were allowed to take larger size positions, essentially.
Yep.
Did that become an issue for you because you were allowed to trade bigger and bigger and bigger, and then after 6 months or thereabouts, you began to find that your strategy or the way that you had been making money was becoming less effective? Did that cause you any grief, like because you were now trading bigger and it wasn't really working?
Oh, absolutely. And that's where I think the initial part of my career almost ended. I hit a plateau. I just couldn't bypass a certain sort of level of income. And I sort of knew what it was, and I started to train deliberately for it. And, it is very important. So I realized I didn't know how to really trade aggressively into the market. Right? I was just sitting passively on queues, waiting for lucky fills. So I took 2 months off to practice that. When I say took 2 months off, as in I'm still trading, but I recognize it's not about profits. So I forced myself to not do what wasn't working. It wasn't not working, right? It was just less effective. Mm-hmm. But I decided to just cut that out. I was like, look, it's not about the money for these couple of months. I'm going to just work hard on sort of aggressive style trading, go into market, trading the momentum, trading the flow rather than sitting passively. Obviously, that's not great for my P&L for that 2 months, but I thought that was a very important lesson for me to be able to practice this deliberately.
Okay, and were you on sim during those 2 months, or were you still real money?
Yeah, I would say once you've gone live, there's very little point going back to sim because all of the problems that come from trading is probably to do with mentality, to do with money.
Right.
The losses, the wins. Yeah.
And you were at Allium for how long before you went to Macquarie? That was your next move, right?
Yeah. So I did that for 2.5 years. And, I would say I was still stuck at my plateau, despite having made a few breakthroughs in my sort of trading style, but I was still really plateauing. And I wasn't sure why I wasn't happy, which is funny because I figured that out after I went to Macquarie.
Okay, so what were you doing at Macquarie? Like, why did you want to leave? Like, why did you want to make that move?
I mean, I think the answer is a lot less noble than any of the other things. It just sounds awesome. Like, I just wanted to be an investment banking trader. It sounds good on paper, and it's something I've always wanted to do as well. I've never been, inside the trading floor of an investment bank. I want to see what it's like. I know they deal with huge institutional clients, huge orders. I want to see what that's like.
What sort of trading were you doing there? Like, were you working orders for clients?
Yep.
So it wasn't actually proprietary trading there?
No. I don't think many investment banks has proprietary departments, if any, at all. So I was an equity portfolio trader, but by trader, obviously not proprietary. It was broking. So I looked after large clients, which, funds and global funds and stuff like that mostly. And they'd have something, say, to do, and then ask me to execute for them. And they will give me what sort of result they want to achieve, because there's a lot of different ways you can get filled, a lot of different ways these funds want to be filled. And they'll give you the strategy and you work it for them. They might ask for your opinion. They might ask, on your thoughts and what you hear in the market, stuff like that.
Okay. And was this in equities or was it in futures?
It was pure equities. So this was in physical equities, the Australian ASX.
Okay. So that must have also involved a bit of a learning curve, because you were at Allium, you were just doing futures, right?
Yeah, I would say the biggest learning curve was learning you're not prop anymore. And just stop trying to put forward your opinion. Because, as a prop, if you don't have an opinion, there's no point, right?
So how were you judged? Obviously, when you're a prop trader, you kind of ultimately you're judged on your P&L.
That's right, yeah.
How were you judged at, I don't know if judged might be a bit of a harsh word, but...
How's your work monitored?
Yeah.
To be honest, pretty much there's two parts to it, because there's also a sales aspect. As you can imagine, being a broker, right? You've got to generate new clients, or at least expand existing clients, and you're judged on commission. Right, you judge on how much commission you bring in. If everyone executes through you and they're all massive orders, you look amazing. Now, obviously, if you're not really good at executing, after a while, people are going to stop giving you orders. If you keep giving bad calls and you keep trashing their orders, that's going to affect it. But ultimately, obviously, it came down to pure the commission dollars. And that was different for me. That's the biggest part I struggle with. I sort of pride myself in having my own view, and like you said, based on P&L, which is something very few people really cared about over there.
Yeah, you're a bit more in control of things, I guess, too.
Yeah.
Are you ready to get serious about trading? Then join tastytrade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. tastytrade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. tastytrade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, tastytrade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. tastytrade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, You don't need millions or even thousands to start trading the US stock market. Bypass the PDT and tap into over 12,000 US listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
So you made the return back to prop?
Yeah.
When was that?
That was in December 16. Yeah, December 16. You know, like, so I realized having done that, and this is actually a really big turning point in my trading career, because having done that, I had this dream job in my head, and I've gone and done it. I was like, yeah, it's all right. I actually didn't enjoy it as much as I thought I would. And so having done that, it's kind of crossed up my mind. And then I sat back and go, well, what do I actually know how to do? Like, what am I good at? I'm like, I think trading, that's it. There's nothing really else, I really want to be doing. So when I came back with a very different mentality. And I think this is one of the sort of things I do want to tell people about, is like, trading's not a let's test the waters kind of thing. In the beginning, sure, like, especially if you've got financial constraints, but you need to commit completely to it. And when I came back from Macquarie and I realized this has to work now, this is all I'm going to be doing. There's no backup. If I leave here, I'm probably qualified to get an analyst job somewhere, but I'm going to hate it. I'm going to absolutely hate it, right? And it's not going to be great. So I really don't want that to happen. So in that respect, this became a must-work kind of thing, and I'm devoted to it. I'm committed to it. And that changes things, because when you're just testing waters, you're unsure of whether it's going to work or not. So as soon as you hit something like a big obstacle, a big drawdown, a big loss streak, you start looking for things you were good at. You start thinking about your backups. If you don't have a backup, then you're thinking about how I'm going to get through this. And that changes a lot.
Yeah, okay. So how did you treat things differently when you came back? Like, were there any noticeable changes? Like you said, it's like you just said, like, you could go get an analyst job if worse comes to worse, but you said you would hate it and it's not something you want to do. You really wanted to be trading. How did you change things, or how did you do things differently this time around to make sure that you wouldn't have to resort to an analyst job?
Yeah, I think the first thing was I stopped trying to maybe prove, like, when you start a trading gig, right, and you're unsure of what you want to be doing, I think you try to play safe. You try to play not to lose a little bit. And not for everybody necessarily, but especially when you come into a firm like this, you don't want to be the first guy to get fired because you've lost everything. But when I came back, I realized, this is a job that this is not an 8-hour job. This is, 12, 16, 20, depending on, which month of the year. It's crazy, right? So I was much more committed. I wanted to go much, further ahead than I used to. And all right, this must work. So I started looking for many ways to improve my trading rather than just look good, have a look good track record. For me, whatever was happening now, this is a process. I want to be there. And that was important, having that goal in mind. So the results of my trading in the short term actually didn't matter as much. And all I'm looking for is ways to improve myself. I was much more open. I started talking to a lot more people about how they trade, started, testing, being more active about my own trading and how to improve it.
Can you just go into that a little further? I think that's quite an interesting point. And the way you phrased it as well, at the beginning, you were sort of playing not to lose. So I guess what that means is you were quite conservative in the beginning?
Yeah, because people take different things into trading, right? Whether it be pride, whether it be, I don't know, whatever you judge yourself. Maybe, you're like, I'm a smart guy. I don't want to look stupid. or whatnot, because most people don't really sort of go through things where the outcome is not necessarily directly correlated with the effort you put in, right? So there's a lot of pitfalls. So in the beginning, you come into, it feels like a very competitive environment. There's 6 other guys that came in with me in the same group, and I'm there going, okay, I don't want to be last. I don't want to be the first to get fired.
Right.
I want to make the most money out of these people. So it's all about the results. All I'm looking for is the result. But when I sat down and go, well, it's going to be a lifetime career now, the short term doesn't really matter. It's all about the long term development. It's all about where I'm going to be in 3 to 5 years.
Okay, so you're willing to give up a little bit of P&L in order to try new things, kind of expand your...
In a way, mentally, I was thinking like that. But what I found, actually, it's quite the opposite. Your P&L doesn't actually suffer because of that. The less you actually care about your P&L, I think the better your trading will be over a decent sample size. Because that's where the mentality problems are. All the things you hear about, the greed, the stubbornness. Like, why are people stubborn, right, on a trade? They're not stubborn because they have this crazy view about where let's pick a currency, where the Aussie is going to be. It's more like, I don't want to lose. And right now it's a paper loss. And they haven't lost money yet.
It's not realized.
That's right. That's where a lot of these things come from, right? It's all when you think about money. I don't want to lose money. It'll come back. I mean, and then it obviously dies on you. But the reason you had that decision was because you didn't want to lose money, or you take profit way too early because you just want to lock it in, put that money in your pocket. But if you're thinking about how to improve your trading, what's the best thing to do? That changes sort of a lot of ways you can look at trading significantly, and that, I reckon, that single-handedly can take out a lot of the sort of typical mistakes, and that includes the mistakes I've made early in my career.
If we had to just pick on some of those, I mean, I know you've already spoken about some of them, but what would you say are some of your most memorable mistakes, maybe?
Yeah, I'll have to bring it. The first one, I got to bring it back to before I joined Allium, how I blew up my account, because that was really memorable. That probably, I'm actually quite glad that happened to me before I joined. So what happened was that was when the Aussie dollar was at above parity. And I was like, this is crazy. Why are we at parity? So I just had some crazy view, right? And so I had a $5,000 account, right? And I was only risking about $200 a trade. And I sold some at 101, 102, got to 103, sold some more, got to 105, sold some more, stopped out at 110. And I'm pretty sure that is literally the highest Aussie dollar is since then. And that's 6 years ago. Blew my account in one trade, even though I've been actually somewhat consistent in the 3 month leading to that. So that's probably my most memorable thing. I go, yeah, something about this is not right, and I need to learn about mentally why this happened. Yeah, so that's definitely a memorable mistake.
And if you were starting out again like today,
yeah,
and you had sort of most of the knowledge of what you had now, what sort of things would you do to help you gain consistency?
I think the most important knowledge I have now over then is my mentality and psychology, and I'll go into them a bit separately, right? So mentality-wise, I think going into trading, when I started, I always was looking for a strategy, a system, how to make money. Biggest breakthrough I had was trading's a skill. And it's sometimes hard to really identify it. So, nowadays I give people a sports analogy. That if you were, because sports is obviously completely skill-based, right? So if you were going to become a, professional basketball player, right? What would you be doing, right? You'd straight away think about, okay, you'd get a coach, or at the very least you start getting research on how to become a better player. And you'd start practicing, right, in, some very, very basic stuff, whether it's dribbling or just straight away, free throws, whatever it is, right? You're not thinking about trying to win. You're not thinking about the NBA. Now, the crazy part about trading is, it doesn't matter how new you are, the only place you can play is the NBA, right? And people need to realize that. It's like this market, there's no, here's where the not so good people play. There's one market. And most of the people in this market are some of the smartest, most brilliant people in the world who's done this for decades on, right? So day one, you're competing here. So thinking about how to win is crazy talk, right? And or focusing on it. Yeah, you want to win, but if that's all you're trying to do, you're missing how you should be training. You're missing, skills. And there is so much skills, market reading, flow reading, pattern recognition, execution speed, accuracy, and obviously psychology, which I'll go into a bit later. These are all skills you need to develop. And no matter how good your strategy is, it's pretty useless without skills. And so that is how I would go back and tell myself to approach trading. Don't come in here thinking you're here to, sort of just straight away win or make money. You're here to develop a set of skills. And if you treat it like that, then you'll probably practice in a correct way. You look at your in the beginning, you look at your winners and your failed trades in a critical way. What could I have done better there? The outcome's completely irrelevant. My next point was then the psychology bit. All right. So, and I think this will be really useful for sort of people starting out who struggles with winning and losing, like the emotions that come with it, right? I look at trading as a probability-based activity. There's never an absolute, right? Because no matter how much you think the market's going to do something, it potentially takes one guy to prove you wrong, like one guy with a lot of volume. And boom, your entire theory, everything you've built up up to this point is now disproved. So it's a probability-based activity. And to truly treat it like that is, I use my sort of blackjack dealer analogy. And this is why I teach my new traders as well. So imagine if you're the blackjack dealer in a casino, right? And you're dealing out hands. Now you have absolute edge, right? You got 51%. That's already known, or depending on the rules. You've got the edge, so you deal the hands. Now, the outcome of these hands are completely irrelevant, right? People, that is not the point, the outcome of the edge, because over 1,000 trades, your edge will shine through. So compared to, say, someone trading, it's actually the same thing, right? So he's dealt his 5 hands and he busts. He doesn't go cry in the corner. Doesn't go blame the table, doesn't go blame the game. He doesn't blame anyone, right? He just keeps dealing because he knows his edge is absolute. And that takes a lot of the sting out of your losers, right? But if you can think like that, because obviously you need to find your edge and how, why they're, edge being, the probability of your trade coming out better than 50-50, right? Why you have an edge, and you got to define it. But once you do, the outcome is completely irrelevant. You're here for the 100,000 trades. One trade changes nothing. And the crazy part is that allows you to stop thinking about money because, the guy who's hired by the casino, right? The casino doesn't go to the dealer and go, make me money. Because he knows it's not about that. Just go and do the good trades, right? What works, do those trades and just keep doing them, irrelevant outcome.
And I think, if anyone who's listening wanted to look that up a bit further, they could probably research the subject of law of large numbers, because I think that's kind of exactly what you're talking about there.
Yeah.
Getting into the long run. What else did I want to chat to you about? That's right. I wanted to pick up on something you said just before.
Yep.
I think it's really interesting how you said that trading is a skill and it's not so much just about having a strategy.
Yeah.
I think that was a really good point. So I just wanted to point that out. Where would you say your edge is today? Like, how are you trading nowadays?
There's probably 2 parts to it. First part, for those who are interested in the bills and bonds intraday market, I can be a little bit specific. So the bills market, we trade the futures contract. We trade the first 8 calendars, right?
Hold on, let me just interrupt you right there.
Sure.
When you say the bills market, what actually are bills?
So 90-day interbank or bank bills, that's the full term. So they're a futures contract on, the 90-day bills that banks lend to each other.
Okay.
Pretty much.
Yeah.
And so we trade the future contracts of those, and the expiry is every 3 months. So we trade I don't know what other people trade. I trade the first 8 calendars, right? So what are we now? We're in November. So December is the first expiry, and they'll go out for, in 3-month increments up to 2 years out. So having the benefit of sort of 8 contracts in the same product but different expiry means we have very natural hedges, and our hedges are often very absolute. Well, not absolute, but it's very correlated. It's pretty much the same product, unless unless the expectation of interest rates is different and specific to 1 month in particular, that isn't going to break down anytime soon. So one of the edges we have is the ability to, not lose money when you're wrong, because we trade in spreads, right? So if you buy something and the market goes against you, you can sell a different contract, assuming you can't sell back at the same price, right? So you can't scratch anymore or get out for free. You can sell a different contract, and that spread is something potentially that allows you to get out of this shitty situation down the track without losing any money. So that in itself is a big edge. It's a bit more complicated than that, but I'm just trying to give a very basic idea of that's one edge that's specific to this market.
Okay, so can you just give an example of that? We don't need to go into nitty-gritty detail, but like, let's say you're long the front contract and it starts to go down. What are you going to do in a situation like that? The front, and this is very specific, but I can't just say, because I'm sure there will be other bills traders listening to this. So the front's a bad example because that's really pinned. Okay.
Because interest rate's not going to hike or cut. So let's say the 5th or 6th contract. If I buy something, I would have already know what was my so-called exit, right? The exit being something to sell if I'm wrong. And when I'm wrong, I mean properly wrong. You cannot sell the original price back. And if you don't hit that exit, you're going to have to puke or lose money on the trade. Now, after hitting this other contract, I'm now in what we call an offside spread, right? Now, because the spread actually has a market in the bills, right? And it's a tradable contract in our market. So there's 2 ways you can get out. Maybe the spread itself will trade out and allow you to get out for free. Maybe you'll have to, get back into it again later through the outrights. The benefit of having this is you've got time on your side. So once you're hedged, right, even if it's a really, really crap position, like from a spread point of view, you've got time on your side. So if you're long, the market is crashing down, you don't have time. This could be seconds and you've already lost money. But now that you're somewhat hedged, you've got time to evaluate it and wait for an opportunity, potentially, to get back out of your original crappy spread.
Okay. So are you starting off... Now, no, this isn't going to be completely accurate because in your situation and the way you trade, very rarely are you flat. And we'll get into that. But when you put on a position, just in that example we gave before, it almost sounded as though you had an outright position.
That's correct. So, we can talk about sort of how I trade, right? So I trade what I would call inventory style. So by inventory, I put on sort of structures around my expectations of where the bill yield strip is going to be. But I don't expose myself to the outright movements, right? In case something crazy happens, North Korea launches a nuke, China's trade wars, whatever, right? That sort of outright risk is something I don't want to take. So I'm going to put on these structures. However, to put them on, I have to leg them or, buy something, sell something. And during that period, obviously I will be outright, quite often for only seconds.
Okay.
But so that is definitely where I would have outright. But majority of what I do is I put on a lot of these inventory with a view on them, and then I'm able to wait until it's favorable to get out of those inventory.
Okay, and with this type of style of trading, like you have quite a large position on it, like all the time.
Yep.
But you're constantly hedging through various contracts across the strip.
Yep.
I'm not sure where I was going with that. So just so if someone's listening to this and it's a little bit confusing.
No, it would be. This thing is part of what I teach to the people who sign up to become traders, and this is a 4-week full-time course.
Yeah.
To try to easily explain it.
So where are you actually making money? Because you're like working this position and you're never really getting flat, are you?
No.
So you're just continually
Well, to give you an example, right? So to be very specific, right? So let's say I'm looking at, so two spreads make a butterfly. So some people will know that, right? Right now I have a big position in the fifth butterfly. It's just a 2-point range. You try to sell at positive ones and get out at neg ones. That's literally all I do. I try to put on as many positive ones I get out. And then when the opportunity comes, I'll buy back at neg ones. And that's 2 points there. Now, if you do that on enough inventory, that's a decently good trade.
So how long until you, let's say if you're in a, what was it, positive one?
Yep.
And you want to get out at negative one?
Yeah.
How long might that movement take? Like that's not going to happen intraday, is it?
No. So these inventories anywhere between a couple of weeks to up to, 2-3 months. It really depends. So, and that's where inventory helps with trading, is that it gives you time. You get to wait until something's a bit whack and you're able to get it away almost freely. And that's one of the things, spotting these opportunities. You might be able to get positive ones away very easily, and you will just load the boat up. You would, completely max out your limits on those positive ones, because that's been the range for the last, say, 12 months, probably more than that, to be honest. And at the time you put them on, it's probably going to be very hard to get them out at neg ones, because everyone's just put them on. You can't get them out. But now you have time to wait because you have a very safe structure, right? And a month down the track, it might be you might not even need to leg it. You might be able to just go to market on a bid and an offer and get out neg ones. And that's what I really look to do. I don't want to take that much outright risk because of what I really, what mainly makes me money is the inventory.
What's going to cause you to lose money?
A big shift in the Bill's yield curve would probably put me under some pressure, especially if the yield curve forms some sort of an inflection point, right? So, for example, right now it's a very stable, normal yield curve that goes down. If for whatever reason, RBA comes out and says, RBA will never say that, but the whole public decides we're hiking rates in exactly December 19, and everyone's convinced of it, and nothing else would change. That's probably going to screw me up a little bit, but that is sort of where the skill lies. I think a big part of the skill is how to not lose money than how to make money. Because we have the saying, if you make money, you're lucky. If you don't lose money, that is skill, right? If you're wrong and you're in a shitty position, but you're able to work out of it, and not to hold on, right? So I want to clarify that for people listening. So that's not what I mean, right? I mean, if you're in a crappy hedge position, how to work out of that complex structure, right? That takes skill. So I guess I just back myself to get out of these heavy inventory should that time come. And until then, I'm happy to, stay in them.
Now, you spoke just before about having a structure on, or at least a position in the fifth contract. For example, what drove that trading decision? How come you were interested in the fifth contract?
It was available. Let's be really honest. I'm always looking at all the different butterflies and other structures that are available across the bill strip. And my own philosophy, trading wise, is there's no point really going for the really hard trades. Just why make your life difficult, right? If it becomes available and easy to leg, and by legging, when I was talking about it, just the first initial outright exposure to get into these spreads. And then if you put two spreads together, you get into these butterflies, right? So sometimes those are very easy to do. Perfect example right now. So I've been short the second butterfly for probably 1.5 months. I was initially short at pars just yesterday. Next threes were literally at market. By that I mean no risk. Buy an offer, sell a bid. Bang. Exit my entire inventory. And that's just become available.
Okay. So when you say it's available, you mean it's trading on the bid at, a price that you want to get filled
That's correct.
at.
Yeah.
Yeah. Interesting. And you're also, so what we've been talking about here is predominantly the bank bills.
That's correct.
You're
yeah.
also trading the bonds.
I
I
also trade a little bit in the bonds as well. The Aussie 3s and Aussie 10-year bonds. Yeah.
How much of your trading would you say that makes up?
Well, during rolls, it's a huge part of what we do. I can talk a bit about that later. But outside of that, I'd say maybe 15%.
Okay,
max.
So it's very little.
Yeah.
Okay, well, yeah. What are the roles?
Yeah.
I mean, anyone who's not in the Australian futures industry is. A lot of this conversation, I think, is
this is very technical. Yeah.
For a lot of retail traders, though, they're not exposed to this type of trading. So I think it's interesting that they do hear about this sort of thing.
That's fine.
To sort of know that there are other strategies and other ways of doing things out there which aren't entirely directional. So yeah, explain to us why you decide to get involved in the bonds during the rolls period.
So the rolls period is literally when the futures contract expire, right? So most of the time, now I mentioned, in bills, we've got 8 contracts that's always actively trading, right? Whereas in bonds, it's always just the front contract, right? Most of the time, no one's trading the back, or say right now, the December contract. No one's trading the March contract. Now, during rolls is when people who are in a December contract, they need to, I guess, roll over their position into the March contract. For the more long-term traders, or actually, they might not even be traders. There could be like central banks, because we're talking about government bonds here, right? Like, so as to who needs to hold these, right? To central banks, large investment firms, managed funds, they might all need exposure to bonds via futures, right? And they don't really care about day to day, but they've got a sizable position and they can't let it go to expiry. All right, so they need to roll it over to March. So that's what happens. So the reason we trade that is for 2 reasons, right? One, during that period, there is a lot of free opportunities because, this will almost go back to almost what I was talking about in terms of when I was trading institutional at Macquarie, is different people, like the large guys, they don't care about a couple of ticks. They just need to get done, right? And this is, 1 week where anyone has any exposure to the bonds in a longer term needs to roll over. So they just need to get done. They don't really care about a couple of prices. Whereas that's our livelihood, So there's a lot of free orders, a lot of free money, so to speak. At least there's a lot of activity. So that's one to start with. It's the most intense week in a quarter. I typically trade 20 to 22 hours a day during that week. So
in a row, like non-stop.
Yeah, that's right. So Monday to Friday. So I'll probably get about 10 to 15 hours of sleep that entire week.
Okay. Wow. I imagine that must have some challenges in itself.
You get used to it. The first time wasn't fun. After a few rolls, your body's ready for it now.
Okay.
Yeah.
And how do you find trading the rolls has been for you? Because I believe it's become much more competitive over time.
It's changed quite a fair bit. I mean, there is definitely, now rolls used to move a lot, the book, right? The actual rolls contract. Whereas now, you're kind of stuck at probably maybe, 2 prices, which is fine, which means you just need to adjust your strategy, right? So for me, that just meant I needed to adjust from holding onto a lot of rolls and letting it collapse in my favor to legging in and out as much as I can, and not taking any directional view on the book.
I just want to make sure we try not to lose as many people as possible here. So when you're talking about legging in and out, can you dumb that down a little bit?
Sure. All right. Well, I'll explain what we do during rolls, right? So during the rolls, the back contract comes alive for the bonds, right? Which usually isn't there, right? So instead of having, for example, just a 3-year and a 10-year contract, now we have 2 3 years and 2 10 years, which means we can now hedge the front against the back 3 years, right? And because they're the exact same contract, the exact same product with different expiries, they move mostly in tandem. The rolls book is the price differentiation between those 2 contracts. So, for example, the rolls book might be, halves at 1, right? So halves bid, 1 offered. Now, during rolls, that book will be massive. So typically in 3 year, you're looking at, a couple of thousand contracts aside. But during roll book, this can be a couple 100,000 aside in a book. So you've got a lot to lean on, so to speak. So if there's one offered, then you will try to leg that spread, right? By buying the back 3 years, selling the front 3 years, hopefully at the price differentiation of one. Now, you might screw up and get halves instead. But either way, you're not short rolls. So you try to leg as many ones as you can. Now, typically, you might wait for halves to trade out, before when they use the collapse. Now, you might not have the luxury. You have to leg halves back out. That is a more dumbed down version, but I'm not sure that's...
No, I think that's good. That's good. And, this is very kind of common stuff in prop trading, isn't it? And I think it's good that people hear this because for a lot of retail traders who don't know anyone in the prop world or what have you, it's this sort of trading they're probably oblivious to. And it's like most of the prop firms in Australia, all the prop firms are pretty much in Sydney. Most of them are doing this type of trading, right? Bar a
fair amount, yeah.
Yeah. But the point I'm trying to make here is it's a very prominent style of trading in Australia. And also, there's huge firms in Chicago who are doing the same thing in, the US futures. And you said before trading during the rolls period, you're obviously very busy trading sometimes 22 hours a day. Even in your day-to-day trading of the bills, that market trades, it stops once in the afternoon and then once in the morning for about an hour each time.
Yeah.
So that also trades 22 hours a day.
Yeah.
So how do you manage that?
Well, a few things, right? One, minimizing your exposure to a large event of any kind. So staying hedged. I don't usually hold much outrights overnight. And two is, being with a prop firm, we have the benefit of having a desk, a broker desk, which services mostly the firm itself. And you can leave various instructions, orders, or even call levels with them, right? So someone will ring you up, if 3 years break through a new price or something changing a spread or something like that. So that's a 24-hour desk, which is the benefit. Now, obviously, it means you're gonna get some calls at some weird times, and that's a lifestyle. That's the thing with trading. There's no such thing as a part-time trader. I mean, unless you're well, into the veteran stage and you just want to relax and not trade as much. But if you're starting out, there's no such thing. It's a 24-hour market. You need to be ready at all times. My phone's ready. If I'm out at dinner, I might need to run to the office or home. I have a home setup as well. So, wherever I am, I'm going to need to be aware of where things are.
Okay. So most of your trading is obviously done during the daytime.
That's correct.
Session.
That's where all the liquidity is, mostly for the bills during the day. Also, because I do need to stay sane. So so majority of my focus trading is during that, say, 10 hours. Between 8 and 6 p.m. And then if something big happens, then I'll have another look during the US or Europe session.
Okay. On that note, is there anything you do outside of market hours which you find helps you during market hours? I mean, market hours, when you're talking about the bills market and the bonds, it's 22 hours. But let's say you get where I'm going with this.
Oh, you mean like things you do outside to just help? Oh, I think people need to learn to also switch off. Like if you're in a full-time commitment trading, switching off is really important. Doing something active, man, like something. So I do a bit of Muay Thai. And it's great for releasing some, pent-up anger, steam. I think, it's as good as it's going to get, right? Other things, people might go to gym, go for a run. For me, kicking the crap out of a heavy bag, this helps out, gets the blood flowing, gets your mind off, especially if you've had a really bad run. You got to go, take a walk or something to change your mentality, because it's all in here, man. Like I would say 70% of trading.
Yeah. Yeah, no, totally, man. What have I got here? I'm just, as we're sort of touching on psychology, I'm just...
I've got a thing I wanted to say there.
Okay, you go.
Because earlier I was talking about psychology in terms of, believing in sort of the uncertainty, right? That anything can happen. You kind of got to believe that. Now, because if you do believe it, then you're not going to be stubborn when it happens. You're like, okay, fine. It was a 95% trade. The 5% happened. Fuck it. It happened. Right. And then you're at peace with it. Now, I would say the next step is, you should reward yourself in a way that's consistent in how you sort of want to, where you want your psychology to be, right? For example, you don't want to be just jumping for joy when you make money and going to a deep depression in the corner when you lose money, right? Because if you're rewarding yourself based on the amount of money you've made, it's actually better to reward yourself based on the quality of the trade. Because that will make your actions and your psychology consistent with where you're trying to be, right? You don't want to be the guy who just celebrates making money. You want to celebrate making a good trade. If that means losing less money, you need to celebrate it. Whereas if you make money on a shit trade, that's where it's really dangerous.
So how do you differentiate between the two? Because that can be quite difficult.
I've got a good one. It's been so long that I don't think the firm will care anymore, but I never told anyone this earlier, right? So, for example, we trade tier 1 Australian domestic data, right? We try to jump right on that first second. So when I first started, and I'm talking about 5 months in, all right, there was one time where we were all waiting for the unemployment figure, the largest figure in Australia, right? Now, you don't want to go into that with an outright. It's crazy. And back then, it would gap 10 points each way, and that's huge. Seeing that most trades you're trying to make 1 or 2. I jumped in, right, when I thought the data was out.
Oh, okay.
So the market gapped 3 prices down, right? And I was like, oh, it's out. We're going down.
So you were already in?
Oh, no, I wasn't in yet, right? So I'm waiting for the figure to come out.
Okay.
And then the market, this is all within like seconds, obviously, right? The market gapped 3 prices down. I go, yep, it's out. So I went and sold. And then it paused for what seemed like an eternity. It was only probably another second because it was a bit weird. I was like, why is it paused? And then it collapsed like there's no tomorrow, right? It collapsed so much I didn't even know what price I got in. I had to go check because my DOM was refreshing so fast I couldn't even see the price. Now, I was lucky because I was right. So I made 10 ticks in an instant trade, right? Like it was probably a second. What actually happened is I placed a 10 grand 50-50 bet.
Right.
That's a shit trade that I made money on.
Yeah, okay. Yeah.
So obviously there's very clear ones. And I thought I should ask, sorry, because it's funny. I mean, they'll hear about it now in the firm. But if that went the other way, I might not be here talking to you anymore.
Yeah.
To be really honest, you know.
And that's the thing as a trader, like I did a podcast just yesterday. It'll come out again. It'll come out, in the next couple of weeks.
Yep.
Probably by the time this episode airs, but like in some instances, all it can take is just you to be off guard by just a little bit. And yeah, you can find yourself in a very different situation.
Yeah, it's actually all about risk management. It's because it's not everyone's like, yeah, that's how to make some money. It's more about not dying.
Yeah. Yeah. Man, that's crazy. You're very lucky that went in your favor.
Oh, absolutely. To this day, I recognize that. Okay, there's 2 things in my career could have ended my career. So it takes a little luck to not get completely crushed. But that being said, I've also had a lot of bad luck. I just don't remember those because these are the better stories.
But that's it as well. Yeah. Like you do also have a lot of bad luck as a trader, or it seems like you have a lot of bad luck that when you do have some good luck, it's worth enjoying it.
Yeah, no, why not? I couldn't tell anyone that story because I figured they might look unfavorably, but I'm pretty sure it's fine now.
Well, let's hope so, because a lot of people are soon to hear it. What about in examples where it's not so obvious, just on like sort of day-to-day trading?
Yeah. I would say that the probably rule number 1, and I'm assume the people who's going to take advice from this are relatively new to trading, right? Is not following your plan, right? Because in the beginning, I would harp that is gospel. If you have a plan, where are you entering or what needs to happen for you to enter a trade, and then where are you taking profit, where are you taking the puke, and why, and for whatever anything needs to happen, right? All of these should have been planned out before you enter a trade. Now, if you enter the trade and you don't follow that plan, that's a shit trade. doesn't matter how much money you've just made, right? Now, the reason I say that is because in the beginning, it's more often than not that mid-trade decisions are usually not good ones, right? Whether you're under the pump, right? And a typical example would be you get into what would seem like a short-term trade, and it's starting to come close to your stop. But on a bigger time frame, this looks all right. So this now is turned into a long-term trade. Now, no one changes a short-term trade into a long-term trade when they're winning, right? They'll get to your take profit, you're like, great, happy days, I made money, trade worked out. You only do that when it's completely going against you. So that's a really good example. Like, you don't in the beginning, you don't really want to be changing your plan. Now, if your plan is crap, and that's fine, then you still need to follow that through, because discipline is really important as well. Having that discipline to follow your plan. Then when the trade's over, you're not in the heat of the moment anymore. You can objectively assess your plan. Maybe it was flawed, but that's fine. This is why you're here. You're learning. It's not about making money in the beginning anyway.
Yeah. And as we're kind of on the topic of psychology here, I did want to ask you, how do you deal with periods where you're perhaps underperforming and not doing as well as you'd expect to be doing?
From a P&L point of view, or from a
Yeah, I guess we could sort of talk about both, but mostly from a P&L point of view. Like, let's say you're just on a bad run, and I mean, I don't know, what your bad runs in the past have looked like, but let's just say, there's been 2 months go by and you've, you're not really up.
Yeah. Oh no, that's I think, and I read this in one of these books. I can't remember what it was. It says success is perishable, mastery is not. Might have been like a book called The Trading Athlete or something. I find it really important, right? Because we value ourselves, and this could even go to day-to-day life, right? On something. You pride yourself in something, right? Whether it's your job, your money, whatever, your looks, could be anything, right? How well you dance. Now, if you value yourself based on something that's perishable, because you think it's not, but it can. Like, any physical thing is perishable. Whether it's your house, it's your money, it's to be honest, your girlfriend or something, right? Then when that perishes, you're gonna be in a deep state of distress or whatever it is, right? So I guess I've always looked at myself and proud. How do you say it?
Yeah. What's the right word there?
I don't know, right? I'll try to say pride myself in it.
Yeah.
It sounds weird,
myself.
is it?
I think that's the right way.
So
let's
pride myself. Yeah, let's go with it. Pride myself in my abilities, right? And both the ability to climb out of holes, like, P&L holes, as well as that, well, okay, I've had some bad runs. If I look at it and go, am I really doing the wrong thing? And that's why I asked you to clarify, that question. Now, if I'm doing the right things by my edge, and I've assessed that there's nothing wrong with my trades, it's just that I've taken on, 2 months of 80-20 trades, and they've given me 2 months of 20% outcomes, then that actually doesn't really affect me as much. I get really annoyed at myself when I, do the wrong things, the wrong trades. So therefore I'm like, okay, I've lost some money or whatnot, but I'm still the same trader. Therefore I can still hold sort of my head up high and go into it again and just go, that was the 20%. Whereas if I was pride myself in my account, then maybe not so much after that too. So I think that's how I deal with it from a psychology point of view. I really focus on sort of what I can control, which is my skill and how I trade, not the market.
Now, Jack, I'd like to go into probably the last subject, which we'll get into, talking about Minter Capital.
Yep.
Because I think this is really cool and this is quite interesting. What are you doing there? What's the idea behind it? So
Minter Capital is sort of what I've taken from, I guess, my last 5-6 years of prop experience and going, I think this is what's going to improve the success rate in the industry. And I want to, give people sort of a much better development sort of experience right now. I think it's no surprise that even in the prop industry, I think the success rates, I don't know what that is, but 1 in 10, 1 in 20, something like that, right? And, I have my thoughts on it, especially given that I've just finished this is quite fresh for me. I'm only 5 years in. I'm very junior in this industry compared to all the senior guys. So I've just gone through the program. I've been through the program myself, and there are some thoughts that I had there. And for me, a couple of things was one is I have a very small group. There's only 4 guys that I'm hiring at each intake at most, right? And because I want to do that, because I want to give them actual sort of a more close mentoring guidance, rather than sort of having people, having a big group of people and seeing how they turn out, sort of thing. And the second, I guess, thing was I wanted to be able to give them mentoring. And so just currently myself and another person who is mentoring them. And the biggest difference is we're both active and profitable traders. And I don't think that's actually very common in the industry. Like, you might get mentored from specific people who are hired to mentor you. I'm not saying they might have been profitable traders before, but the fact we're still right now full-time trading, I think that adds another level of insights to what we can teach the new guys. As in, the way I came up was I pretty much never had any help, to be really honest. There's a few good guys who gave me a few tips here and there. Obviously, Mark helped me out, but in the grand scheme of things, he was very self-driven, and I think I wanted to give them that. And the last thing is, really, really putting together a tight team environment. Prop trading is such a lonely job. It's your own book, your own losses, your own gains. Like, you can make $1 million and you might not have anyone to celebrate that with. Right. There's no team, no one else cares, right? But to put together a team and just really have them bounce ideas off each other, have the "what am I doing with my life" conversations, which if you haven't had that, you haven't gone deep enough into prop trading, right? But I think that's what's going to really help people develop. So I'm really I'm changing, I guess, the model a little bit and I'm going to invest a lot into fewer people and try to bring them up to be successful traders.
Okay. So what's kind of motivated you to do this? Because obviously you could just continue trading your own book and, happy days. But you've decided to branch out and do something a little bit bigger than just yourself.
I think for 2 reasons. One, I was lucky that I had people that I can really connect with in my trading career, and they really added a lot of value to my trading. Kai. So, we used to trade very closely together when he was still at Genesis. And then obviously Mark helped out a lot as well. So I wanted to create, I guess, another environment like that as well. I think both for myself, it sounds a bit selfish, but one of these guys is going to be my trading buddy, and bounce ideas off each other and stuff like that. So that's probably one of the main motivations. And I do find that, I enjoy actually contributing. Like, it sounds a little cheesy, but this can be life-changing for somebody, right? They've done some 9-to-5 job, they hate it. If I can help make one person a senior trader or, consistently highly profitable trader, their life's going to change forever, and I'd really enjoy that as well.
Yeah. Yeah. I mean, it can be very rewarding to see other people who you've invested time in or helped out.
Yeah.
And then, they take the things that you've helped them out with and they really make something of themselves based on that. Like, I totally get that.
Because I can tell you, it's definitely not about sort of, what this business can bring. It's really a rewarding way as well for me, because, when I'm constantly teaching, I remind myself to not do stupid crap.
Yeah.
It's like, I've just said to him, don't do that. And I go and click it. I'll be like, that was really stupid, But yeah, it is so rewarding in that respect.
Yeah. Now, this might be a bit of a personal question. Feel free, we can skip over this if you like, but I'm curious to know, because it probably says a bit about you. How is this kind of structured? Like, because obviously you're with Genesis. I know you've got some sort of partnership with Genesis. So how does that kind of work there?
Well, I mean, in short, so Genesis, is pretty much backing me to do this. If you really want to think about it, is I'm just simply responsible for training these guys. We are in Genesis office. We're trading Genesis platforms. they're on Genesis Capital. Let's be really honest. That's sort of how this entire thing works.
And are you responsible for their risk? Like if one of these guys blows up,
Yeah.
or loses too much money,
Yeah.
do you have to wear that?
Yeah, I do. So I'm responsible for their. So when I say Genesis Capital, I mean the margins and all that, right? But yes, so I'm entirely directly responsible for sort of their risk, which makes sense because I'm developing them. So it goes both ways, obviously.
No, I think that says a lot about you, man, because like that's real skin in the game there.
Yeah, no, that's true. Yeah, there's that's as they bleed out or as they become successful, I'll definitely be I'm very much in them on that.
Yeah, because you've got four. There's four guys.
Four
right?
guys. That's right. Yeah.
And they're all. Do they have any prior trading experience, or they're fairly new to it?
I mean, rudimentary, just like myself with my CFD accounts at best.
So how did you pick these four guys?
It was actually a very long recruitment process. There was a lot of interest. I think I got like 400 applicants.
Did you really?
Yeah, I put up on Seek for a month, and it was pretty crazy.
Man.
But I really wanted to find. I had type of person. To me, like education. Like when I say education, I mean like official education, or like whatever your degree was, and whether you've done trading before. That comes secondary to the personality, right? Because to be a successful trader, you've just got to have grit. You got to go through the dark days. Like every successful trader would have been in a massive hole at least twice in their career. So whereas the other ones just die off in that hole, right? So if you don't have the grit, you're not going to be around for long. So that grit and competitiveness, and not just everyone says they're competitive, but not just like the kind of verbal competitiveness, like real competitiveness, i.e. if we play something together and I win, you're going to spend the next 2 weeks practicing that to come back at me. You're not going to just trash talk. You're literally going to spend your entire time focusing on improving yourself and coming back at it. Trading's like that because you're going to you get crushed. You could just mop about, or you spend a whole week thinking about how you can improve. So those specific characteristics. I interviewed like 52 people personally, and really want to look at their character more so than sort of other attributes.
So how did you judge that? Like what type of questions did you ask during the interview?
Really, I guess really life decision based. Sort of not life decision, life experience based. So I had one guy who told me about sort of all like, so pretty much asked him, what's one of the hardest things you've in your life and how do you bounce back from it? These kind of questions. Because I'm looking for people who's actually done something competitive as well, whether it's in sports or even gaming. Like not casual gaming. I mean like properly professional gaming, sports, poker, something where you're putting something on a line, pride, money, and you can lose. That takes a certain kind of person. So that experience was really, people who had that obviously looked, favorably upon.
And what's the process been like from bringing these guys on? How long ago did they start? Because this is all quite new.
This is very new, yeah. So they went live in November. I started training them midway through September. So what happens is I had, it was scheduled to be 7. There ended up only being 5, right? Because people changed their minds, who were going through what I called the training program. So the training program is a full-time program for 6 weeks where they do demo trading, as well as, I have classroom elements to teach them all the strategies and actually all the mentality and psychology that trading involves. But I'm also assessing them during that period. And then, once they've finished it, if they passed, then they get offered a contract to start trading, which started at the beginning of November.
So how have you structured the training program? Because obviously, you've been through a program in the past, which was your foot in the door at a prop firm. So how are you structuring your program, with that experience and with 5 years trading behind you now? Is there anything you've done differently compared to how you were trained, or?
Yeah. So I guess the first thing is for me, I think going straight into the deep end is very important. Like, you just got to start trading, whether you're making or losing money. You got to get involved. You don't learn trading by reading books. You learn trading through trading. So they start on demo pretty much day one, right? Whereas I think I started maybe 2-3 weeks in. So we're teaching theory alongside, demo trading, whilst they're getting taught sort of, I guess, real feedback from active traders like myself and the other person who's teaching. The second thing is I've made this a bit more structured to help people ease into this kind of lifestyle, because the trading lifestyle is different, right? After you become profitable, no one really cares. Like, you can become a millionaire or you can stay where you are. You got to drive yourself. It's your own business, right? So, we've got this sounds a bit cheesy. We've got a belt system at Minter Capital, right? Like, you start like in a martial art way, right? You start at a white belt. Eventually, when you make 7 digits, you're now a black belt. So this goals and setting goals for people to achieve. And that's what I found was one of the things that lacked for me. After you've reached a certain point, and for us at LM, that was like probably 40 lots, trading 40 lot bills, which means you have access to everything else, right? You can trade the curve now, because the curve minimum is 33, 3 years by 10 years, right? You can't really trade it if you don't trade that size. So once you've gotten to that point, that was it, So I wanted to give people a real sense of progression as well. So they've got active goals to work towards and something to celebrate.
Yeah, that's cool. That's cool. So did you say you had 5 people initially and then it dropped to 4?
Yeah.
Okay. So what happened to the 5th person, do I ask?
I could talk about it. I mean, there's no hard feelings in trading. It's one of the least bureaucratic industries, right? It's very definitive. It's on a statement, No, it was just the sort of the risk tolerance. The risk management for me wasn't really there for the person. And that's unfortunately, I only have 6 weeks to look at something. Right, and this is where I make a decision whether I'm going to risk, 25 grand on a single person. So, at the very least, I wanted to see, good risk management during that period, and that's something, unfortunately, didn't work out for that particular individual.
Okay, and will these people, these 4 people who you've got starting with you now, are they trading the same products as you?
That's right. So the idea is that they are going to trade using my strategy. Well, it's not mine, but the way I trade.
Yeah.
Simply because it's proven. They have free reign once they become profitable traders to do how they want to do. But if they can get this down, make it their bread and butter. If you've got like a couple $100 coming in from one trading strategy, and you want to go do something a bit crazy, mate, be my guest, right? But at least this is happening. You don't want to do the crazy thing day one, right? So they're trained in the exact same way as I trade, and it's just this has like the biggest sort of success rate for beginners. This type of trading.
Do you have any expectations on how long it will take them to reach a certain level of consistency or profitability?
Typically, it takes, I would say, at least 6 to 12 months to become consistent, but it can be longer. And that's the crazy thing with trading. It doesn't really, there's no set path. There's some people that make money day one, and then there are some people, and who I know this individual who took a while, maybe 18 months. And then has just skyrocketed, So there's no real, it's not a linear career path, by any means. But I'd say typically you're going to expect probably 6 to 12 months, at the very least.
So what's your longer term vision for Minter Capital? Like, where do you think this will be in, the next 5-10 years? I'm sure you've thought that far ahead.
To be really honest, to me, it's more like one trader at a time, because I'm not going to take in traders every quarter, because that's too much and I can't focus enough on the existing guys. So at best, once a year, I would say. And then from there, I'm just going to keep generating these traders. Now, if they want to take on traders themselves, they can. Sounds a bit like a pyramid scheme, but I just realized how that image came up. So it will be like a very organic growth kind of thing. For me, it's really about just taking on one trade at a time. It's not going to be like some empire. That's not where I want to take this. It's more about me helping out people and then being able to take on a few traders and create a good environment for people who really want to be traders.
Okay. Solid, man. Very cool. I think I've just looking over my notes here, I think I've pretty much covered everything I wanted to chat with you about, plus more. I don't know. I know you've got a couple notes over there. Is there anything with...
it's pretty similar to what you had. I think one final thing would be, for traders who's in this right now, and they're doing it tough, right? Because that first year is it's like borderline depressing. Okay, you're trying to learn, right? But because progression is not linear, like I think you can imagine if there's a point here, right, where after this point you start making money, right, and you start here. Doesn't matter if you're here, you're still making nothing, right? To really be patient with themselves for traders, like don't set yourself too much. Like obviously people have life, circumstances, financial circumstances, but don't set yourself sort of limitations and time to hit something. You don't want the pressure of that. It doesn't help. You have to be patient with your development. It's not a get rich quick scheme, so to speak. So that'll be my advice for people who's in that middle period. I was lucky I had a few people I can depend on, and I'll tell you, I've had more than one. What am I doing with my life? Kind of conversations. But then you pull through next week and keep coming in. Eventually it comes back to you. But at that point, it wasn't that apparent. I have to say.
Yeah, of course, man. So if anyone wants to find out more about what you're doing or connect with you online, is there a way they can do that? Are you on Twitter, LinkedIn?
I'm on LinkedIn, but it's probably a bit hard to search for me on Google. That's the problem. You type in Jack Ma, I'm on page 67, right? Like because of the Alibaba guy.
Yeah. I said to my mate, do you know Jack Ma? He's another trader in Sydney here. I said, do you know Jack Ma? I'm going to be doing a podcast with him. And he goes, Alibaba guy. And I said, no.
Yeah, he's like, Aaron, you've done well for yourself, mate. Yeah. I mean, I didn't know he was a trader, but that's a good interview, mate. Yeah. Like, that's pretty hard to get. You can find me on LinkedIn or, onto the Minter Capital website if you're interested in it. It's just mintercapital.com.au. Or, you can drop me an email if people want to discuss about trading. That's fine as well.
And your email address, is that on the website or you want to give it out?
Yeah. I can give it out. jack.ma@mintercapital.com.au.
Okay. And Minter, just to be clear, is spelled MINTER.
Yeah.
mintercapital.com.au. Okay. Well, I'll put these links in the show notes, like on the Chat with Traders website. So it'll all be there anyway. I appreciate you doing this, man. It's been a lot of fun.
No, mate, thank you very much for having me, mate. It's my pleasure.
You've reached the end of this episode of Chat with Traders. But rest assured, there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes. And we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Hey everyone, thanks for joining me on episode 170, and Happy New Year, by the way. My guest on this episode is Joshua Greenwald. He's the CEO of a newly formed crypto derivatives exchange, LXDX. But the part that got me keen to speak with Josh was the fact that he was a professional trader for more than 10 years prior. Josh started his career at DRW Trading in Chicago. He then left after 6 years and went on to co-found Greenlight Trading, which was a proprietary firm specializing in low latency options market making almost exclusively for Asian markets. Greenlight grew to be a team of approximately 30 people before it was acquired. Over the next hour or so, we spoke a lot about Greenlight, the timeline from beginning development up to beginning to trade, the signals and the opportunities that they went after, and even the technology that they utilized, such as custom-built FPGA chips. Then, towards the end, we discussed what's involved in starting an exchange, the functionality and the features that are missing from most crypto exchanges that are common and almost a given in traditional markets, and how LXDX is using a security token offering for additional funding. But please, let me be very clear, this is not an endorsement of any kind. If you do decide to purchase tokens, that's cool, but that's totally on you. Not my responsibility, okay? Let's get started. I really enjoyed this conversation, and the topics we covered were super interesting. I hope you'll enjoy listening. Here is my guest, Joshua Greenwald. So you just got back from Asia, did you?
Yeah, I was out there working on fundraising for LXDX for the past week.
Okay, so you're trying to get investors over there, right?
Yeah. I mean, we're doing a security token offering, kind of one of its first, and I'm out there kind of one, obviously raising forward, and two, explaining to people how it all works, because it's kind of an unusual, still novel way to raise funds.
Yeah, I did read an article online about you were doing something like that. So I've actually got it in my notes here to ask you about that. So we will get to that.
Sure.
Now, you started out your trading career at DRW. Just tell me a little bit about how you actually got started, obviously at DRW, some of the things you were doing there, and then we'll get into what you were doing at Greenlight, because I think that's really interesting. But yeah, take it away.
Sure. So to a large extent, DRW made me. I started there 12 years ago, actually at the same time of one of my co-founders here at LXDX, John. We both were there. I was there working on a group, coding, helping build models for a group that would eventually become DRW Equities, which I'd eventually help run. And thanks to awesome mentorship and a fair bit of luck, we were quite successful. My interest, especially as we kind of left the post-Lehman world and went into the zero interest rate world, my interest kind of shifted more to Asian markets and HFT. And so when DRW launched an Asia group, I was thrilled to hop over and work on that and kind of run research for that, and eventually Kospi trading for them. And that was kind of success there is what led to me and a few guys starting our own firm, which was Greenlight.
Yeah. So what motivated you to actually go out on your own?
I think that the things that you can do at a small shop and the things you can do at a big shop are very different. I think that DRW is a very, very powerful place to go after certain strategies, but for the specific businesses we wanted to do, which was ultra low latency build our own hardware, do FPGAs, like get into new products fast and keep iterating fast. There's something that's powerful about being kind of like your own lean small shop and being able to do whatever you want without getting approval for trading products and stuff like that.
And how long were you with DRW before you decided to branch out and do your own thing?
Let me think about that. I got to DRW in 2005, so I guess 6 years as a DRW.
Okay. And prior to that, had you had any trading experience?
No, none at all. To be honest, I knew nothing about trading. I was studying information security at Carnegie Mellon, and I happened to wander into like one of the like campus info sessions that DRW was holding, and they're explaining market making and trading, and I was more interested in blackjack and poker back then. So I met one of the partners and talked his ear off about how to model clusters of cards when you shuffle a deck, and he thought it was a applicable skill set for financial markets, and that's how I ended up meeting the DRW guys.
Yeah, okay. I'm sure you did. So you left DRW after about 6 years, and you started Greenlight Trading, which was your own thing. And did you have another co-founder when you started this?
Yeah, so there were three of us that founded Greenlight, or GLT, sometimes it's called. Brian, Eric, me, and John. And John and I are two of the co-founders on the new thing, LXDX.
Okay. And what was Greenlight? Like, how would you sort of sum it up, I guess?
Greenlight was fun. And we were good. We didn't have, like I said, the resources of a huge shop, but we had the specific expertise that you could really lever and move fast. And so we had, some of the first, like FPGA solutions in the market, and a lot of the markets we traded in. We were a large percentage of the market in Kospi options and some of the other Korea products. And then we were a big trader of Japanese futures, CME options, kind of like a broad set of things where you could really bring ultra low latency tech to the table.
So you were purely options?
Not purely options. I think that we were pretty product agnostic, so we would trade anything as long as we could model it, and we thought that we had an edge, we would trade it.
Okay. So what other things were you trading besides options?
We traded index futures, currency futures, bond futures, all over the place.
And were the futures mostly to complement your options trading? Like, was that part of the strategy where you would trade the options against the futures, or something, some sort of complex strategy like that?
Well, I mean, we did definitely some liquidity provision in options. So, like we were doing market making in options, and when you got filled, you'd hedge. But a lot of our strategies were kind of short-term momentum. Like, so we'd have like a machine learning model that would say, hey, I think that this asset is gonna move a few ticks over the next 30 seconds or a minute. So grab some futures and ride it for a few seconds and then get out.
So Greenlight was you could describe it as a proprietary trading firm.
Proprietary trading shop, correct. We traded all of our own capital. We did not have any outside investors.
And how did you go with getting the capital to trade? Like, what sort of arrangements did you have there? Were you able to sort of put up money with a clearer and they were able to offer you a lot of leverage, or was that not necessary?
That's the bulk of it. I mean, we used our own capital, and we used our brokers to lever up to have access to the opportunities we wanted to be in. I mean, most of the products we traded were pretty highly levered anyway, so we were able to make like extremely outsized returns on a pretty small starting stack.
And are you able to share a little bit of insight to what kind of volume you were doing? You said that you were a large, or quite a decent chunk of the volume that was being done in some of these products that you were trading. Can you give us some numbers?
I can probably give you some ballparks. I think that, in most of the highly liquid things like major index futures and options, we were, 3 to 5%. I think that where we were very large participants were some of the smaller products on the KRX or SGX, where we probably We're between 10 and 25% of a lot of those products.
So SGX is obviously Singapore.
Singapore exchange, and KRX is the Korea exchange.
Yeah, okay. So you focus predominantly on the Asian markets?
Yeah, Greenlight was almost exclusively Asia markets, with the caveat that we also did market making in S&P index options as well on the CME.
Okay, and you were mostly, you were based in Chicago doing this, right?
Right. So I was based in Chicago. Eventually, Greenlight had offices in Seoul and Vancouver, but the bulk of all of our development, all of our trading was always out of Chicago.
Okay, and did that were there any issues which came with that, or any challenges from not being, closer to where the Asian markets are trading?
Yeah. I mean, other than the impact on your personal life of having to work from 4 p.m. till 2 a.m. all the time, which is significant, and leaving the Chicago office at 2 a.m. when it's negative 10 degrees outside is not the greatest way to live life all the time. Definitely, in Asia, there's a lot of need to be on the ground and understand the situation. Just not all of the information about how to connect to the exchange the best possible way, like when new products are coming out, when regulations might change, when rules might change. All of that you get by being out there frequently, or by having a physical permanent office there. And so that's why eventually there was a permanent presence, and why, for most of the time running Greenlight, one of us founding partners was out in Asia once a month. So there's basically always someone from the firm out there.
Yeah, makes sense. And you were later acquired, and we will get to that, but how many people, what size did Greenlight grow to?
I think that when I left, Greenlight was about 20 people, and I believe it grew a little bit past that point.
Okay. And out of those 20 people, how many would you say were actual traders? How many of those people had trading roles? What was kind of how were those 20 people split up? What sort of different things were they working on? I presume the sort of trading that you guys were taking part in, you had a lot of developers and probably only a few guys who were actually doing the trading. Can you shine a little insight on that?
Sure. So, when we started, we had basically just two of us as traders, and we quickly had 6 or 7 other people that were sort of developers / IT operational support. I think once the firm was sort of really plugging away, we probably operated under a ratio of 2 developers to 1 trader, approximately.
Okay. And were there other roles besides just traders, developers? Maybe you had more specialized developers in certain areas like networking and that type of thing?
Yeah. So, I think that we viewed, so one thing that's a little bit unusual for us is we didn't really view that there being a distinction between research and trading. So everyone that was involved in researching, developing strategies, or even just doing analysis of the performance of strategies was also generally trading. Maybe not as much as the larger traders who were that was their sole focus, but they were still actively trading. On the development side, we sort of had a little bit of hardware development. We had integration between the hardware development and the core kind of C++ software. And then we had a team of kind of core developers that all had their different focuses, order routing, market data connectivity, strategy code. So we definitely broke things up. People definitely wore multiple hats depending on just kind of what was needed.
How long did it take you to actually get up and going? From the time when you decided you were going to start Greenlight, day one, to when you actually began trading, what was that timeline like?
It was about 8 months before we turned the systems on. and we were profitable even after costs in the first month after we turned the systems on. That said, which was a great success. We were something I'm phenomenally proud of building that and having it work so quickly. But people remember their successes and not all the things that went wrong. Like Greenlight, we had lots of strategies that were you work on and they work great. But I think part of trading is always building building great infrastructure so that you can try lots of different things. We had a lot of strategies that we thought were gonna crush it that never got traction, but we always had a big enough book of strategies where we could always have a few things that worked well.
When you say that you were profitable within the first month, does that mean that you were able to cover all the costs of development, etc., from those first 8 months and getting up and going?
No, I mean that basically the recurring costs were easily covered per month at that point.
Gotcha. Okay. So you kind of mentioned it there, but what were some of the difficulties or challenges that you had at Greenlight, either in the early days or, as things were churning along?
I think that one of the things that has been a persistent challenge in my career is that often I am interested in strategies that take advantage of a specific market mechanic, like the way that an auction works or the way that an exchange's lock period works or a break works. And the advantage of nuanced strategies like that is that there's less competition, but one, they're very subject to winning at that game because it's kind of a limited size opportunity. And two, the rules of those sorts of things change frequently. Like an exchange changes how its auctions work, changes how it's the ways in which it accepts messages during different periods of time. So one of the things that we would run into pretty frequently is just that the rules of the game would change as you're optimizing for a specific thing.
Are you able to speak about one of those strategies in a little more detail?
Sure. So in Korea, I could talk about it in some detail, probably not excruciating detail, but in Korea, for a long time, the options market would just open without any indicative market data. So basically the future would start trading, and then all of a sudden all of the options would start trading, and you wouldn't be able to see the prices in any of the options, which creates kind of an opportunity, right? Because there's nothing that means that all of that stuff is in line with one another. So there's just lots of potential instantaneous arbitrages that are available in the first second of trading. So we had a strategy that we jokingly named First Strike after the Jackie Chan movie, which would go after opportunities in the first second of the day. And we spent a while developing it. It's not it sounds like it'd be very easy because it's all arbitrages, but given the limited amount of hedging instruments and the difficulty in knowing which things are in line and which things are out of line, there's a fair bit of as with any trading system, making sure you have all of the edge cases covered. We spent a while developing that strategy, and basically right as we were launching it, they changed the rules so that the auctions were no longer blind.
So when you say that the auctions were blind and you couldn't see the prices, is that you couldn't see kind of the indicative price of where it's likely to open, where it's likely to have the first print?
Yes, exactly. Sorry, you should always call me on when I use nonsensical high frequency jargon. When I say the auction is blind, it's exactly that. There's no published indicative price in the market data.
Okay, so the only thing you can base your trading off is where the futures are trading?
But those are also not open yet. There was back then no indicative price in the futures. So imagine at 9 a.m. suddenly the futures market and all of the options markets are trading, and there's been orders in them because people have been submitting orders pre-open.
Okay, so they all come online at the same time.
Exact same time. And that sort of mechanic is something that you will see repeated in many markets, in many areas. Like there's been similar opportunities in Chinese markets. In fact, that one is still active. As far as I know. People still run basically this sort of strategy in Chinese markets.
Yeah, right. And something like that, there's no chance of a human being able to trade that, is there?
Well, when it's blind, generally no, unless you have some great intuition from some other source. Like if you know that the guys that are going after this opportunity don't know about some large event happening in the underlying cash instruments, or you have flow from some OTC thing which tells you that you can take advantage of the opportunity. It's not impossible that you would participate manually in an opportunity like that.
Okay. Yeah, right. Now, I asked you just before what were some of the challenges you had with Greenlight. Can I ask you more specifically, what were some of the challenges you had, or some of the lessons you even learned while building up a team? Because it's very impressive that you were able to start, I think there was just the 4 of you in the beginning, and you grew that to 20 people. What were some of the challenges you actually had in building out a team?
So I think that there's no real easy way to attract great developers to a small trading firm, because the established big guys have deep pockets and provide great work cultures for developers that, like, you have to, for someone to agree to work with you instead of going to one of the big shops, they have to personally trust you as a trader that you're going to be able to be successful and make the risk that they're taking worthwhile. So I think that, we knew that to be successful in attracting talent, we had to find people that were interested in the optionality of getting in on something at the ground floor. In that regard, it's similar to, like recruiting for a startup. Like, you have to convince people of your vision. It can't be like a purely economic argument that you make to people. There's it's a little bit cheesy to say it's an emotional argument, but there's a inspirational need to be like, yeah, we're the small guys, but we're going to kick ass and we're going to win at this. Like, if you don't have that, and you're just shopping on price, it's super hard to put together a great team.
And did you ever have to offer equity to get some of these developers over the line?
So we typically offered not direct equity in the firm. I don't think we ever offered anyone direct equity in the firm. I think that we typically played by the standard kind of trading firm rules of giving people bonuses from the trading revenue.
Right.
I think that the other thing that we did a good job of is pulling talent from outside finance in. A lot of the best developer talent we had came from telecom, ex-NSA, high-end audio engineering, like lots of people that worked in disciplines that we knew had skill sets that were very similar to building high performance trading systems, because those are all places where people write where performant code is very, very important. So we looked at industries where people write highly performant code and really tried to leverage our headhunters and networks in those disciplines to bring in talent at price points that we could afford.
Okay, that seems like a clever way to play it.
Yeah, I think that if you dig deep on where a lot of the fanciest low level C++ handwritten assembly code is written, it's a lot of times in places you wouldn't think to look. The example that springs to mind is digital cameras. Anyone that ever works on sensors for digital cameras, the code that they write for that stuff is super badass. It's all handwritten assembly. So guys that work on those systems can write you some fast tick to trade systems too. You just have to frame the problem correctly.
Yeah, okay. So what advice would you have for anyone who's trying to put together a team of their own or just starting out?
I think that no matter what, you have to budget 9 months to a year of development time if you're building everything from scratch. I think that like building from scratch is still a pretty good way to go, because it means that you understand the systems. I think that you definitely need to make sure that all of the talent that you start the thing with have enough personal runway where they can commit to the project for 18 months to 2 years, because it's going to take time. And like I said before, as a trader, you need to have a solid book of strategies if you're going to start a trading firm. You can't just have like one or two things that you're going after. Difference, I think, between startups and a trading firm is a startup, you're incentivized to lever up, right? Because you have VCs, you have investors, you have all these people, and you want to like lever up and focus on the one specific thing and do that one specific thing great and get it out to market and build it up. But trading, I think, is a little bit more like portfolio management. Even when you're a startup, like you have to have enough things so that you can keep the lights on while you build them out. So horizontally before vertically.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with 0 locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
So the strategies that you began trading at Greenlight, after the 8 months when you were up and going, ready to push the go button, were these strategies which you developed over that 8 months? Like, did you know at the beginning of those 8 months that these are the sorts of strategies you would be trading, or are these ones which you researched and then developed during that period?
The core ideas of what we wanted to do were known. So we knew that there were like 4 or 5 types of opportunities we wanted to go after. Obviously, like as options market makers, like we knew we wanted to be options market makers. We knew we wanted to quote actively all of the strikes in Korea. And as we had like spent a lot of time doing like delta momentum type stuff, we knew that we wanted to do delta momentum strategies. I think that we knew the high level brushstrokes of what we wanted to do. And most of what I spent my 8 months pre-launch doing was all of the research, calibration, tuning, and kind of like actually figuring out the exact specifics of how the strategies would work. There's maybe like 1 or 2 new things that like we decided we wanted to do during that time, but we sort of started the firm with a decent book of objective strategies.
Okay. And then you obviously added to that over time.
Yeah. As opportunities become, often new opportunities are arising because the market dynamics change, because the market rules change, because the market climate changes, but also, you learn that you can lever ideas from the success or failure of one strategy to do something different.
Right. You said just a moment ago, you talked about delta.
Delta momentum, yeah.
Yeah, what are you referring to when you talk about that?
So I think that like very commonly in electronic options trading, you have guys that are trying to provide liquidity by showing quotes in many strikes of options, and they're like using to determine their prices primarily like their notion of skew or volatility and their reference price of the underlying. And as the underlying moves, they move all of their quotes around. And exchanges like provide lots of different messages and optimizations to make them successful at that. On the other side of the table are guys that are trying to take advantage of market makers being too slow to move their quotes. And so these guys are watching for the futures to move and then trying to get options. And typically like that sort of strategy, like people are going after high or delta options. They're trying to like get directional exposure by trading options based on the underlying's move. It's a game of kind of cat and mouse there.
And so you were more of the later?
Yeah, I think that, you know, I've probably, most of my career, I've run both liquidity making and liquidity taking strategies. However, I personally like have a tendency towards preferring liquidity taking strategies. That's not because I'm a parasite that just takes from market makers, but if you build liquidity taking strategies, they inform your liquidity providing strategies. So like if my goal is to like pick off your quotes when the market moves, well, then it also means that like when I quote, I have the signal that prepares me to defend against that. So I often view like starting out most times when I try and start out a trading desk, I start with liquidity taking and then use that to kind of like build to protect and build the liquidity making around it.
And is this why, and you know, you've mentioned it a couple times that you were a very low latency shop. Is this why reducing your latency as much as possible was so important for the way you were trading?
For sure. I mean, I think that for liquidity taking strategies, latency is where you see like the most impact of being of low latency, because you're going to build these models, you know, like, and they could be fancy, you know, you could have whatever 50 parameter fancy machine learning model you want, but a lot of the signals are obvious. So it's like, even like you and Jump and Optiver and IMC and every usual suspect, you all have different models with different parameters. But like when someone sweeps the book in futures, like you're all responding to that. So like there's so many common signals across sets of participants in the market that you're all racing to send orders at the exact same time. And then it's just who's fastest.
Yeah, okay. Well, that was something I was going to ask you about actually, is like what kind of things were you using to drive your trading decisions? Obviously, it's all order book stuff, right?
Mostly order book stuff, but often order book stuff in other products. So, you know, like if you're doing a purely futures strategy, obviously like you're using like microstructure parameters in that product. So you're saying like, hey, like, I can give an example in products I've never traded. That way I'm definitely not leaking information. Like if you're trading nat gas versus crude oil, which I've never traded, so I know anything about it. And you might use not just like the price movement of natural gas to go after crude oil, because that's probably pretty obvious, but you might even use just like book changes in nat gas to go after crude oil. Like if you see a whole bunch of cancels in the book of natural gas, that might make you think that there's about to be a large flow in natural gas, and therefore you think there's going to be a large flow in the correlated product. So typically, like I'm a big believer in parameters which are like book pressure, which I think lots of people will always have book pressure in your local product, but also book pressure and microstructure signals in highly correlated products can be very, very powerful.
Okay. And how far out were you trying to predict? I think you said earlier sometimes it was just a couple seconds.
Could be a couple seconds. I think that often this is like a little bit of like you sort of tune these dials as you actually run the system in production, because it sort of depends on the quality of executions that you're getting. So you might train a model to go after, to be like, the model might be most accurate at 10 seconds. It's going to be less accurate generally the further out you're trying to predict. But because hedging all the time and exiting trades all the time is expensive fees wise, you might have a model that's designed to predict prices or the distribution of prices at the 10-second window, but you might only actually hedge every few minutes. Sometimes that sometimes like that asymmetry is a problem, and you have to sort of adjust the forecast horizon to be closer to the hedging horizon. That's just kind of something that you play with based on the feedback you're getting from the market.
Okay, and these strategies which we're talking about here, I presume that you were using, like, some of the trading decisions were, like you said, driven by order book activity, and also correlated products or related products. The research for these strategies and actually creating them, how much did you rely on machine learning for this?
I would say quite heavily. I think that often, like, I think that the type of trading that I do is I have a preference for sort of simulation-based trading. So, like, if you can build a simulator to at least approximate how the actual exchange you think works with some assumptions, and then you can sort of codify the trades that you would do and play them through the simulator. You can then sort of say, hey, like, if I had done these trades on this day's worth of market data, like, how much money would I have made? And so working backwards from that, like, you're going to have some set of signals which tell you when to enter and exit trades. And your simulator is going to tell you, like, what the performance of that set of signals is on that day's worth of data. To be able to first tell if, like, the idea of a trade is okay, you can get by with just some kind of like if statements and conditional logic and stuff like that. But at some point it actually becomes easier and faster to just grab the things that you think are going to be predictive parameters and put them in a model and then shake it back and forth and see what comes out.
Shake it back and forth. I like it.
Yep.
When you spoke about a simulator there, can you just describe that a little more? Was this a simulator using historical? If it's historical data, I guess it's not really a simulator. So you were creating synthetic, like?
No, it'd be historical data.
Okay.
So, like, you basically record an entire day's worth of data, right? And so you have, like, every single tick that happens on the exchange, and then you can, like, play through that, stepping through message by message, and, like, then take that data and put it in whatever model you have that's going to generate trading signals. And then it'll say, hey, I would have generated a signal on this message at this time. And then you say, okay, like, pretend I sent an order to the exchange to buy 10. And you add, like, a little bit of delay that accounts for how long it would take to get to the exchange, and, like, what are the odds that order would have crossed if the book turned away from you. So you build in all of the different execution assumptions into your simulator to try and accurately run your strategy as if you ran it on that day.
Okay. I mean, that's pretty sophisticated sort of stuff, right? Like, that's, most people at home can't really. It's going to be difficult for them to try and pull that off.
It depends on your time horizon of trading. I mean, there are lots of good tools for this sort of stuff if you're targeting like not just ultra low latency data. You know, like, there's Zipline and some of those, like, Python testing frameworks where you can sort of run strategies against them and see how they would have performed. And I think that I'm a little bit less up to date on what the current state of all those are, but I think that there's probably lots of tooling in this space now.
You wrote an article a little while back, or a series of articles actually on Medium, and they were about position sizing. And I noticed you had an interesting line in one of those, and the line said something along the lines of, if your algo trades 1,000 times a day, or if your trading strategy has 1,000 trades per day. And I just thought that was really interesting because I kind of like this idea, and I guess it kind of goes back to the premise of HFT. It's just taking lots of little small bets.
Yeah.
And instead of being dependent on a couple big bets and hoping that they work out, you just take lots of, sort of spread your bets wide. If you're not a liquidity provider, if you're taking liquidity, how do you find 1,000 signals per day?
So the challenge is definitely real if your set of products you're trading is very small. So you're not going to find 1,000 signals per day to trade a single thing. But if you diversify the set of products you trade, instead of trading one stock, if you trade 500, it's a lot easier for you to find 20 signals per thing as opposed to 1,000 signals in one. I think that signals can be very small if the gain you're going for is minuscule. Like an example is like I think that this is pretty common knowledge now in the press. People call it the 0+ strategy. Have you heard this term?
I have heard it, but refresh my memory.
0+ is basically like the idea that like you are just trying to collect bid ask, and you do so by every time the market turns, you try to join the bid on the newly forming bid or join the offer on a newly forming offer, with the hope that like if you buy the bid, there are people in queue behind you to sell back to if you change your mind. And the strategy is really just designed to always have good queue position and try and make a tick every single time. And this strategy was called 0+. I forget which trading firm it leaked from that called it 0+. But basically, every trading firm I know has run a version of this strategy. And if your definition of signal is basically like joining newly forming price levels, then it's very easy to have thousands of signals per day in a lot of products. I mean, it depends on the product. If it's Fed fund futures, maybe not. But if it's crude oil, then yeah, like the market moves usually multiple thousand price changes per day.
The first thing that comes to mind, and this is, I guess, just my retail mind, is the costs, the trading costs associated with something like that.
Yeah.
What sort of advantage did you guys have, and anyone who's in that professional space have when it comes to transaction costs?
That's tough. To be honest, I don't know that I have great clarity on what the different relative cost advantages are for proprietary players versus retail players. I'll say that like we were very small when we started out at Greenlight, and we were still generally able to negotiate very good fees with everyone. But fees are, for a lot of these strategies, like an extremely important part of the equation. I've run strategies where like almost all of the money made by the strategy was based on like the differential in fees that we paid versus someone else. So definitely there are certain things where it matters a lot. Counterpoint, when I was trading in China, I traded a lot of CSI 500 futures, and they had enormous fees. I think that the round trip fees were either 6 or 8 ticks. So it might just change the set of opportunities that you go after if you don't have the best fee structure. It's not like there's nothing you can do, but it does mean that there's probably certain sets of strategies that you can't do. Something like 0+ or something like that. We're gonna churn like a huge volume, and you need to have the lowest possible fees.
Just while I think of it, you said earlier that you're using FPGA chips. Now, I find that stuff really fascinating. and I know very little about it. How are you using FPGA chips? Like, what sort of things were these doing to assist your trading?
So I think that depended a little bit on the era, but there's probably more than two. There's a few different main things that FPGAs can provide for you. One, on the market data side, you can use FPGAs to really accelerate the market data that's coming into your trading systems. You can do things like, if you're listening to multiple feeds, you could do arbitration across the feeds so that only the fastest message makes it into your trading system, and you're not slowed down by sort of like the redundant copies. You can do fancier stuff where like you potentially only process parts of messages and stuff like that, and then can react to just part of a message. And then I think that on the next level stuff you do with FPGAs is often like, just how do I respond with an order as quickly as possible to a signal? And so if you can program your hardware device to be ready to respond with a pre-ready to go order, as soon as you get the signal, you can just kind of like release your predetermined response. This idea is old, actually. Like the idea of basically like pre-deciding what you're going to do and then just waiting to get the signal to send the order that you already sort of pre-built. It dates back to, I think, 2009. Susquehanna came up with this for options trading. But that idea is sort of spilled into low latency systems in C++ and Java, and then eventually became kind of like what you're really trying to do with an FPGA is just send this thing that you've already decided on as soon as you get the signal.
So it's kind of like embedding your algo in a chip.
Yeah, so I mean, like an example would be like, say there's like a 50 delta option offered for $2, and as soon as the future upticks, you're going to try and buy that option for $2. Like you can pre-build the order to the exchange that has like all of the fields filled out, and you can put that on your FPGA. And then you can tell your FPGA, hey, as soon as you see the futures uptick, send that order. And so instead of like even going into your trading system, which would take, some number of microseconds to process, even if you spend 2 years and lots of developer hours optimizing the thing to be as super fast, like the FPGA, because it's just the dumbest thing possible, is really fast. It's like deterministically fast, right? So like all that FPGA is looking for is like one field on one message, and then it's going to send this order that was already pre-built.
That's really cool.
Yeah, it's really cool. It takes a long time to build.
Yeah. Like how long?
I think that from the moment we started working on hardware to when we got to market was probably 9 months on the first set of strategies. And like, I think that the general development time is probably ×2 if you want to do a strategy in software versus do that strategy in hardware, you're probably doubling the time to market.
Yeah, okay. Wow, so that's a pretty big advantage.
It's a big speed advantage, and if you have the budget and resources to play in the game, it can be a big advantage, but it's usually for very specific things. And there are challenges, like the maintenance of these systems is very difficult because you can't necessarily make incremental changes to the code without redeploying the hardware. So if you want to make some change to the software in something that's running in Frankfurt or Korea, like you potentially have to do a flash of the device, like the same way you'd like flash some hardware device, or worst case, you need to like actually manually swap out the hardware.
Yeah, man, that's really cool. That's really cool. I've never actually spoken to someone who's done this sort of thing. I've spoken to one person in the past who kind of spoke about it because he was aware of it, but no one who was actually has run these sorts of things. So
I think that only in the last like three years have people been willing to talk about this stuff. I think that these used to be very, very closely guarded secrets by the trading firms. I think that the democratization of information has been pretty rapid in the last few years about HFT, to some degree because HFT has been kind of in the spotlight for in a lot of bad ways. But I think that also the nature of the game is changing a little bit to maybe discourage some of these strategies anyway.
Yeah. Okay. So I know we've got to talk about LXDX, and we'll get to that in just a moment. But before we do, you also worked at one other place, which was quite interesting, between Greenlight and what you're doing now. SpaceX. What can you tell me about that? What were you doing there?
Yeah, so it's kind of a weird story. I was a very active trader in China leading up to the crash. And I found myself leaving Shanghai like after really probably the most exciting trading experience of my career. And I spent the next few months coding a new system from scratch in preparation for China reopening its markets. However, three things happened. I met my to-be wife. China didn't reopen their markets. And I was introduced to a brilliant ex-SpaceX engineer who felt I could bring my specific set of skills acquired over a long career to bear at SpaceX and have meaningful impact. And I've always been a space nerd, Expanse fan, truly believe we deserve the stars. And it's one of my life missions to help us get them. And so that's what got me there. And I loved it there. I can't talk like in too much detail about the stuff I did there because of rules. But generally like automation and propulsion stuff. And it's like basically like taking the same sort of machine learning models you'd use to predict the movement of some asset and using them to understand components of the vehicle.
Okay. And this is going to be a really silly question, but did you have anything to do with Elon Musk?
To be honest, not terribly. I saw Elon in passing a few times. Most of the communication that I ever got from Elon was through Twitter. Just reading his public Twitter. That's how you learn things about what Elon is thinking.
Okay. Cool, man. So let's talk about LXDX. How come you've gone from trading and also SpaceX to now starting an exchange?
I think that, first of all, what got us on the path to LXDX was John, Steven, and I were all at Greenlight together. We loved working together, and we liked the idea of doing something else together, and we thought about doing another trading firm, but focused on crypto. I had been watching crypto from the sidelines for a while, and kind of with the growth of Ethereum, it became like no longer just a technology, but like a new asset class. And it was clear that there was going to be opportunities by being active traders in the space. So we started to connect market data or connect to exchanges, record market data, get set up. And we realized that none of the exchanges were built to the standards of the exchanges on which we spent our careers in traditional markets. And so LXDX is an exchange born out of our vision of what the current ecosystem was and still is lacking and what needs to be there for crypto markets to scale.
Okay, and I understand that you're an exchange, but have you been deterred by the price drop over the past kind of 12 months or so?
So we started working on this when Bitcoin was trading 2,000 or 2,500. So, the market is still above when we first thought that this was a good idea and the market needed this. I think that exchanges all have a delta to the performance of the assets. That's undeniable. Like as the market rallies, like like your fees are generally like basis point structured fees. So like you're collecting like larger fees when the market is at higher prices, but it's easier to it's better for the long-term health of an exchange that the market does well. Like volumes might be pretty high for a little while during a recession or a crash, but it sort of then is flat and dead afterwards. So the bear market is not worrisome as long as we see volumes stay healthy, and to a large degree they have.
What you're saying is that you had the idea to start a crypto trading firm similar to Greenlight, but with a focus on crypto. But in order to do that, you couldn't find the things that were necessary or the things which you had access to through traditional markets. So you saw an opportunity there to launch an exchange which had the functionality that sophisticated traders and investors kind of depend on, or maybe even take for granted in traditional markets. What are some of those things which you found were currently lacking on a lot of the crypto exchanges, which most traders or sophisticated traders and those had access to in traditional markets? Like, what's missing?
So I think that there's a few kind of broad areas here. Like, one is technology. Like, the crypto exchanges are basically websites. They're not really exchanges. Like, you just send your orders to a website, and then a few seconds later maybe they get accepted, and then you get some market data. Whereas like your traditional derivatives or cash exchange has their own data center. You could co-locate next to it. You can get market data at low latency. You have reliable connectivity to it. Like, you're not routing orders via the internet to the exchange. And if, like, you can't DDoS the CME, like, the market is always up and always available for trade. And so for me, like, I think it's really important that an exchange is always there. And I think that none of the exchanges could really deliver on that promise. Like, they go down all the time. They are unavailable to receive orders all the time. And so that's a big problem. I think that the products are pretty lacking. Like, if you trade on most exchanges in traditional markets, you've got futures and options and fixed income products and lots of different ways to express opinions. Whereas in crypto, you really just trade cash. And so, LXDX is about bringing both the technology, we do everything out of our own data center, but also products from traditional markets. We do warrants, so you can trade both from the long and short side. And then maybe, like, even the third thing I would say is kind of like ethos. Like, exchanges are run in a professional and transparent way in alignment with local regulations. Generally, like, if you're trading on an exchange in a traditional market, you're not worried about the exchange secretly trading against you, which, like, we've seen massive amounts of in crypto. Or you don't worry about, like, the exchange front running your orders. And so that's kind of like a lot of and I guess maybe the last thing is, like, wash trading, right? Like, wash trading is like fraud and a crime in traditional markets, but is, like, rampant in crypto. And so it's the ethos of, like, bringing what we get in a traditional market to crypto is also, like, one of the things that LXDX is trying to do.
Yeah, and just for anyone who's not sure, wash trading is when you trade against yourself, right?
Yeah, wash trading is when you trade against yourself, and in crypto, it's typically facilitated by the exchange. So the exchange has fake accounts that they use to trade with each other to make it seem like the exchange is more active. They're generally not doing it to manipulate prices, which is why people wash trade usually in traditional markets. Like, in a traditional market, if you have some illiquid small cap stock that doesn't really trade, it's fraud if the thing is worth 5 cents and you and your buddy decide to trade it for $10 while no one is looking, but on the market. But in crypto, it's really about just inflating volumes, not a ton of price manipulation, though there's a little bit of that.
That's crazy. So you're saying that most of the wash trading in crypto on crypto exchanges is done by the actual exchanges themselves?
Done by the actual exchanges themselves. The only guys that will tell you a different story are the decentralized exchanges, because they have actually no incentive really to manipulate their volumes. Small incentive, but not much. But what they have the problem with is that like, team members of, like, really small coins that people have never heard of have an incentive to, like, drive up the price of their coin so that, like, their market cap goes up massively. And so they'll go to a decentralized exchange and the thing might be worth, like 5-10 thousandths of a cent, and they'll like bid up the price and then trade up each other for a penny over and over and over again. They'll even pay the fees, but it's worth it to them to manipulate the price that much. It's like shocking if you come from traditional markets to see, like, all this stuff that, like, you're like, but they would take you away in handcuffs for that in real markets.
And this is something I was a bit curious about, actually, it's something I've wondered, like, when you actually start a new exchange, how do you attract volume? Like, how do you attract market makers, and how do you actually get, because one of the things which incentivizes people, I would have thought, to trade on an exchange is, like, the liquidity that's available. In most cases, that's sort of an advantage or something you prefer is liquidity. When you start a new exchange, obviously you've got no volume. How do you bring volume onto your exchange?
So I think that's, that's the thing that keeps me up at night is thinking about liquidity. Like, how do we, because the true product of an exchange is liquidity. We can have great technology and we can do all these other things, but if I don't deliver to you liquid markets, then I have broken my promise to you as a customer and you should go somewhere else. So to provide that, though, most of the liquidity at the end of the day is coming from market makers. The idea that one retail or buy side investor happens to show up at the same time as someone who wants to sell is pretty low, right? There's almost always you're going to trade with a market maker, and then they're going to trade with a market maker, and then there's going to be some hedging that happens. So it's really about attracting market makers to the platform, and thankfully that's something that we know very well as we've spent our whole careers as market makers in markets all over the place. And so some of that is just kind of the network effect of knowing a lot of who to harass and bug and call in favors to come do this. And the other is that I think that we actually, our promise really is to develop a platform for market makers to be optimally successful. We built all this technology so that they can more easily move their quotes around, send lots of messages, accomplish the things they want to accomplish. And so I think that if you're a market maker and you see a platform like ours, as long as you believe that we're going to try and bring flow to the platform, it's not crazy to show up early and say, hey, they might not have any volume for a little while, but I want to be there for when they do. And I value the potential here. And so it's kind of just about aligning kind of in the same way that you have to attract talent to a startup to get them to believe in the vision, you have to attract market makers who believe in the vision that this is going to be a successful platform.
Yeah, I guess it's one of those things which ultimately it just takes time.
Correct. And, I think that when I log into a new crypto exchange, which there's a lot of, right? And if they have, the thing I care about is not so much what their daily volume is. I look at that number, but what I really care about is what does top of book liquidity look like? Because if top of book liquidity looks pretty good, then I think to myself, this is a place where I could sometimes trade. But if top of book liquidity is horrible, even if they have okay volume, I still know that you probably can't really do the things you're going to want to do on that platform. And so priority one to me is really making sure that the markets are tight and liquid. Volumes, I think, kind of follow thereafter. If you can deliver on tight liquid markets, people will come use the platform.
Yeah, and you said it right there that there seems to be quite a few crypto exchanges popping up. What do you make of that? How do you feel about that?
I think that there's obviously way too many exchanges. I think that that people have seen the success of Binance and BitMEX and some of the other large exchanges, and they think that that's easy to duplicate. And I think that regulation on exchanges has been very dovish. So, if you want to start a new equity options exchange in the US, that's hard. It takes lots of licenses, and you got to get everyone their Series 57s, even that just writes code for the thing. Whereas in crypto, it's much easier to just start an exchange and try and attract customers. So I think barrier to entry is low. And I think that the potential upside is high. So it's not surprising to me that lots of people are trying to be in the exchange space.
And where are you guys placed with regulation? Is that something are you going to be a regulated exchange, or how does that work?
So we're going to be a regulated exchange in Malta. We chose Malta because they were the first to act in terms of providing a set of guidelines for how to be regulated. We're like Malta a lot. We think that there's lots of other exchanges. A lot of the biggest exchanges, Kraken, Huobi, OKX, Binance, are all sort of moving their operations to Malta. People are calling it Blockchain Island. And I think they've created like a sandbox to sort of to be kind of like creative and try things out with how the rules should work for these assets.
It seems like a lot of what you're building there is so that sophisticated traders have a reliable exchange and have access to the functionality and the things that they depend on. When you actually launch, what type of customers or participants, I guess is probably a better word, do you think you're going to attract? Obviously a lot of the professional, but do you think you'll also cater to many retail traders as well?
So I think that we think about it like the following way, that we design the technology so that sell side guys would be able to provide liquidity successfully. And as a promise to that, we are going to make sure that the products and marketing bring retail flow to the platform, and then that joint liquidity is what's going to facilitate institutional flow. And so accordingly, like the goal is that LXDX is a great platform for retail to trade on. Retail might not need ultra low latency speed. It might not need all of the bells and whistles, but it will benefit from their existence because there will be better pricing and better liquidity on the platform. I think that the products that we offer, like we're going to have, like I said, our focus is derivatives, and initially it's warrants. So you can trade a call and put on Bitcoin, you can trade a call and put on Ether, and you can trade a call and put on Ripple. And these let you have, you can both participate sort of from the long or short side accordingly. And they also provide a decent amount of leverage. So if you have a specific view that Ether is going to move in the next 5, 10, 15 minutes, like it's expensive to pay $150 per Ether when you could pay, a very small fraction of that to trade the option. And, like as opposed to seeing a 1% move in the underlying, you might see a 25 or 50% move in the warrant. So I think that like the selling point to retail is leveraged exposure, ability to participate from both the long and short side. The fact that we're the only place in the world to trade these products. And eventually, as we move sort of into phase 2, we're going to have smart routing on the exchange. So, like the idea is that you'll come to us for superior liquidity and for products you can't trade anywhere else. And smart routing will enable you to trade on other exchanges through our systems. So we can execute for you on other platforms. And so then it's kind of like you can trade exclusive stuff at LXDX, and anything that we decide to not trade, we can still facilitate for you. That's kind of the vision. Is we want to be a place where all of the various parties get something out of trading on this platform, because I personally don't really believe in institutional only platforms.
Cool. And what about launch date? Like, you're not trading yet. Do you have a launch date in mind?
I've been prohibited from saying the exact launch date, but it is the middle of December. We are doing private testing now for market makers. So we have like a cert environment where you can test out the APIs, both the web APIs and the fixed Colo APIs.
Okay. So either way, it's not far away.
Not far away.
Yeah, cool. And like you said right at the very beginning, you're doing some sort of security token. I know nothing about those. How does that work?
Sure. So security tokens are they're securities first and tokens second. There's been lots of ICOs, token offerings, where basically a company sells you tokens, and it's kind of like selling you airline miles before you build the planes. Like you have there's a use of the product without like the product existing. Security tokens are pretty grounded in real, like pre-existing regulatory frameworks. So each token, each LXDX token maps back to a share in LXDX. And so if you have a token, you have a share, and there's like an actual, offering document which says this share maps to this token. The other thing that we're doing with the tokens is basically the token holders are entitled to a revenue share of the exchange. And so basically it's a way for us to create an investment product for investors that believe in our vision to own a share of LXDX, a meaningful share of LXDX, and know that there's like a fully compliant backing for this investment, that we can't change the rules on you, that there's a piece of paper somewhere saying that this is the way this thing works, and that there's, like EU law protects the investment.
Now, is it necessary to have one of these tokens to be able to trade on your exchange?
No, and I think that a lot of people have asked, well, does owning the tokens give me discounted fees or any special privileges? And the answer is no. We obviously could have done it that way, but we think like the set of people that see this as a great investment might not be the set of people that are interested in actively trading crypto, and forcing those to be the same set of people might not be reasonable. Like there's people that would view this as, I have a model, I can predict what I think the exchange's revenues would be, and therefore I want to do this thing because my opinion of the discounted cash flows that these dividends are going to generate is X. Those people might not actually be that interested in trading cryptocurrencies. They might just be interested in basically a coupon paying instrument.
So what's the incentive for you to offer a token?
As opposed to just doing a standard equity raise?
So that's the purpose of it, is it? To raise, it's purely just a different sort of way of raising capital?
Yeah, I think that's just an alternative way of raising capital. So, the options in the crypto space for most people are traditional equity financing, where you go to VCs and private investors and you do private financings. You do Series A or Series B, whatever. Or you go to the fully other extreme, which is you do an ICO, which is fully unregulated, and you just ask for money and then hope that the SEC doesn't take you away in handcuffs. Or you do the thing which is the compliant version of a token offering, which is that you say that the tokens actually do map back to shares, that they actually are full securities and governed by securities law, but they still have the ability to be liquidly traded. And so, if you invest in the token as an investor, if you invest in the token, you know that this thing is going to have liquidity on secondary markets. So you're going to be able to get out of your investment at some point, and there's probably some premium for that liquidity. As an issuer of doing the fundraising, as someone who's trying to raise funds, I see it as, I obviously am going to want to buy these tokens back. Because anytime you sell either traditional equity or any share of your company, you always want to get that back, right? In some way you could. You do a share buyback, you go back to your investors and you offer to buy them out. Like you always want to take back your company that you had to sell pieces of to raise money to do your company. And so tokens as the person issuing them is actually also attractive because their liquidity makes them easier to buy back. So that's kind of the way I see the STO space.
Okay, and you're not the first to do this, are you?
We're not the first. It's actually very, very hard to track, like, who's the first and who's the whatever, because it's like unclear, like, does announcing that you're going to do it mean that you're doing it? So I don't know. I think we're definitely going to be one of the first companies that have done a security token offering in Europe. But we won't be the first.
Yeah, okay. So what other, like besides exchanges, has there been any other technologies or projects, I'm not sure what the right terminology here is, but other companies maybe which have offered a token in this way?
I mean, I think that to me, this is clearly the future. Like I see us kind of rapidly snowballing towards a future where there's millions of these tokens available for trade. Like you'll log into your IB or TD Ameritrade account, and instead of there being a few thousand equities, there's going to be millions of tokens. And those tokens are going to be companies like doing the equivalent of equity fundraising, but there's also going to be, like bonds, real estate, art collections, royalty rights, IP, and then funds that aggregate all of those various things and slice them up in all kinds of ways. So, I mean, that's that's the future that excites, us for LXDX. And the other reason why the technology has been built the way it is we want to be able to have hundreds of thousands of things available for trade on the exchange at some point. So I think that lots of stuff is going to be tokenized for the benefit of increased liquidity and increased transparency, and perhaps increased efficiency too. So I think that this is the very, very beginning of this process.
Yeah, cool. All right, man. Well, I wish you all the best. If someone wants to find out a bit more about yourself, are you on Twitter?
I am on Twitter. LXDX is on Twitter. I'm on Twitter, but I'm not super active. Probably the best way to find out more about me is to ping me on LinkedIn. And the best way to learn about LXDX is to check out the website or the Telegram.
Okay, and the website is?
LXDX.co.
Well, that's easy. And do you want to just share your Twitter handle anyway? I know a lot of Chat with Traders listeners are pretty active on Twitter, so.
I believe our Twitter is @LXDX.
Okay, and your personal one?
It is 0x Joshua.
Okay, well, I'll put all that in the show notes as per usual. Josh, thanks a lot for doing this, man. I really appreciate it.
Yeah, it's been fun. It's been great. I appreciate you having me on.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders. Loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Hey there, what's going on, everyone? Welcome to episode 172. I hope you're doing good. Just before I introduce my guest of this episode, I'd like to share something with you. So, the other month, I hosted a live podcast event in Sydney with Mike Balafiore from S&B Capital and two highly accomplished equities traders, Austin Mitchum and Bryce Edwards. So the event was filmed and the video has now been released. You can go ahead and watch that on the S&B YouTube channel. You'll find it there. Though, as you will hear, we had some audio issues. The sound quality is quite poor, which is quite disappointing because there was a lot of great information shared that night. However, for anyone who would prefer to get the information and not have to deal with poor sound quality, here's what I've done for you. I've taken the full audio of our conversation and I've turned it into a neatly formatted PDF document. It's available right now as an easy-to-read ebook. It was quite a bit of effort to create this, and I think you'll get a lot of value from it. So I've put it on the website for $10. To find out more and to get a copy for yourself, go to chatwithtraders.com/transcript. Okay, that link once more, chatwithtraders.com/transcript. Okay, now with that being said, it's time to introduce my guest and also a really good friend of mine, Anthony Riley. Anthony is a proprietary futures trader from Sydney with 10 years market experience. He's active, particularly during the nighttime, in a range of products such as Australian and US bonds, equity indices, currencies, and even a few commodities. While he's a click trader, Anthony is quite systematic with his processes and strategies, which are mostly trading spreads between correlated products. Naturally, we speak about many things during this episode, but I think one of the highlights was hearing about how Anthony got himself into a six-figure drawdown and was able to claw it back in just 1 month. We spent quite a bit of time breaking it down. Also, I'm not sure if it matters, but I'll point out this episode was recorded in December, just before Christmas, and we did this episode in person too, so there is a video. If you'd prefer to watch rather than just listen, make your way over to the Chat with Traders YouTube channel, and again, you'll find that video there. On with the show now, here is Anthony Riley. All right, so the cameras are rolling? Okay, great.
Sorry.
Where do you want to start out? How's your week been in trading? Let's start there.
Yeah, the week's been interesting. We had the rolls this week in the Aussie bonds. So
do you trade the rolls? Do you get involved in that?
No, not the roll itself. Most of my strategies in the bonds, I only run a couple of trades. Like I don't run a lot of the stuff I trade because sometimes it can be not ideal conditions. Sometimes the roll can be quite one way, so you end up getting caught in these trades and stuff. So just the testing that I did in the past and past experience is just, it's not really great. So I almost take a step back and have a bit of a quieter week. I used to take a holiday in rolls, but I do some other trades now that are running all the time. So
yeah, okay. Have you traded rolls in the past? Like, is it something you used to trade like quite a bit and now you stay out of it, or you just never really? Wasn't never really your thing?
Nah, never really was. It's quite interesting because obviously I do a lot with the Aussie 10-year bond, and since that's gone to the quarter ticks now, that's ideal for how I trade. It is better, but just the flow's a little bit different.
The quarter ticks, it's only quarter ticks during the rolls, isn't it?
Yeah, it is, yeah.
Okay. Yeah, cool. And how about like the volatility in the US kind of equities and that? Has that had any sort of flow-on effect to what you were trading?
It has, yeah, because I trade some equity index futures spreads.
Ah, that's right. Yeah.
So it has definitely had an impact with them. The trade frequency has certainly gone up, and I've found a lot of trades you're kind of, you'll be fading it because a lot of it's a mean reversion style trading, and things will be disjointed a bit more. So there's actually more fat in the trades which is good. But at the same time too, sometimes you got to modify or adjust your risk on the trades with obviously the expansion and the volatility and stuff like that.
Right. And is there also, you said there's more fat. Is there also more risk too?
Yeah, to an extent, yeah. What I found though is that the amount of fat actually on the trades, like, if you were going for like a 1-to-1 risk reward on the trade sort of a thing in the past, you're probably getting like a 4 to 1.5 sort of, if that kind of makes sense. So you're definitely getting a lot more on the upside and you're taking on a little bit more risk on the downside.
Yeah. Yeah. And are you going to continue trading? Like, obviously we're coming into Christmas and that sort of thing. This episode will probably go out after Christmas, but, how do you change your trading during that time? Does it have any effect at all?
Not generally, no. I mean, I'll have off the main days over like the Christmas and New Year period, but I actually found over the last couple of years that you can get some quite good moves, especially with the mean reversion style trading. As long as you're not trying to stand too close to the mean of the market, you can actually get some quite decent moves, because everyone kind of has the idea that they want to just get what orders they need to do. And, sometimes you have bigger players in the market that will just come in and just be like, all right, I need this done now. They'll just do it. And that presents then good opportunities.
Yeah. For you to jump on their coattails.
Yeah, absolutely. Exactly.
Okay. Well, maybe we should actually talk a bit about how you actually trade, what markets you're involved in, and that sort of thing. So maybe we'll start there. Like, what products do you trade?
So I'm primarily in the Aussie 3 and 10 year bonds, as well as the US 10, Ultra 10, and the 30 year. And then I do a bit in the SPY ASX 200 futures, the E-mini S&P 500, and then some of the Asian equities as well, Asian equity indexes. That's primarily, but then I run sort of like a different sort of strategies on the FX futures, which I trade similar to a, like I guess what retail traders would trade spot. I just execute the trade to the futures. So it requires a little bit more messing around. And then I use the same sort of style trades on crude and gold and things like that too. But that's basically the broad gist of it. So I guess it's across a lot, but.
Yeah. Would you say that the majority of your trading is done in a select few of those products?
Yeah, definitely. The majority of the size that I would use is definitely in the fixed income side of things.
Okay. And, you described quite a few different products there. Are you trading those kind of individually, or are you trading, I know you trade the SPY, so essentially like the ASX 200,
yep.
the share price index, versus the E-mini? So are you trading a lot of those things you mentioned there as kind of spreads against each other?
Yeah. A lot of them are spreads against each other, but then sometimes you have outright views on them and things like that. So that can play into how you actually trade the spread.
Okay. So will you sometimes just take a purely outright position?
Very rarely. Very rarely it'll be a straight outright position. It might be a differently sort of weighted position. Say for example, if you're using like let's just say a 1-to-1 ratio on a spread trade, maybe sometimes you might do like a 4-to-3 or that sort of a thing, or a 3-to-2 sort of a thing.
Okay. Yeah.
So depending on your outright view, you might see, a certain market rallying, and then you might think, okay, this has probably still got legs to continue on, or there's more risk at the moment. If it sort of keeps going, you'll kind of change the weighting of the two products.
Can you talk a little bit about how you would actually trade the spread? Let's say the SPY. So when I say the SPY, I'm talking about the share price index, the Australian futures index, not SPY, the ETF. So if you're trading SPY against, is it the E-mini contract you trade against?
Yeah, I mean, sometimes it's the mini. I mean, you can, like, I've also done it like against, the DAX and the Nikkei and things like that, because obviously there's the broad idea that these particular things, like, obviously they don't always move the same, but there's a tendency for equity markets to be correlated across the world.
So what sort of things would you look for? Like what would drive a trading decision to trade that spread?
Basically, a lot of it's done in the testing. So I'm pretty massive on the testing side of things, and I've found that the best sort of trades, I guess, that suit me are ones which I have an edge that I, seen on paper. I'm like, okay, there's definitely opportunity here for me to, I guess, be able to get something out of the market, and then that will kind of be translated, I guess, into the trade. So for example, with SPY Mini and with, SPY against Nikkei and FTSE and DAX and all these sort of things, you're generally looking for certain standard deviations away from a mean. So when you're testing or originally come up with the idea, you generally go back and test, you'll find a mean first, which can be anything really, I guess. And then you work standard deviations back, and then I guess then you work out how much of that you actually want to take, whether you want to fade it back to the mean or you sort of just take a small profit. Or when you talk about testing these types of ideas, now you're, for the most part, I'd say you're probably a discretionary trader. Is that fairly accurate? I'd like to actually think of it more now as it's like I have systematic processes. So even though it's all executed, a lot of it's executed manually, it's all systematic processes, but with the discretionary edge of sizing and times of when to actually execute the trades.
Okay. So with that sort of thing, you can actually go back, and it's I don't know if easy is maybe the wrong word, but you can actually go back and test it because there are rules to how you trade.
Yeah. You can definitely go back and say, I would have taken that trade, as opposed to it being like looks like something I would have done. And then you kind of build a strategy on like what ifs rather than actual hard sort of facts.
Mm-hmm. So how would you decide how much size you're going to trade each side of the spread? So before you were saying you might trade, 3 contracts of the SPY and there may be 4 of the E-mini. Like how would you sort of think about?
So generally what I'll do is I'll get data. So either daily, hourly, or whichever sort of time frame you're looking at. So in my case, I mainly do hour, 30-minute, and then I'll get like 1 minute or 5 minute data and just chuck it in Excel. And then you do sort of, slope. So you work out you do regression on it to see the relationship of one to the other. And that will basically be your standard beta. So obviously that does relate to the relationship between one and the other. And then that will generally give you the chart. So then I've got spreadsheets and stuff that I look at too, where you can work out 1%. So for example, we'll use SPY and Mini, for example. You work out 1% move in that, then 1% move in that, then work out the dollar value of each. And then, if one's 10,000 and one's 5,000, then that would be 2 to 1 sort of a ratio, or 1 to 2, sorry. So that the same move is the same in each, given that the relationship that you think they share is that.
And what about your trading in the Aussie 3-year and 10-year bonds? What sort of things are you doing there? Are you trading the 3s against the 10s or?
Yeah, generally curve related stuff. Yeah. So most of the trades around that still center around mean reversion. Though I trade it a little bit differently because the behavior of it can be a bit different, especially now that 3 years have gone from full ticks to half ticks. I felt that, in the past you could kind of get in and out for, a tick, and it was, I guess, efficient on the brokerage side of things to be doing that because there was a lot of fat in the 3 years for a point. But now I think you kind of have to go for a bit more moves. So the way I've traded that has definitely changed over time, but I think it does share the same trade sort of style as what I do across the other products.
Okay. So how has your trading changed from the drop to half ticks? Because I know a lot of ASX traders were upset over that when it came into play. When was that?
would have been
Probably about 6 months ago.
I think it was
12.
this time last year, actually.
12 months.
Yeah, I think it was.
Yeah. Yeah.
Yeah, it would
Must
have been
close.
Yeah.
So how have you had to change your trading to sort of still make that a worthwhile product for you to trade?
So I think for me, generally what I've been able to do is because a lot of my trades are actually more suited to holding positions a little bit longer and getting a bit more fat. So it's actually bettered my trading on those particular products because the cost of like the slippage, I guess, in a way is now less.
Mm-hmm.
Because, for example, before, like you might have been getting in the 3 years and then the market starts to move and you get filled on the 10 years and then you have to go to market in the threes. And now that point now is halved. So there's almost more on that sort of side of the trade in a way. But I guess overall, I probably trade a little bit less now, but I'm a bit more specific and a bit more, I feel there's better risk reward on the trades now than what there was before.
Yeah. I mean, that thing you mentioned where the slippage is certainly a lot less, that's definitely got to be helpful. If you've got to stop out on a trade, you can stop out on half a tick instead of a full tick.
Yeah. Which has its disadvantage too when you are, front of the queue on it and you could have easily got a full point.
Right.
Now you only get a half tick. So, but I think how I sort of try to look at it is like longer term, you want to be making your money off ideas that you can replicate day in, day out, not necessarily off the queue of it. I mean, it adds to it, it's always good to get, but I wouldn't want it to be my sort of bread and butter as a trader.
Now, you haven't always traded these products, I presume, because you weren't always a prop trader. I don't actually know too much, I know you fairly well, but I don't actually know too much about how you actually got into trading. So this is going to be interesting because I'm going to be learning something as well. I know you started in trading around about 2008. Was that right?
Yeah, that is very
true. So where did you start out? Like, how did you, get involved?
Yeah, so back then I was kind of always interested in making money, as most people are. It brings us to trading. And during that sort of a period, I started looking at Aussie stocks and things like that, and I was sort of dabbling in them. And then 2008 came along and I was at uni at the time and I thought, okay, I'm going to go do some traveling. So I went and traveled after I traded some stocks and I randomly met someone who was a trader. I think it was for Credit Suisse. And it was like somewhere in Europe. And I remember it would have been probably around August or September while everything was starting to kick off. And I remember he was like sitting next to me in a hostel looking at like charts on the screen. And I was like, oh yeah, this is like stocks and stuff again. This stuff's cool. So anyway, I ended up coming back to Australia, and during that time, the accounting company that I was like working with as like a cadetship made me redundant. So I was like, all right, okay, what do we do now? And I was like, maybe I should do this stock stuff and give this a go. Why not? It's a good opportunity. And it actually turned out that a friend of mine from school was actually doing some trading. And this was all in, it was like momentum trading with like the E-mini and gold and USD and those sort of things. And he was kind of going to some seminars and learning and doing all that sort of a thing. And I was like, yeah, I'll come along. Why not? So that was really where I started to first, I guess, get more involved with it. From there, we ended up going halves in the trading account, which was always an interesting thing to do. So we put 3K in each. And I can't remember how long it took. It took a while. Like, I mean, we didn't blow it all. I mean, but we ended up taking out, I think it was like 2,600 to like $1,300 each.
Okay.
And then we kind of like walked away and we were like, all right, what do we do here? And I kept trading because the strategy was actually primarily suited to trading at night. So even back then I was still trading through the night, which was interesting. And so I ended up continue on trading and working with him because he didn't fully ditch the idea. And so we ended up modifying what we'd learned, and we kind of like, I guess, broke that strategy apart and sort of rebuilt it back. And that was when I think things started to get a little bit better. I mean, well, this was probably like 2009, 2010 that this was happening. And then, 2011 was when it started to get somewhat consistent.
Okay. Can I just jump in there?
Yeah.
So you said you got made redundant. What year was that?
2008. Would have been right at the end of 2008 when I got back from Europe.
Okay. So did you go get another job somewhere else?
So that was kind of like it was sort of like a full-time job, but it was like a cadetship. So like I would do full-time uni, work at night, and then the second semester I'd work full-time and do uni at night. But after that, it was like I actually had a part-time job at Tui's at the brewery out of Lidcombe, but then that was a which worked well because that's open 24 hours, so I could work it around my schedule.
Okay. So you just had a part-time job to keep some money coming in the doors.
Yeah, exactly. Like I was still living at home at the time and stuff back then, so it kind of fitted everything. It worked around my uni schedule, worked around trading, and it was actually some pretty good money for like it was like what, mid-30s an hour working in like a warehouse. So back then it was good because you could work less and yeah.
And did you have the goal this whole time, during those few years that you would become a full-time trader, that eventually you'd be able to make enough money from trading that you could give your job the flick, or this part-time job the flick?
Yeah, definitely. It was. I think I was a little bit naive in how I went about a lot of it. I think at the beginning, the work I was putting in wasn't the right work. And I think that's something I've learned a lot over the years, is that just because you're putting in, 6 hours a day, it doesn't mean it's a good 6 hours of work. Sometimes it could be on totally the wrong stuff. And I think I spent too much time working on the actual strategy. And every time it would have a couple of losses, I'd be like retesting it and re-optimizing it and all this. And I'd lose sort of sight of the big picture in a way. And I wasn't working as much on the mindset and on myself as probably as much as what I should have.
Okay. So if you, how do I want to ask this question? If you were to, what were some of the mistakes that I know you kind of outlined some of them just there, but for anyone else who might be starting out, might be very kind of new to this, maybe some of the things they're thinking at the moment are a little bit naive, and maybe they don't actually realize that.
Well, I think one thing that I probably did at the beginning, I guess, is I was probably using too larger of a percentage of my trading account per trade as risk. That was one thing, because that obviously caused the drawdown as big as it did. Because if you think about it, like, even if you are very active, it will take you a little bit of time to get through 50% of an account if you risk, 1 or 2% per trade or something like that. That was probably one of the things. But I think the other thing too was that I wasn't always willing to be wrong, which was something that took me a while to kind of get over, I guess. I was always seeking and searching for like the perfect strategy, the perfect system, and that's just a battle you're never going to win. Rather than just finding something that's good and then working with it. And I think I probably tried to eliminate too many what I saw as errors or like problems with a strategy, when it was really just that was part of the reason where it would work in a way, if that makes sense. Like I was trying to eliminate one of the variables that actually caused a strategy to be profitable, but that's what also caused it to lose money.
Yeah. Okay. Can you share what maybe that variable was? Like, do you remember?
So it was more along the lines of like the management of the trade. So I would try to run stops too close when it got into profit, but by having the trades back then that I was doing was like momentum sort of breakout sort of strategies. And then when it would hit a certain amount of, ticks in profit, you would sort of try your stop. And sometimes I would be very keen just to like get the trading in, like don't want to lose money. And you would end up getting taken out on the first pullback and it would just trend all night.
Right. Okay. Yeah. I get you. That makes sense. And I mean, it's been interesting, like doing a bit of algorithmic trading and testing that sort of thing. You can certainly see how putting stops and sort of the impact of stops affects your P&L. It's very interesting to test that kind of thing.
Yeah, it is. It is.
It can make an absolutely huge difference. And, you know, stops in the wrong places can cause you to have a lot more losing trades and effectively kill a strategy.
Yeah, and the interesting part is the premise and the idea behind the strategy can actually be right. It's just amazing how much, you know, smart stop placement, as a lot of people call it, can alter that end outcome.
Yeah. Yeah.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with 0 locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
So I cut you off before, but you had kind of walked us through your journey up to about 2011.
Yeah.
Where were you at that point in time, and when did you start to get into prop trading?
So, yeah, throughout 2011 was really like the last year I was working sort of part-time with TUIs. I ended up just sort of giving that away after I went and did some traveling over in the States, and I came back and was like, oh, I gotta really focus more, because I was never getting the traction that I wanted to. It was like, yeah, like moving along, but it wasn't helping me take it to the next level. So it would have been like mid 2012. I was in the city one night, and I was on George Street at the Macca's, and there was 2 guys in front of me, and this is how I found out about prop trading. And they had these jumpers on, these hoodies, and there's like a little chart sort of thing on the back of them, and I'm like standing behind them in line. I'm like, what's this about here? Like, and I was like Googling it on my phone, and I was like, oh wow, these guys are traders. Like, what's this all about? And that was really, I was like, oh wow, these places exist. And I remember going home and I did a lot of research and stuff like that, but I was a bit hesitant to pull the trigger and go and actually like pursue it. And it was interesting because I had a number of people who were like, oh man, I want to get into trading. And I was like, go apply at these prop firms, man. They seem pretty good, but I didn't do it myself. So it was like, took me to probably like took me a good like maybe 4-6 months until I actually.
So how come? Like, what was holding you back?
I kind of thought I knew it all.
Okay.
At the time, I think. I kind of thought, oh, what could they do for me? But then I think I had a chat with some good friends, and they were like, man, maybe this is going to be a good opportunity. You know, like go in as a trainee, see what they've got to offer. I mean, it can only build on what you know. And, you know, it was probably like when I first sort of applied and went through the online sim processes and all that. I can't even remember how I did, but I remember when I went for the actual interview, it was probably the most relaxed I went into an interview.
How come? Because you thought you knew it all?
I did. And then within the first period of starting there, I just realized how much I actually knew, which was nothing at all. So it was complete opposite. Like, it kind of really humbled me a lot when I found out later about the guys who I'd interviewed and like their background and a bit of their story. I was like, oh, geez. Like,
so what were some of the things that made you realize you didn't know as much as you thought you did? Like, what's some of the realizations or the misconceptions you had going into, starting at a prop firm? Some of the things you realized which you thought were true in the past, maybe weren't as true as you thought they were.
I guess for me, it was more the scalability side of trading. I've always believed you could scale it, and I think a lot of people think that it's just add another zero, and like to an extent it is, but at the same time too, people don't realize that depending on the market you trade, there's like liquidity issues and there's things around this which can't just, like, sometimes you actually need to change the way you execute a trade, which then can impact how you manage and stop out of a trade and where you take profit, or from the liquidity side of things. Mm-hmm. So like even in like the SPY, for example, I mean, you can't just trade it with like 200 lots because, day or night, like you're going to get taken out over a couple of prices. So that was really one of the things. And I guess a lot of it around probably the biggest thing for me, and this is where a lot of the mental journey sort of started, was that I just sort of realized how important the mindset was to it. And I think my mindset was, there was like confidence and self-belief, but it was from more of like an arrogance side of it, rather than like, I'm doing the work. I've, seen some results, and, I'm going to, I guess, push on and do it. So it was a bit more maybe of an ego-driven sort of a thing beforehand as to where it was when I started at the prop firm.
Yeah. What about the strategy side of it? Like, you kind of said you were trading these like breakout momentum types of strategies. I know obviously in the prop world, they trade a whole lot of other strategies. I'm sure many which at the time you had no idea even existed. When you started trading here, were you trading different sorts of strategies? Like, you didn't come in with trading the same way that you had done, as a retail guy? I
attempted it and it didn't go too great because obviously bonds move a lot slower than what I was used to. And it probably took me a couple of weeks, maybe even a month and probably about six to 8 weeks, I think it was in the beginning, of me just still trying to do what I was doing. Like I went through the training, I learned all their stuff, but I was like, this like spreading stuff and these markets move slower. I was like, man, I want to trade stuff that's moving, stuff that's active. And it kind of got to a point where I wasn't making money. And I had a chat with the mentor at the time, and he was sort of like, man, you got to like up your game. And that was really when I was like, all right, let's give this spread trading stuff like a crack. And then, it kind of went from there. Like, my results changed significantly, because I just found that it kind of clicked when I started to actually test it. I was like, hold up, I actually see what's going on here. Like, I see how there's potential in this strategy. It was quite different than what I was used to. I mean, I was trading breakouts, and the next minute I'm like getting things that move not a lot, and I'm trying to fade them. So, and your risk reward on spread sort of trading isn't what people would see as being great. Sometimes you're sort of risking 10 ticks to make like 1 or 2. It's a lot like the insurance policy kind of a game.
Yeah. I want to go back to something you said a little earlier. You spoke about, I was putting in a bit of work earlier on. Like, sometimes I'd sit down for like 6 hours and I'd be working on my trading. But now you kind of realize that those 6 hours that you were putting in work, you weren't really spending most. It wasn't really an efficient use of time. How would you say, like, what sort of things were you focused on then, which you probably should have been focusing on more? Like maybe you were focusing on some of the wrong things. I'm not sure.
Yeah, so I was always focusing a lot on getting the best entries, and making sure that, the entries was the main thing that I do remember. And I remember going back and back testing like all these entries and, whether they hit the targets that I had or not, instead of kind of looking at the bigger picture of the trade. I think, like, for example, now if I was to go back and do it, I'd probably be putting a lot more emphasis on, what does that move actually do? Like, I guess the next few hours of the move, as opposed to me getting in and out in like 15 minutes. So I think my thinking was very micro in the scheme of things, and I was focusing too much on things that, to me, I think were well, at the time they were obviously very important, but I guess were a bit less important overall, if that sort of...
Yeah, that makes sense. And what would you say, how would you say that you're testing? Like, I heard you say Excel before. Is that how you're doing most of your testing?
Now or back then?
Yeah, let's talk about now. It's probably more relevant.
Yeah,
like
yeah.
How are you actually testing your ideas? Because you don't do any coding or programming.
No, I don't. It's something that's on the to-do list next year. But most of my stuff is done through Excel. I'm probably a bit old school in the way where a lot of my initial ideas come from me visually seeing the chart and just watching the ladders in the market, and you pick up nuances and characteristics. And I've got some spreadsheets where I will note down like certain things I've seen or patterns or things like that happening in the market. And then that ends up being like, I guess, a foundation of what I look for when I'm looking to add new things to my strategy or change things and stuff like that. So generally then I'll get those ideas and then I'll run back over the charts visually and look at it and see if I feel there's any sort of substance to it, I guess. And then from there I will go and collect the data, and that's generally all done in Excel, where I'll get all the trade data and manipulate it and do all like, the Monte Carlo and all these sort of things and chop and change it around, forward testing, back testing, all that sort of a thing on it to just see how viable it is.
Okay. That's interesting to hear you say, and I think this is maybe something that someone listening to this should sort of take note of. And what you said there is that a lot of the ideas and things you're testing come from your actual observations in the market. I understood that correctly?
Yep.
Yeah. Okay. I think this might be a good point to get into talking about sort of the hole you clawed yourself out of just recently.
Yep.
I think this is going to be like sort of the meat of this interview. I think it's going to be very interesting to hear about. Do you want to just kind of explain what happened? Like, how long have you been trading for now? Almost 10 years, right?
Yeah.
How long in prop?
5.5 in prop, just over 5.5 in prop.
Okay. So recently you've, come out of a fairly significant drawdown, fairly significant for you.
Yep.
When did things start going wrong, or did things start going wrong? Because obviously you can lose money without doing anything wrong per se. When did sort of things start to turn south?
So it was the August, September sort of a period, was the first sort of 6-figure drawdown that I've had. I've had other drawdowns which I've battled back from before, but this was a little bit larger. And just interesting thing was a lot of it was driven by, so I'm always trying to scale trades up and slowly push them up and things like that. And I got to a point where all the trades were decently sized, and it was a period of probably 6 weeks where every trade had like a drawdown together. So on paper, it looked like a big amount. You're like, oh, geez, like what's going on here. But breaking them down, none of the strategies were really at their, what do I like to call it? I guess it's kind of like a critical point in a way. So like in the testing, you're like, okay, the average drawdown is, 3 stops on a trade, and they were maybe down 1 to 1.5 stops on a trade, but just the dollar value had increased probably quicker than what I guess had grew myself maybe.
This is the tricky part with scaling up, isn't it? Because you build your account up, you build it up on, trading smaller size than what you're about to trade when you scale up. So as soon as you start scaling up, it sort of reverses those profits a lot quicker if you start going into a drawdown, or if you start, losing a few trades. You erode a lot of the profits that you've built up trading smaller size. As soon as you start clipping up,
you naturally have that drawdown from when you've just increased your size so much, because obviously it's a thing where after you've done good, you want to kind of reward yourself for the next time you do good. But everything's in waves, and like you're generally upping your size at the top of the wave.
Yeah. So I don't know if you're comfortable talking about actual numbers, but how long did it take you to get to sort of the lowest point of the drawdown?
It was probably about 5 weeks.
Okay. So you'd say you lost 6 figures in about a 5-week period?
Yeah, it would have been, yeah. Yeah, definitely would have been. Yeah.
Okay. And what did you do at that point? Like, was there a point where you're like, I just need to get out of all these trades?
Not really. In a way, it was more... So I generally would always trade from the office. And it's something that I've done through the whole time I've been at Prop. But for the first time in a while, I was sort of like, okay, I need a break, but I need to trade still. And I was like, all right, I'm going to go and trade from home. And I remember there was a couple of nights in here where I had a lot of trades on and everything was like going against me. And I was like, oh, geez, like this is pretty full on, but like got to keep my composure and keep executing. But it would just be like, it wasn't even like 1 or 2 just big down days. It was like slow bleeding consistently. So it like really can take its toll after a while. But I guess for me, the thing really that kept me sort of going and made me not change it was that these particular strategies are always slower middle of the year. Seems to be something around this daylight savings sort of a thing. It might be like some conspiracy theory or something, but things do sort of change in these particular markets. I think when flow comes in, and if flow comes in later on at night, because you find that some of these trades, you just end up being trapped all night, and then there's no flows late in the US session to sort of bring things back into line.
So what were you trading at the time? Like what were you most focused on?
Most of it was bond spreads, which is where most of the drawdown came from. Okay.
Were you trading like currency futures as well at the time?
I was, yeah. I had a little bit of a drawdown in that period, but it was as a percentage of the P&L that was drew down. It wasn't as much as what it was through the bonds.
So how did you deal with this, like psychologically? Like you obviously were able to sort of pull out of it. How did you maintain enough confidence? I mean, obviously, you're in this situation, you have no choice but to deal with it. But like, where were you at, like, mentally? Like, how was your confidence holding up?
Man, it was like, it's probably been the most difficult period I've had in trading mentally. I guess you always think of doubt creeping in, but it was more just like, in my mind, it was just like, how long do I have to just stick this out for? And that took its toll just because, you end up thinking like, when you're sitting in these bad positions offside, you're like, oh, geez, like, when am I ever going to get paid again? And all this sort of a thing. And to me, the main thing, I guess, that helped me push was that I kind of ended up making up some spreadsheets about like my equity sort of curve on what I've made through my time at the prop firm. And then that drawdown is then put into perspective. And I was like, you know what? Like, this is the most I've been down, but I'm at the furthest point so far in my journey. So, like, almost in a way, like, this is what should be happening. Like, obviously, it's not ideal, but you'd rather be on the progression to be making more, losing more than just like, you know, making the same but losing more, making the same but losing even more again.
Yeah, it's like a part of your growth in some ways.
Absolutely. And I think that was something that kind of helped me stick through it. And then I just did a lot of like the one thing I don't like to do is try to change the strategies in these sort of periods. But what I do like to do is go back and just review them. Like I have a lot of screenshots of like good trades and a lot of the data from good trades and good periods. And that helps, just gives you reassurance that you're not broken. The strategy is not broken. This is just a drawdown. You know what I mean? Because there's a big difference between going through a period where your strategy is actually just completely fucked and you need to trade something else, and it just being a natural drawdown. You're just at a point where maybe in your mind you think, I don't want to be taking a drawdown, or you've just increased all your size. So you're like, I want to get paid, but now it's not paying you. So it's more of a internal battle, and you've got to separate the two. You know what I mean? Because yeah, it can really cloud your judgment. Like one thing I guess that I was just good at through the process was just coming in each day and like, we just got to do it again. Like have a shit night. You leave the office. You're like, oh, we'll just do it. We'll just come back tomorrow and fight again. And that was kind of like, I guess, what got me through, because taking those small incremental steps of, even though it's just the next day, you know, if you feel you're at your lowest point, then how much lower can you go? You know,
right.
Like in your head.
Yeah. You said something interesting, which I'd like to pick up on, is that, you know, here you were sitting in these losing trades, or these, you know, the trades which weren't going so well. That's interesting, because I'd like to ask you, why didn't you cut those trades? Like, is it because you wanted to follow the rules of your strategy that you had laid out?
Yeah. So basically, a lot of my trades aren't ever on at the same time. So a lot of the bonds trades, because some of them are fading things at different standard deviations away from the mean, some of them aren't all on. So in these particular days, the market had moved more. So I ended up having more trades on. So there was more risk on, the P&L swings were bigger. And yeah, then it's like the way in which you execute those trades changes too, because then you go from trading size, which if you've got, you know, 1 or 2 or 3 trades on in these markets, especially in the Aussie bonds, you can get in and out pretty okay. But then when you have all of them on and it's getting late in the US session, you can sometimes end up be taking out a price or price and a half. Like you can pay a lot of slippage as well. Mm-hmm. So then that comes into your mind when it's getting later, and you've got to make sure that like, I guess it's almost like you know, you're almost afraid of the outcome, but at the same time, you kind of like want it to be over. So sometimes you can, you know, exit a bit prematurely because you're like, what if this doesn't do what you want it to do? But really at the end of the day, like I always just think, like when I'm testing them, like this shit is not in the test. So like,
yeah, your discretion, you mean?
Yeah. With some of these, yeah. And so when I'm thinking like that, I'm like, well, why is it here now? Like I need to get rid of that, because if I start messing around with all these discretion of, you know, how I'm feeling and what I'm thinking at the time or whatever it may be, then everything that I've done in testing is useless. That's kind of how I see it. like I'm changing everything. So like I put all this time in, what's the point?
Correct. Yeah. And what about the firm like that you're trading for? Were they ever, did they ever sit down and have a chat with you about how much money you were down, or like they weren't too fazed by it? They didn't want to put any pressure on you? Like,
I wouldn't say they weren't too fazed by it. I think I've had a drawdown, not as severe last year, but, and we had a chat after the drawdown last year about what worked well. And, it was interesting because I was always like, when the drawdown happened the previous year, I was always like, oh, I wish they would like, talk to me more or something like that. And then I was like, you know what, it was better for me that I was sort of left to just do what I got to do. And that's what was done this time. Obviously, there's people sort of monitoring what you're doing and stuff like that. But for me, it's better to just sort of be in my own world and execute. And then there was a point, I think, would have been just before it started to turn, where we sat down and I like explained the breakdown. And I actually remember them saying like, it's like, what are you worried about? Like, it's like,
okay.
You've lost, like you run like so many different things. You're just drawing down on them all. Like, it's not like you've been taking on too much risk and doing all this other stuff. So that sort of gave me a bit of like, yeah, they're right. Like, even though you know that yourself, sometimes I guess getting that
reassurance from someone else. Like,
yeah. Especially when you're in this partnership with a prop firm, you know what I mean? Like it's not just you at home on your own, and like when you value the opportunity and where it can take you, you do want to do right by both sides. So it's good that they don't see the drawdown as you being
reckless.
Yeah.
Was there anything, like looking back on this, was there anything which you did, or sorry, maybe not looking back on it, in the moment as this was unfolding, was there anything you did to kind of reduce the severity of the drawdown? Like, did you start trading smaller? I mean, obviously that's sort of a fairly common thing that people talk about when they go into bad periods. Was that something you did, or was there anything you did, or you just kind of kept pushing forward each day at a time?
The interesting thing actually was that when I ended up going over and working and just creating that, reassuring myself that the strategies and stuff were right, I actually ended up noticing certain patterns in trades where some trades would be a lot more profitable than others, and some trades carried more risk. So because I still want to execute all the trades that I should be executing, what I would do then is I would just slightly alter the sizing on some of the trades, ones that I feel fall into the category of containing more risk. So that was really the only thing that I did in that period.
Okay, so you did kind of decrease your size a little bit on trades you deemed to be more risky.
Yeah, which was probably 25% of the trades that I would take. They were probably fell into that sort of a category.
So how did you climb out of this hole? Like, was there anything that changed, or was it purely just a matter of your strategies are now performing better in the current market environment?
I think it's a combination of both. Interestingly enough, the big turn was the week after the daylight saving shift at the beginning of October. No, that sounds conspiracy theories or anything, but that seemed to be when equity markets started flying around and there was a bit more movement in the bonds as well. So that was really the turning point for the P&L. And I think too, the end of September wasn't too bad either, but it was more, there wasn't a lot of opportunity, but it was almost enough to build confidence, which was interesting. And that was when I started to trade from home. So I think that in itself had a lot of an impact on it, because interestingly enough, like when I'm in the office, I'm always under the impression like, okay, I'm here to work, let's work. But at home, I was almost like afraid of trading from home because I was like, oh, I'm afraid to be lazy. What if I miss trades? What if I'm, cooking dinner or doing something stupid when I should be watching the markets? And interestingly enough, trading from home now, I'm probably even more disciplined and patient than I was in the office, because I think I've gotten to the point now where over the years, like, this is a business, this is how I make money, this is what I want to do long term. So you make sure nothing fucks with that. And I think at home too, just sort of like, I guess, having the ability to step back a bit, but still be on it, which can sound a bit counterintuitive in a way, but I find that was probably one of the things that helped me execute the best. Because during the period where I really started to claw it back in October, a lot of the trades I was taking required me to use, like, this is what we were talking about earlier in terms of like they were running further on the upside than what I'd ever taken profit on some of these trades before. So it got me out of my comfort zone too, because it was like all of a sudden, you're used to taking, say, let's just say, for example, 10 points on the trade, and all of a sudden now you're taking 30. And you got to have the balls to hold that. And it's quite fascinating because it would have been just as easy to come into that period and say, I need to, take time off, or I need to reduce size or anything like that. But then all these trades occur that are your strategy, have more profit potential, and were more frequent. It was like a real test of, I guess, how sort of strong you are and how strong, I guess, you can stick to your plan.
Yeah, 100%. I mean, it sounds as though you did a really good job of sticking to your plan and following your strategies throughout this whole period. And, I really think that now that you've gone through this and you've come back from it, like, that's, it says a lot about you as a trader, and it's going to help you, I think, a lot moving forward as well. Like, knowing that if something like this occurs again, you've been through it before, you can bounce back from it. Like, you've kind of, I can't think of a great analogy, but like, it's, you've been through a downturn of this much.
Yep.
You've done it before, you can bounce back from it. It's not all over.
True. I think it's quite interesting because I know back in the day when I first started at the prop firm, you hear about people having drawdowns, you're like, oh wow, how can you battle back from that? But the battle is what makes you almost, you know what I mean? Like, the amount of stuff now that I've learned from going through that, just in terms of how like, when it is your sole income, how you have to manage your own personal money for longer drawdown periods, how you need to manage your own emotions. And one interesting thing was just like, sometimes you do need a change of environment. Like, sometimes trading from a different space or a different place for even a short amount of time can reset you a little bit, I feel.
Yeah, just like a different environment.
Yeah, absolutely. And I think sometimes
breaking the mold.
Yeah. Like, the office for me, as good as it was almost like over-consuming me. Like, I just felt like I was like, it's almost like you live and breathe it and it's everything, and then it's not performing, and you can become in this spiral almost of like, almost negativity, I guess, in a way, where it can be a challenge to get out of. And I think going home and being a little bit more like, I could put the trades on and like, they're always on, I'm always still watching, but I kind of spend a bit more time going through some Udemy courses and like reading some books and doing things like that. And that was really what helped me just focus on the process. You know what I mean? Like, I let it, just kind of like let it happen. I didn't check the P&L actually either through that whole period. I only really started to check it towards the end of the month because I was like, this month's gone all right. Like, I think.
Yeah, you just knew.
Yeah, but I did sabotage myself from hitting the 100K, unfortunately, because I remember I had trades on the last day of the month, and I reduced the size because I didn't want to take on too much risk.
Right.
And this is something I didn't do throughout the whole month. And then, it turned out that I should have just kept the trades on at normal size. And
when we say sabotage, you came short of $100K month by like what?
$500.
Yeah. So we can round up. I think that's acceptable. No, man, congrats. That's really awesome. I've just got one other note here on this particular subject. I mean, have you done anything to, of course this is going to happen again at some point in your trading career if you continue with this long enough, which I'm sure you have every intention of. Have you done anything kind of as a preventative measure of, that's not even the right word, because like we said, this is probably going to happen again at some point. But is there anything you would do differently if you went into a period like this, or is there anything you've done which might reduce the severity of it? Or
for me, I guess it's more just I had a lot of sort of things outside the trading that I was like doing with money and all this, and I was probably tying up too much money in things that I couldn't get quick access to. And that, because I'm of the thinking where like no matter how much money you've got, unless you're sort of making some sort of income, it's going to go to zero at some point. And like if that's the case, then you've always got to be a bit cautious on that. And that kind of like that probably messed with my head a little bit. So I think it's more I need to probably work on things that are removing my need to make consistent income, if that's
okay.
If that's kind of like the right thing, which is strange because obviously you trade to make money, but at the same time too, if you're relying on withdrawing every month, you could become dependent, which then changes your decisions. So that's something I think probably I manage my money reasonably well, but there's always ways I can do it better. I can always have a bigger contingency fund for things and stuff like that. I probably got a little bit too emotional. Like,
it's hard not to though, right?
Yeah, it didn't impact my actual trading, but I think in terms of impact it had on me and on my body and on just maybe other people maybe around me, that kind of maybe is something that I have to look to change for the future. But yeah, that's probably the two sort of main things I think. Like with any sort of business, the businesses stay in business the longest are the ones who have cash flow or cash reserves. Why a trader is no different. We need to make sure we can sit out a drawdown. If you believe in yourself and you back yourself, you got to make sure you're there for the next cycle, regardless of how tough it is. Because we never know what time, we could start a new strategy now and we don't know if we're starting in the drawdown. But can you survive 6 months? This could be the best strategy in 6 months' time, but can you survive? And I think that's something that's very, very important. If you love it long term, you just got to be there every day. You have to put yourself in the position where nothing externally can stop you from sort of like being there ready to trade and put the trades on.
Yeah. I mean, that's like that's very relevant for me just this week. There was a day during the week I was trading and I'd barely traded during the morning, and it was seemed like a very quiet day and not much was moving. And I had a few other things I needed to get done, and I was like, tossing up whether I should just throw it in for the day. And anyway, I had an awesome trade come, I think I sort of got into it a bit after lunchtime and held through mostly till pretty close to the close. And, it was a brilliant trade and it was actually my best trade of the week. But had I not been there, had I, given it up for the day, then I would have missed that. So absolutely, you've got to be there because you never know when these opportunities are going to
There's just so many things.
Something might hit the wires.
Yeah, exactly. So many things are always trying to pull for our attention. Half the battle is like being able to resist and be like, this is the set times, or to have, I guess, build, or what would you call it? Sort of like build things around your trading where like if you're not there or if you have to do something for half an hour or an hour or something, that you can still take advantage of some form of opportunity, however that may be. But yeah.
Now, I know you speak with a few other traders who are, a bit less experienced. So maybe we can just speak about that a little bit. I've got a question here. What skills are most important for new traders to develop, in your opinion? Like someone who's very green to this, sort of starting out, in the past 6 months, 12 months, what sort of skills do you use most days that you think are most beneficial for any new trader to learn?
I think discipline is certainly a main thing. And I think that's generally built through other things that people have done in the past, whether it be sport or whether it be just being quite disciplined in their diet or eating habits or something like that. That's certainly the first one. I think something that I think is interesting, but it can be misinterpreted as perfection, is attention to detail. That's the word. So yeah, attention to detail, because people can look at that as being perfection, but attention to detail in your journaling, in your just searching for trade ideas, that to me is very, very important, because I think it's easy to find someone to teach you a strategy that will work today, but it's attention to detail of thoroughly understanding that strategy and learning about the market that's going to help you adapt for tomorrow. And that's something that I've found has helped me a lot. And then I guess, there's the cliche ideas of, people have they've got to be focused and they've got to want it. Like everyone wants the money, but do people actually want it? Will you put in the hard work to do it? Like, is this something that is just a shiny ball syndrome for somebody, or is this something they actually generally want to do? And I think that's something that a lot of people maybe get into trading for the wrong reasons. There's a good book actually out there called The Values Factor by John Demartini. Not sure if you read it.
No, not.
Really good in terms of breaking down what you actually want. And when you know what you want, then it's easy to do it with like 100% of yourself. And I think that is very, very important.
Okay.
Yeah.
So it's a book you'd obviously recommend.
Yeah, definitely.
Who's it by?
John Demartini.
Okay.
Yeah.
All right. Might have to check that out.
Yeah, check it out.
I need to get back into the habit of reading. I used to be read every day, for a little bit in the morning, 20 minutes or something. And I don't know. I've gotten
the Audible. For me, I always get everything on Audible, and then if it's good enough, I'll be like, all right, I better buy the book. There's actually another one I'm listening to at the moment called The Chimp Paradox. Have you heard of that one before?
I feel like I've heard the title. That's all I could tell you.
I can't actually remember who it's by, but it's quite an interesting book. Another one sort of on the mindset side of things, which I guess a trader, for somebody who's new, they have to want to become very interested, I guess, in this self-development journey, because sometimes the journey of self-development is going to outweigh the P&L journey. So there's going to be a period where you lose money, but you've grown so much, and you need to be able to recognize that that's the P&L, not necessarily the dollar P&L.
Yeah, having another way to measure your sort of progress besides P&L. As you were talking there, you kind of reminded me of something I wanted to ask you about, and that was how you actually kind of review your trading. Because I think that's something you put quite a bit of
I do,
time and energy into.
Yeah.
So how do you actually go about reviewing your trades? And
so throughout the week, I'm generally recording all my trades. I generally screenshot beginning of day, end of day on the markets that I'm doing, or entries and exits with the currency trades and all that sort of a thing. And come the end of the week, I will generally go through all my more systematic trades, and I do a tested versus actual. So what I've actually executed and the results that I've got compared to what I've tested. And I have certain percentages of what I've tested that are I generally work it out to, if my strategy pays 10 points or whatever it may be, I generally work around the ratio of about 80%. If I'm achieving 80% of that, I know that that's profitable because I've worked that out in the testing as well. I'll do that, and then I'll do analysis 2. So that's done each week. At the end of each month too, I have an overall monthly review where I'll also look back on previous years, similar months. This is probably more applicable to bonds. And I've done this for a while now because as you sometimes find changes in markets in the months, different periods
like
of the
seasonality.
year. Yeah. Things move. There's more tendency for reversions at certain times. There's more tendencies for flows. And by looking back over the previous months of previous years, you're just bringing anything that might be important to your attention. You know, maybe 11 o'clock is not a good time to be stepping into the market because, you know, it's showing that there's generally flows. Or maybe you might step in, but step in with half size. So things like that can change, not fully change a lot of what you do, I guess, but can kind of add that extra edge, that extra element that, you know, other people might not be looking at.
Yeah. It gives you just something extra to be thinking about.
Yeah,
like
definitely.
Before you put this trade on, yeah, there's a couple other things running through your mind that you want to give some consideration to.
Yeah, absolutely. And then there's, with a lot of it too, and I've started to do this more in the FX side of things, more so than the bonds, a lot of around just analyzing where it is, but then looking at the types of trades I might get that week. So I'm all about sort of wanting to be prepared. And I think by doing a lot of work on the weekends, that will help me so much easier during the week, be able to manage multiple strategies and things like that. Like you really just know what you got to look for. That to me they're the sort of key things, you know. And then as well, like when you're recording all your data and you're doing these weekly reviews and then you're doing your monthly reviews, when market conditions and things do change, you will see it through the data. Like you probably will see it yourself first, but you'll see it starting to change through the data. And that way you kind of have your pulse on the market a bit more so that you can alter or change, or it might even just be just the awareness of it for, you know, further down the track, because it's not always a case of like something changes and you change it, but maybe something changes and you just wait another month to like almost like the confirmation of the change before you actually change things. Like, for example, I've had to do that with stops on trades. You know, I've noticed trades are getting triggered out at certain levels, and I think, okay, this is something that has happened a bit too frequently now. Maybe I need to alter things. So then, you know, I've monitored that for the next month and then tried to build a bit of a case around why this is happening. Is this something that's going to continue into the future? And if it is, then I'll adapt my strategy to it. So it kind of helps you just be on it more, which I think is just so important, because you think of like the amount of people and people that have people working with them, like you're against these people. Like if you're not doing smart work, because as an individual, we can't do everything, but we can do smart work. And that I think is probably the most important thing with the whole journaling and weekly reviews and monthly reviews side of things.
No, it's really cool to get a bit of insight into how you do all that, because I know it's something that you do take very seriously.
Yeah, I probably love that side of trading the most, the sort of like the analysis of results and the data. And I think that's why I do so much of it, because I'm always so fascinated by the outcomes of it.
Is there anything else you want to chat about? I think we should chat about your podcast, actually.
Okay. Yeah.
Because, I mean, you're not one-dimensional. You do other things outside of trading.
Yeah.
How long have you been doing your podcast for now? When did you start that?
Well, the idea sort of started probably about a year ago.
Right.
Didn't really get going for about 6 months, but it's very similar to this, but in the motorsport space. And it's called Minds of Motorsport. And basically, it's cool because I go to a lot of V8 supercar and motorsport races as a fan, and I find there's a lot of similarities to motorsport to trading. So that was kind of where the motivation and the drive for it came from. And I really love the mindset side of things. So being able to sit down and chat with people who are like professionals on top in their game in motorsport, which I'm interested in, talk about mindset like that to me was like, okay, this is a cool idea. This is something cool to do.
Yeah. It's funny how you said it took you like 6 months to get started. I think I was worse. I think I had the idea for Chat with Traders about a year at least before I finally got around to, doing my first interview, my first podcast. It took me a while. And then as soon as I started it, I was like, man, I should have started this when I first had the idea. What was I waiting for? I presume
absolutely.
It was the same.
Yeah, like when you do sort of start, I guess there's a lot of you're a bit hesitant because I think it's like for me it was like I was a bit, I guess, what was it? Like I'm not worried about people's opinions or what they think. Maybe the guests or like how to approach people to get them on to make it not sound sketchy or something like that.
Especially when you don't have anything to show them, like when you're just starting out and you don't have a back catalogue or a body of work, etc. Yeah, you sort of just got to try and win their trust without any of that.
Yeah. But it was that was interesting because going to some of the races, obviously I'd gotten to know some people around the paddock and it made it a little bit easier because I was able just to hit up a lot of people that I'd already known somewhat. And then it's cool because then you get to have a conversation where with these people who generally like at a race weekend and things like that, it can be quite hard to have a chat about this particular stuff because it's kind of like in their...
They're at work.
Yeah, exactly. While in this, it's like a neutral environment. So like, it's like both people are equal. And then you're talking about a mutually equal sort of subject. So it's cool. I've been able to gain a lot out of it. Just, it's interesting hearing how people in other industries, especially professional athletes, deal with the same and similar setbacks to what we have in trading. Because when you think about it, there's not a lot of sports out there who have the amount of third-party influences like what we can have in trading. So like, you look at like rugby, like the ground, it can have an impact, but there's no real other third-party influences. Like obviously in racing, there's the competitor, which is the same as like the competitor in a normal sport. But then you got like mechanical failures and like things breaking on the car. Like you could have the best car and you could be the quickest and you could still lose. Like, in trading, you could be the most prepared, have the best trading plan, and still lose. Man,
this reminds me of something I had when I had the conversation with Jack Ma. He said, in trading, all it takes in some situations is just for one big player with a lot of volume to destroy your entire trading plan, your entire trade idea, and your entire like thesis for the actual trade. So yeah, he's like, he was talking about risk management at the time, but I was like, that's so true.
Yeah, it is. It's exactly like that, especially in bonds where like someone can just come in and be like, a central bank. And there's been times actually when I've seen that happen and been on the wrong side of it. And that was back in the day, I guess, where in these particular spread trades where you just keep averaging until you stopped out, where, it wouldn't always be fun. But yeah, if a central bank wants to sell today, and you don't pick up that they're selling, you can get very, very ran over. And then it's a case of how much you're going to lose. Like how quick can you, recognize it or hit your stop and get out when you need to.
Yeah. So have you ever thought about getting into motorsport yourself? Like how come you wound up in trading and not in motorsport? Obviously it's been a passion of yours for some time.
Yeah. Like I've always been interested in motorsport. Like, as a kid, like I would go with my dad to the races back at like Owen Park and stuff like that. And I think probably, I probably used to doubt myself physically to be able to play a lot of professional sport and do things like that. And it never really interested me to actually do it. Like I've always wanted to do something to make money. But now I think I would like, I'm even still tossing up these days of whether I'd want to get involved as a driving or whether I'd want to sort of like go down the path of like the goal long term would be to have my own racing team and whether I'd rather go in that sort of side of it. Because I think like for me, it's like, yeah, I get to enjoy the the driving side myself, but I kind of feel I would have more to give and share by working with people, especially like on the mindset side of things and really helping develop somebody. I think that's probably where my passion would lie in it down the line. Yeah.
Right. Well, I mean, a podcast is certainly a good, lead way into that.
Yeah, absolutely.
That's the cool thing about a podcast is it can lead to so many different things. Like there's, you're sort of creating this platform. There's a lot of different directions you can take it or different ways you can go.
Yeah, the connections and the way the people that you meet is like, it's very hard to do that in other ways.
Yeah.
It's such a non-aggressive, confronting sort of a way to have a chat with people who you admire or, want to learn from. And yeah, it's a good way. It's a good two-way street for them to use as like to get their name out there. So like, that's what I found with a lot of drivers. Like people want to go on because they want to share their story, which helps people try and understand them at a deeper level, which, if you've got the right person listening to who's got money, there's a sponsor, and all of a sudden you are going racing next year. So yeah, that's where it can be kind of cool.
Yeah. Cool. All right, man. Well, I appreciate you doing this. And we should try and do it again sometime.
No worries. It was good. Good fun.
Yeah. Cool, man. Appreciate it. We'll call it a wrap.
Thanks, mate. Have a good one.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
Welcome to Chat with Traders, episode 173. My guest of this episode is Mike Katz, who also appeared on the podcast last year for episode 156. To refresh your memory though, Mike's a short-term equities trader and he's the co-founder/managing partner of proprietary trading firm 7 Points Capital. The purpose of doing this episode was purely to have a very specific and a very detailed discussion about how Mike traded rideshare company Lyft on the first day of its IPO, being the 29th of March 2019. To make it easier for you to follow along with this episode, I've actually included intraday charts with Mike's entries and exits in the show notes. Go to chatwithtraders.com/173 and feel free to tweet me at chatwithtraders and let me know if you dig this type of episode format. If so, I may try to do others similar to this in the future. Also, while you're listening, please remember the information shared during this episode or during any episode is not a recommendation to buy or sell any of the securities mentioned. You are entirely responsible for your own trading decision. And that's all from me. Here is Mike Katz.
Let's do it.
Cool. Let's waste no time. So I do want to say to you, actually, feel free to be as technical as you want, be as specific as you like. And, if there's any extra details that you can share, by all means, please do. Because, this episode's a little bit different to most episodes, right? Because the pure focus of this episode is to talk about how you traded the Lyft IPO. So I guess my first question, it might seem quite obvious, but what got you interested in trading the Lyft IPO? Like, why did you feel as though there could be opportunity in this?
Yeah, I think this is a good format. Definitely get as technical as you like. A lot of my videos are going to be coming out now on YouTube going forward. They're going to be a lot more technical, and they focus on this type of discussion. So this plays right into it. What got us interested in the Lyft IPO is my partner and I, Mike Mangieri, we've been talking about it for a while. And basically, the IPO market has been a lot slower than what it used to be, right? You have half as many publicly traded firms as you had, say, 20 years ago. And the rate at which these IPOs are coming out has definitely slowed. So the backdrop is that the public is hungry for IPOs. You don't get too many of them. And, Lyft is a big name that everybody knows all around the world. And when they announced that they're coming out, there was definitely a lot of interest by institutions, by public, by traders, anybody who's in the market. So then they started bringing up the pricing of the offering every time, right? I think they started in the 50s and 60s. They ended up pricing it at 72. And there was definitely a lot of hype surrounding the IPO. Now, when they came out public, the valuation was $24 billion roughly. Uber's going to be at 120, they're saying. That's a lot. That's just ridiculous, right? Lyft is losing $900 million a year, right? That's a little bit out of control. So $24 billion is a bigger market cap than JetBlue, American Airlines, Delta, Ford, all these companies that are just, have a proven track record. So here comes Lyft, and every time anybody takes a ride with Lyft, it comes out to them losing about $17 per ride. Right? So every time you press that button, Lyft picks you up. $17 is what Lyft loses. So they're nowhere near where they need to be, I think, to be profitable. And there was a lot of hype surrounding it. They kept on bringing up the price of the offering over and over, just squeezing out as much as the public was willing to pay. And then when it finally opened, there was just less demand. There were more sellers there. So that was the thesis behind the kind of the fundamental side of things, that they're losing money. There's a lot of hype. And if selling started to come into the market, there could potentially be a decent unwind.
Can you talk to how raising the price of the offering works?
As far as I know, I'm not a banker, right? But as far as I know, they have a roadshow and they go around and they try to figure out what investors are going to be willing to pay. Right? Obviously, when they're selling shares to the public, they're going to try to get as much as possible. And the bankers, it's in their interest to get as much as possible for the company, because their compensation is also based on how well they do for them. So I think what they do is they gauge the interest from the public. And if there's more demand than the shares that's going to be supplied, they're more than willing to bump up the price until they find that equilibrium. And they brought it up to the point where, demand met supply, and it was just It was just a little bit too high. You see that a lot. You see that in hyped IPOs. You see that quite a bit. Facebook and then Spotify. I remember being one of them. If they keep on bringing the price, you got to be careful.
Those couple things you said just before are actually quite extraordinary, aren't they? That Lyft had a bigger market cap than companies like Ford. That's insane.
It's unbelievable. And people don't think about it that way, right? But at the end of the day, these are still companies. These are still valuations. And I don't claim to be a fundamental guy. That's, above my pay grade. But simple things like that you're just comparing apples to apples, apples to oranges. It's like, this doesn't really add up.
Yeah. And then the fact they're losing $17 per ride. Wow.
Yeah.
How's that even a business?
Yeah. I remember reading this article. I think it was on Market Watch. It was like they lose $17 per ride if you divide, their loss for the year by the amount of rides that they had. And it's just, you got to be crazy not to ride on Uber, right? Because they're pretty much, you're exploiting an inefficiency.
Yeah. Actually, I don't even know if we have Lyft in Australia. And if they do, then Uber certainly dominates.
We have Lyft here in New York City. And the way it works in New York is a little bit different than the way it works in other states. In New York, the taxis have a little bit of protection where Uber drivers and Lyft drivers, they still have to register with the TLC and get all kinds of documents, which is good, but it brings up the costs of the rides for the riders. I remember when I go to Florida, and recently I was in LA, and during the week of the IPO, my partner Mike was in Florida visiting our Florida office, and you get rides down there for $4 or $5 because anybody that downloads the app, has a car, I think goes through a basic background check, it can drive. So here in New York, it's a little more expensive, but they're everywhere.
Right. Okay. So I presume you probably had a bit of a bias on the direction that this stock might trade for the day once it came online.
Right. Absolutely. So everything we just spoke about is great. You have a thesis, you have a bias, but, I tweeted that morning, I remember saying, I located some shares and I'm ready to go long or short, depending on what the stock wants to do, what the price action is telling me. So here I am sitting there with a thesis that, okay, this is potentially going to unwind. And whether it does actually sell off kind of helps me get more aggressive with my thinking. Had the stock opened up and started to drift higher, then my thesis is to the downside. So I'll probably take a small loss or maybe even try to participate on the long side, but the conviction is not going to be there. The conviction is going to be there whenever I have a thesis, and then the price action lines up with that thesis, if that makes sense. It
does, yeah. Was it easy enough for you to get borrow on a stock that had just IPO'd?
It's on a symbol by symbol basis. We have a few parties that we deal with for locates. And this one seemed like it was available across the street for pretty much anybody who wanted it. Sometimes, I'd say about half the time, the shares are not available, but this time it was, and it was pretty easy to borrow.
Okay, interesting. And are the fees, like the borrow fees on a IPO stock, typically higher than normal, or is it just the same regardless?
I think it just comes down to the supply and demand of the actual locate. So from what I understand from the traders that I deal with on the lending desk, if you think of the locate itself as a security, they have a bid and an ask, and they trade out there. And, if there's more demand for the locate, then the price of that locate will increase and vice versa.
Okay, yeah. And are there restrictions for investors? So anyone who got the stock before it actually came online, who was, allocated some shares of Lyft, do they have any restrictions on when they can sell, or can they get allocated shares before it's available to the public, and then can they sell immediately once the stock comes online?
Honestly, I don't know. The real answer is I don't know. I know that, some investors, when they invest pre-IPO, it depends on, what terms they invest under. But some of them have a lockup of 6 months. Employees might have another type of lockup. I'm not sure exactly if everybody has a lockup, but it doesn't seem like it just the way it trades on day one.
yeah, you're right there. I also love the fact that you're not 100% sure about these things, yet can still trade it and do extremely well out of it. I mean, that it just sort of goes to show that you don't have to know all the granular details about these sort of things.
Yeah, absolutely. That's a great observation. After doing this for 20 years and seeing many traders come and go, I firmly believe that it comes down to price action. You could think what you want. You could have the best research. I didn't get to listen to this recent tweet that you sent out, but I want to go back and hear that video about, is more information really going to get you better trades, right? And I don't know. Sometimes too much information is not always going to help. And just having information, that also builds on, let's say you have the best thesis and your conviction is through the roof. That's great. When you're going to be right, you're going to probably do very well. But that also sets you up to have a major loss, because if your conviction is that high, then you're going to be less willing to part with the position if it doesn't work. Therefore, you set yourself up for a really big loss. It's like, you look down, you have pocket aces when you're playing, right? When you have pocket aces, either you're going to raise and most people fold, and then you get a couple of players and maybe you're lucky, you get it all in once in a while. But most of the time you're going to make a little bit with pocket aces, right? But then somebody else might flop a set or something better, and you're putting it all in. So you're very committed to that hand, and most likely when you're going to lose big. So I don't think that having all the information is necessarily that good. I mean, back in October, I took a huge hit because I had so much conviction on a trade, and I was just not willing to part with that position.
Right. Was this was it PTI?
Yeah.
Okay.
PTI.
Okay. We might try and get to that if we have some time at the end.
As painful as it might be, I don't mind talking about it.
Sure. So you kind of spoke a little bit about your bias and your thesis on this stock just leading up before it actually came online. You had kind of a short bias to begin with. How much had you actually thought through a plan on how you were going to trade the stock, like how you were going to attack it once it actually came online? Like, what was your thought process going into the actual trade?
With this type of a trade, and probably most trades, my thought process is I like to draw reference points either in my mind or on the chart, right? And these reference points are really important for me, because when I start looking at the symbol and price action starts to unfold, I start comparing price compared to that reference point. So when this opened up, I think it was at around 88. That gives me a reference point right away. And whether we trade higher or lower, that tells me which way is supply and demand, who's in control. So the symbol quickly drops to 87, 86s, and then comes back a little bit, but just can't get back to the opening price of 88. And so initially I was thinking I'd like to put a position on. If I'm wrong and this thing starts to make highs, gets above 88, then gets 89, maybe even 90, then that means I'm wrong. This thing's going to go higher. Maybe I'll have to try it later, closer at 100, or just bail on the whole idea completely because price action is so strong. But when it opened, it went 88 and then quickly went to 87, traded through a massive bid at 87. I think it was like 200,000 shares. Went a little bit lower and came back up, but then couldn't get back to where it started trading, and then started curling down again. So that was my cue to start trading on the short side.
Okay. Just looking at the chart here, it looks like when it opened, where did it open here? Oh, yeah, went up to about, yeah, okay, I'm following you. So when did you actually get your first trade on? It looks like it was pretty soon after the open.
Yeah, so I remember it kind of went through 87, then it went through 88, but just couldn't hold 88 for a second. It just went up there and then right back below and quickly got back to 87 and even lower. So when I saw that, I just started shorting at 87 and change. And then a few minutes later, it ended up coming down and below 87 again. And it didn't make it back up to where I shorted my initial position. So this is how I think, right? So if I'm wrong and this thing goes up, then I'm wrong on my starter. I put on, I think it was 87.28 is my first trade. Had that thing gone up to 88, 89, 90, I'm done. I'll take a loss on the starter. But instead, it ended up going lower, and it kind of confirms what I'm thinking. Price action is saying, yes, there's more supply here. I ended up shorting some more, I think 80 below 87, like 86 and change. So I like to add to my winner. I don't like to add to my loser.
Okay. Now, so that very first entry, if you'd gone in and it had gone against you, what sort of risk were you dealing with on that trade? Like, was it a pretty small? You described it as kind of a starter position. So was that obviously wasn't sort of as much size as you wanted to get on? That was just a little bit just to sort of feel it out.
Yeah, exactly. I'll never put on the whole position at once. So it's very rare for me to do that. I like to see green on my screen. So when I put on a position, if it's not working, it's most likely not going to work right away. So if it starts to work right away, then that means I might be in a good position. The ones that end up being a loss just end up reversing pretty early on and going the other way. So I'll put on a starter, and sometimes, quarter to half of what I want to put on. And then as price confirms, then I can get bigger. And as I have now new reference points where I can move my stop closer, then I can get even bigger.
Okay. So going into this trade, did you have kind of an idea about what sort of size you wanted to build up to if things started to move in your favor?
I did, but it's also very fluid. It also depends on liquidity. Liquidity is always a concern, especially with something that can move multiple dollars very quickly, right? Liquidity is definitely in the back of my mind, but I did have a decent idea of what I want to get to, how much I want to risk on the trade. It all comes down to what I want to risk on the trade. I don't really think in terms of shares. I risk X dollars per trade. This one a little bit more than usual because it doesn't come around as often. But I think in terms of what I want to risk per trade, and then I figure out where my stop goes, where I cut off the trade, and then I figure out how many shares to put up. And then it started working quickly. That was the key with this. The quicker it starts to work, the more red I see on the screen and on the tape, meaning more sellers. What was interesting was I saw sellers on the offer showing 100 shares, some guy showing at 87. And then all of a sudden, instead of 100 shares, there are thousands, tens and hundreds of thousands of shares trading at 87 on the offer, and this guy's only showing 100. So there was a lot of soaking on the offer there. And then all of a sudden you see offers jump ahead of him. So that tells me that all the buying that came in was absorbed. And then not only did all the buying get absorbed, now you have sellers coming in and saying, no, I want to sell it lower than where this guy just sold it.
Right. Now, I noticed, I wanted to ask you around that. This first entry, and then you added a couple times shortly after, kind of, I think it was about 5 minutes later. Was this what you would call a setup? Like, was this one of your setups, or was this a pure kind of price action play?
This was definitely more of a price action type of a play. And this is kind of where I thrive in my trading. I like to get everything compartmentalized into setups in my trading, right? But, after 20 years of doing this, it becomes hard to just put everything in its own little compartment. And I feel like I trade my best whenever I am just reacting to price and reacting to the action that I see unfold in front of me.
Now, were you happy with the prices that you got set in at the beginning of this trade? Like, did you have, like, where was your conviction at this point? Did you feel confident that you'd got set at a good starting price?
Yes, I did. I felt like I had a good entry, pretty much as good as I wanted without being the first guy to trade. Right?
Yeah.
It moved really fast. The stock traded very quickly. And then what I noticed was that every dollar level, the symbol had quite a bit of liquidity there. So when it dropped to 87, there was like 200,000 shares on the bid, exactly at 87. And then when it dropped to 86, same thing. There was like 300,000 shares on the bid at 86. So in order for me to create some cash flow, what I end up doing is I could buy a piece of my position, about half, a little bit above 86, so that I can kind of lean on that bid there at 86. And the first time it tags 86, most likely it's going to bounce. And I'll be able to scalp for $1. So whatever I cover at 86.02, let's say, I'll reshort it back on a pop to 87. So that way, it helps me do two things. It helps me create some cash flow, trade around a core position with a piece of my position, right? I don't want to do it with my whole position because if I can't get it back, it's going to be hard for me to re-enter. But if I'm creating some cash flow with half my position, then the profits are starting to rack up a little bit. But more importantly, I'm able to feel how easy it is for me to first cover and then reshort that position at a better price. So I don't want to buy anything unless I can reshort it at a higher price. And whether or not I can do that is now information for me to telling me which way supply and demand is favored towards.
Okay. Now, when you take that partial cover at, I think it was 86, how much are you taking off? Like, what portion relative to your full position size are you taking off?
Almost half. Where it's meaningless for me to do it and still get some cash flow. And then where it's not too big, where if it keeps going, then I have nothing left. And what I won't do is I won't buy at 86. And then if I can't sell it at 87 and it keeps going lower, I won't buy at 85 and at 84 and 83. I don't want to reduce my position size, especially if I can't reshort it, right? If I can't reshort it, it's telling me that something is wrong and there's a lot of weakness here.
When you're saying you can't reshort it, what do you mean by that? Like, you can't short any, like, there's no pops for you to short?
Mm-hmm. Yes, I can't resell at a higher price. So the trades where I sold 87 and change, I sold at 86 and change, and then I got a first cover at 86. And then I was looking for a pop to 87, and I got it.
Okay, so you don't want to be shorting into like new lows, and as you don't want to be shorting into momentum, essentially.
When I will do that is whenever I can't get my fill on a pop. So if I can't get my fill at 87, and now the lows are 86, and I covered at 86, and every time it bounces, let's say it bounced to 86.75, and then the next time it got to 86, it only bounced to 86.50, and you can see that the bounces are getting lower and lower, like a bouncing ball. Then I'm going to time that 86 crack to try to put it back on. Okay.
Now, were there any tells on this trade early in the session, let's say within the first kind of 30 minutes, that signaled to you, or signaled to you that this move, there was likely more behind it, like it was likely going to continue lower for some time?
The main thing was the amount of volume that this was trading. There was a lot of interest in the symbol. And I think in the first 5 minutes, it traded 10 million shares. That was a third of the float, if I'm not mistaken. A third of the float just turned over in the first 5 minutes. And then in the next 5 minutes, it traded another 6 million shares. It was just unbelievable amount of volume. So the more volume that it trades, the more I equate volume with fuel, and there's more fuel to the move. So at the same time, every trade that's happening, we're going lower and lower. And what I use is a volume profile on my chart, which displays the volume to the right instead of the vertical bars. And then we kept on trading lower than the area where most volume was traded. So that tells me that everybody who bought is out of the money, and everybody who shorted is in the money. So I want to be on the side of the winners.
Can you speak to how you were covering as the price was going down? So during from, what was it, about 12 o'clock till about 1 p.m., you covered, and it looks like another 3 or 4 times as price was dropping. Can you speak about sort of why you were covering at those areas? Like, was there any rationale behind that?
If you look at the chart, you'll see that they were at whole dollar figures. So 83 was a cover there. I think that was at around, I want to say 12.15, 12.20. The first time it tagged 83, I tried to cover there at 83, right above 83. And the biggest bounce it gave was to 83.5, right? And there was, I believe, about 400,000 shares at 83 that was bid for. It traded through that, and the only bounce it got was to 83.50. And had this thing bounced it to 84, I would have been able to reshort my cover there. But I wasn't able to do that. So now, instead of covering at 82, which you see I didn't do any of that, the rest of my covers were at 80. I didn't cover at 82. I didn't cover at 81. I was now, because I couldn't reshort, and because it's so weak, I'm being a lot more passive with my covers, and I waited till the big figure, the $80 figure. And then there was about 500,000 shares, maybe even more. But the big bidder was 500,000 shares at 80, and that took about 3 hours to break through. So that was a good support level to do most of the covering there.
Now, when you're covering some of your position, how are you actually doing that? Are you just using a market order and you're just buying into the offers, or do you put a bid sort of in the book at the price that you want to cover some at, sort of in advance?
I'll leave a bid out above 80, for example. So I'll be at 80 spot 10, 80 spot 05. And I'll have an order out waiting, and I won't display my whole size because, with the HFTs, it might just go tag it, and then, it'll just bounce off of it. I'll never get the fill. So I could show maybe 10% of what I want to buy, and I'll have the order sitting out there. That way, in case there's a big flush, a lot of times you don't have the opportunity to click the button and buy offers. So I will have orders out there waiting.
So how do you hide some of your size?
Mainly through just doing those iceberg type of reserve orders, right? Where most exchanges offer that on EdgeX, New York, pretty much all the exchanges offer that. Where if you're looking to buy 5,000, you only show 500. And then when you get filled on 500, your bid doesn't go away, just replenishes for more and more.
Mm-hmm. When it replenishes, are you still in the same queue position?
No, that's a good point. So if there is, let's say, 2,000 on the bid, and you add, in order to buy 5,000, display 500, right? The 2,000 has to trade, and then you get filled on your 500. If anybody came in after you, then they have to get filled. So only 500 gets the queue priority, and then the other 500 goes to the back of the queue. And then it just keeps repeating that. But this thing was doing so much volume that I don't think it even mattered.
Yeah.
I mean, you could have just done whatever.
Yeah. So it looks like you covered your full short position, must have been about 20 minutes past 1, where it sort of, I guess it kind of looked to you as though that 80 level was maybe going to be quite a strong support level, and the price started to bounce a little bit. Can you just talk us through why you decided to cover your full short position at that point?
Sure. So we got the initial flush to 80. I did quite a bit of covering there, and now I have a third of the position left. And from that point, we bounced to 81.50, and then comes back to 80 again. And if it's going to break 80, I'm looking to hit back into that 80 short. All right, so there's 500,000 shares in the bid. Once that starts to go down to 400, 300, 200, I'm going to try to time it so that I try to get short again, because that support that's there is starting to go away. But when it came back to 80, if you look at the chart right after 1 o'clock, around 110, 115, it just tagged it for a couple of minutes and then bounced again. And I don't think that it took off too much of that bid. So then it ended up going past that 81.50 point where it bounced to before, and it kind of made a higher high, only for a second, but that was enough for me to take it off, take off the remainder of the position. And at that point, I was done with my initial short.
Okay. That 81.50 level, was that something that you were kind of mentally thinking about? When it came back to retest 80, and were you thinking this through in advance? If it doesn't get through 80 and it gets back to 81.50, that's me done on this trade? Or was it just you were just reading sort of the order flow tick by tick?
No, that was in advance. So 81.50, if it broke through that meant that it took out the previous high where it couldn't get through. And that tells me that now it could curl up and I no longer want to be short.
Gotcha.
Now, a lot of times it ends up being, a fake out where it just takes out that level and reverses, but it is what it is, right? You can't win them all. That's the point where I no longer want to have risk on the trade.
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with zero locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
So you were out of this short position. What was your next move from there?
So then I figured that 80 level. Well, before we talk about the next one, I remember in the back of my head, I'm thinking the previous IPOs like Spotify and some of the other big ones, and they had some pretty big drops. And just overlaying that over Lyft. Let's see, I don't remember the exact numbers on Spotify, but I remember that day some of the traders were sitting around going back and looking at Spotify. If I remember correctly, it had about from 150, it had about a $30 drop, and we're kind of trying to equate that over to Lyft. and it was in high 70s was kind of our measured move, just looking at how Spotify behaved. So going into the trade, initially I'm targeting 80. And then it kind of stalls out at 80 because that's the big figure, right? There's a lot of liquidity there. And if it takes that out, I don't mind continuing on the short side. But once momentum starts to leave the stock, and instead of, constant lower low, lower high, it's now just starting to go sideways and chop around, then I'm less interested in a continued momentum type of a trade. So at that point, I'm thinking, if I can get any pullbacks to this 80 level, then I don't mind trading on the long side and buy it as closely as I can to 80 and lean on that big bid. So if there's 500,000 shares there, if I can get some fills at 80 and a quarter, at 80.20, then I'm risking, 25, 30, 50 cents, whatever it is, to try to make now a few dollars on the long side. So I ended up getting long on a dip back on a retest of 80. And I think my fills were some at 80.50, 80.70, 80.30 mainly, and then a lot at 80 and a quarter. And then it never ended up getting back to 80 for a while. So I felt like I had a good long position. And after 2 o'clock, it really started picking up volume again and some pretty big green candles. So I ended up adding to my winner and buying more above 81.
Did you feel as though this was a high probability trade, or did you feel as though it was more a trade where you could just get, a bit of size on and you could, with very limited risk?
Exactly. It was very limited risk. Expected value is probably positive on this, but the win rate is not going to be too high. And I just figured that it has two benefits. One is maybe I can pick off a turnaround with low risk, but at the same time, it keeps me involved. And now if, I still have my finger on the pulse, then I can actually time it to either go up or down again. And then at the same time, I'm on Twitter and I love engaging. And then all of a sudden you hear a bunch of people talking really bearish about Lyft, after it dropped from 88 to 80. So, I said, okay, maybe it's a little overdone. Everybody's excited about this thing going down. So maybe there could be a long trade in this.
That was an interesting point that you said just before about how it kept you involved. I think that was an interesting choice of words.
I feel that when I'm in a stock, when I'm trading and I have a position, I'm plugged in and I'm in the zone with it. When I trade well, I'm reading it well. And for me to have a feel from that symbol, I need to have some skin in the game. If I'm just watching it, I'm watching the trades go by, I'm not as plugged in as when I have a position on. And a lot of times I'll, if I, let's say I have an idea, I did some homework over the weekend, and I think this symbol needs to go up, right? It's a decent long trade. I'll put on some small, just a couple thousand shares, just put it on just so that I'm forced to watch it. And then I could go from there. If it starts to work and the thesis is playing out, I'll get some more. If it ends up being a dud, then okay, I have a small position that nothing ever happened.
Yeah. Was this the only stock that you were trading that day? Like, were you purely focused solely on the Lyft IPO, or were you also trading some other symbols too?
Yeah, let's see. I don't think I was trading anything else. Let me just go back to my screen here. Yeah, so not a whole lot. I had a SPY position. I had maybe a NVIDIA position, but tiny, nothing big. I was plugged into Lyft.
Okay, nice. So at what point did you cover or exit this long position?
So I got out, I think it was about a little after 2:30. Again, so I bought some near 80, 80.50 is probably my average price. I added some more above 81. And then it ends up going to 82. Stalls out a little bit at 82, but then eventually reclaims 82 and gets above and goes to 82.50, right? And then it just didn't have any more power. It couldn't get back to VWAP, which was near 84. It couldn't stay above 82. And then eventually just couldn't hold that 82 level. 81.50 was the previous recent low. Once it got below 81.50, which it couldn't do before, I got out. That was the end of that long.
Now, it looks as though you not timed, but you covered at quite a good price, or you got out of this long position at quite a good price, because it looks as though it was slightly above your most recent, like your last add to your long position.
Right around there.
Is that how you normally manage these things?
It's more along the lines of it's going down, it's drifting lower. It sold off over $1 from its recent high, and it got below 81.50, which it couldn't do it before. It coincides a little bit with where I entered on my ad above 81, but I don't want to sell as it's going up. I want to give it some space.
Okay.
And then once it decided to curl back down, I missed, I ended up selling it $1 off of that recent high, maybe a little more, but, I had to give it a chance to go up.
And then obviously the trade later in the day was through that $80 level. Can you just step us through that trade in the last half hour of the day?
Right. So the thinking behind that trade is the momentum trade that you mentioned earlier, right? Selling lows and trying to join the trend and trying to catch a quick crack in the stock. So there's about 500,000 shares on the bid at 80. We come down around 12:30. We tag it for the first time. It barely gets tagged for anything. We bounce off of it. We go to 81.50, and we come back. We don't really get back to 80 again, and then we get above 81.50, right? And that's where I got long, and it goes to 82, 82.50, and then it comes right back to pretty much 80 again. So now there's this big bid there, and everybody who's watching it is very aware of it. There's a good chance that everybody who got long near 80 is counting on that large bid to hold up. And if it doesn't, everybody's going to look to get out, and that could be like a waterfall type of a break. So at around 3:30, I ended up taking a stab at shorting at 80. And I remember it was around 300,000 shares on the bid. So it got hit for some, and I'm trying to time it, right? And then instead of the whole bid being taken out, it just pops up and goes to, I think, 80.50 very quickly, 80.75, at which point I end up taking off half my position. So I short 80, and then I want to see it work right away, right? And if it doesn't, I take off half right away. And if it ends up going higher, above 81, 81.50, I'll take off the whole thing and I'll be done, right? And I'll just chalk it up as a loss. But it hit 80. I took off half when it didn't want to go through. And then like 10 minutes later, it comes back and tests 80 again, at which point I put it back on. I put on some more, thinking, okay, now it's time. It went from 500,000 there to 300,000, and now it has a little bit more momentum. Every time it bounced, this time it bounced, it couldn't get back above 81. And then finally it whatever was left at 80 was taken out. And at that point, I already have some orders out at 79, 78, just looking to get the covers for a quick flush.
Nice. And did you take some of this home over the weekend? Like, you didn't cover your full position before the close, did you?
No, I was flat. I was flat.
Okay.
Yeah, I didn't want to take this over the weekend. I felt like, the easy trade was pretty much done. And then come Monday, I felt that I could, always get back in if I needed to, which I didn't. That Monday I had a big drop, and I missed the initial drop. I remember that. That was a pretty big miss. But there was a lot of follow through. I traded it afterwards after the open, but that initial drop I did miss. So maybe I could have kept some for over the weekend. That would have been nice. And even in after hours, it traded lower. I think it went lower by another couple of dollars in after hours. That reminds me of the Facebook IPO. It was $40, and all day it was trading at 40, and 40 was the offering price, and it was being stabilized. $40 all day long. It was just being defended. I think it was by Goldman and all the big bankers. They were there, and there was a lot riding on Facebook IPO and not being a dud. And it just traded millions and millions of shares. There were millions of shares displayed on the bid at 40, and they don't want you to sell. And then they held it, and they held it, and then it didn't crack until after hours, and that was the end of that.
Okay. So given the fact that you've traded a whole bunch of different IPOs, was there anything unusual about this one?
No, I can't really think of anything unusual, I can't really think of much that really stood out at me. It was just pretty clean price action, high interest by the public, lots of liquidity, and it already got me thinking about Uber and what we're going to do with Uber.
Is there any idea on when Uber is about to list?
I don't know. Hopefully sometime soon. I think it's supposed to be this year. And that one is going to be a little bit tough to figure out. I know that there's been a lot of trading in I forget what you call them, the private market, between people who already own Uber. And I don't think the price has been doing too well with Uber in the third market.
Do you think they might be deterred by having seen what happened to the Lyft IPO?
They've been deterred for a while, yeah. I don't think they're too happy with what happened to Lyft, and kind of Lyft beat them to the punch. But I think people are going to be a little bit more selective with Uber. And a buddy of mine, I remember last year, called me up and said, Mike, how do I buy Lyft shares pre-IPO? I said, honestly, I don't know, but I can make some calls, find out for you. And I ended up calling someone that was dealing with this, and he offered him certain shares, but he didn't end up doing it because the liquidity is so low, before it goes public. But the guy kept saying how prices are dropping. It's a buyer's market for Uber shares. I
don't know, you've obviously seen a lot more IPOs than I have, but this kind of, like you said, there wasn't really anything too unusual about this. It seems that a lot of IPOs, they do get dumped and sold down for the first few days, but then there's often kind of a turnaround play comes at some point. Will you track this stock to, for those sorts of trades?
Yeah, absolutely. Absolutely. I mean, a lot of the IPOs over the last few years, the quality of the companies, I don't think has been that great. If you think about it, the amount of IPOs we've been getting has been decreasing. And the quality of the companies that are listing is not that good. If you're a private company, most are probably saying they don't want to deal with the regulations. They don't want to deal with the public and shareholders and all the scrutiny that comes with being a public company. If they need capital and they need access to liquidity, the private equity firms are a lot more prevalent these days. They have a lot more capital behind them. And I think the chances are most don't want to be bothered with being a public company. So the quality of some of these IPOs has not been that great. So a lot of times you do get that initial sell-off. But, then you have some of these other names that when they come out, if they hold the first day's prices, and instead of selling off all day, either they go up or they hold the price and go sideways, there's a lot of upside there because there's no ceiling. There isn't anybody who's stuck long and is looking to sell at the first chance they get, right? In Lyft, there's probably a lot of people who are stuck long between, 85 and 88, 80 and 88, right? So the first few bounces you're going to get, you're going to have a lot of selling pressure there, right? They're kind of going to act as a ceiling. So it could be some time until Lyft could get through and make high all-time highs, right? But if on day one, day two, the stock just trades really well and holds prices and then starts to drift higher, everybody who owns the stock is sitting pretty. They're not acting as a ceiling. they're actually, all happy and looking to buy more, right? So a stock, when IPOs come out, if they're acting well and they're holding well, that's a nice long trade, a day or two after, as long as it keeps going. And there are lots of examples like Twilio and Tilray and so many of them that when they hold well, they could have a nice move.
Right. So have you been trading in and out of Lyft, over the past week? It's been online for probably almost, 5 trading sessions now. Have you been continuing to trade this, or have you moved on to something else?
On day 2, I had a few trades in it. I missed the initial drop. That was the easy trade. I did have, let me think, I think $70. I traded it a little bit, but I wasn't very active in it. And some of the other guys in the firm definitely have been trading it more actively, but I kind of pretty much moved on.
Okay. Now, as we spoke about your trade on day 1 of this IPO, there were kind of 3 main trades. So there was the short first thing out of the gate. There was the long off the $80 level, and then there was the short through the $80 level into the close. Where was the bulk of your P&L made? Like, did the bulk come from that first initial sell-off, or was it evenly split through the 3 trades? How did it play out?
So I'm pretty sure the bulk was made on the first trade. Yeah, definitely. The first trade on the first short, that was a big drop. That was where most of the P&L was made. On the long side, it was a small winner, almost a break even, you could call it. And then there was a decent trade on, going through 80. That was also pretty good. But the bulk of it was definitely 2/3 of it was on the initial trade.
Right. Okay. Are there any other things you'd like to talk about with regard to this trade, or maybe even trading IPOs in general? I'm just looking at my notes here, and I think I've kind of asked you everything I wanted to about it, plus some. So, yeah, are there any other thoughts you had on this?
I think that just the only other thing I'll mention is that the public, when they're trading, they just have to realize what they're buying, and still valuation counts, and don't get too caught up in the hype. As traders, the best way we could trade is just to decide what we want to do, and then if price confirms it, you can tackle it. Otherwise, just hopefully take a small loss and move on, and maybe even participate on the other side. But that's the main takeaway from me from this trade, is that if your thesis lines up with the price action, great, right? You're going to nail it. But if it doesn't, then you better run the other way and not fight. If you're going to fight it, then you're going to get hurt. And I know that everybody who trades is going to get hurt. Everybody takes losses. It might not seem that way on social media, but everybody takes losses, and the key is to just go running the other way whenever it doesn't work. And everybody has these moments where we don't do that, and losses get out of hand. I don't think any trader can say that they've never been through that, or that they never will again go through a scenario like that. But the key is to just minimize that, and hopefully just run the other way when it doesn't work.
Mm-hmm. There was actually one last thing I did want to ask you, Mike. I'm not sure if you'll have an answer for this, but realistically, when you look back on this trade and look back on this day, do you feel as though there was anything that you could have done better? And don't feel as though you need to say there is, if there, maybe isn't. It looks like you did very well. So don't feel as though you need to make something up just to sound humble.
Look, as traders, we're always going to be pissed off, right? You make money, you're pissed off because you should have made more. You lose money, you're always upset. I think I traded this well. I think there's definitely more money I could have made. Maybe with my initial trade, I could have covered a little bit better and waited. But no, I think that I followed my plan. I tried to play the dollar figures. When it was working, I was in it. When it worked, I added. And then I tried to trade around a core, which is my plan. And then I try to stretch out as much as I could and stay as long as I can with this, targeting 80, targeting 75. When we lost momentum at near 80, I got out. So, yeah, in hindsight, there's so much that we could have done better. I mean, I'm a trillionaire in my hindsight account, but I think I did okay with this. I can't really think back to an error that I want to change.
Nice. Cool, man. Well, I'd love to chat about the PTI trade, but I think, as we've gone for about an hour on this, maybe we should do that in another episode, because I think this was really good. I've enjoyed sort of the different kind of format and just really pulling apart this one particular trade. So, maybe we can set up a time at some point to talk through the PTI trade example.
Absolutely. Sounds good. I love being on, and I think you do a great service for the community. We get a lot of great feedback. I know when Stan was recently on, we got a ton of great feedback, and just keep up the good work. I appreciate being on and love to be back anytime.
Cool. Yeah, that's good. Stan was an awesome guest, and anyone who's hearing this episode, if you haven't heard that episode with Stan, make sure you go and listen to that. There's a lot of great information in that episode. Episode 171 or thereabouts, something like that. Go check it out. But anyway, Mike, I do want to say I really appreciate you making the time to do this. I know we're doing this immediately after the close, so you've had a long day. If someone wants to follow you on Twitter or find out more about you, where's the best place to do so?
So our website is 7pointscapital.com. We have the Twitter and Instagram, and that's at 7pointscap. We have the YouTube videos, which we do the trader takeaways nightly. That's starting to get a lot of traction, and that's also 7pointscap. And my handle is Michael_Katz11, and that's on Twitter.
Very good. Cool. Okay, Mike, once again, thank you very much for doing this. Let's call it a wrap.
Thanks, Sam. Take care.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
You're welcome. Thank you.
Take care. Cheers, buddy.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.
Chat with Traders is brought to you by Trade the Pool. Did you know that every decade the market reinvents itself? Online brokers opened the doors, mobile apps made trading seamless, and commission-free trading erased barriers. Now, a new era has begun. Meet Trade the Pool, limited risk trading. And now you also have unlimited time to reach the profit target. From now on, your trading risk is capped, and your trading opportunities are limitless. Trade the Pool funds home-based stock traders with up to $200,000 in buying power. That means you can trade larger positions and scale your strategies without risking your own savings. It's time to trade with more capital, making it truly worth your time and effort. Ready to trade the pool? Click the link in the description and join the stock trading revolution today.
Are you ready to get serious about trading? Then join Tasty Trade, Investopedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade all in one platform. Get low commissions, including 0 commissions on stocks, so you can keep more of what you earn. Trade smarter with advanced charting tools, a pre-built strategy selector, risk analysis tools, and more features. Visit tastytrade.com/chat for more information. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC.
Markets, speculation, and risk. This is the Chat with Traders podcast, hosted by Aaron Fifield.
What's up, good folks? Welcome to Chat with Traders podcast. This is episode 175. My guest is Jonathan Shapiro, a senior reporter at the Australian Financial Review. While Jonathan writes about a range of subjects from banking to hedge funds to private equity, he's renowned for stories that uncover dishonesty and the crafty schemes of listed companies, for which he's won several awards. Our conversation begins with Jonathan telling the story of Blue Sky Alternative, a fund manager that came unstuck following the release of a short seller's research report. From there, we roll into a very detailed discussion about Jonathan's investigative work on Big Un. Without saying too much, Big was a video marketing company listed on the Australian stock market and a top performer in 2017. But as you'll soon hear, Jonathan discovered much of it was smoke and mirrors. Now, to do this podcast, I met up with Jonathan at the AFR office, so there's also a video of our conversation. If you'd prefer to watch this video rather than just listen to the audio only, as you're doing now, make your way over to the Chat with Traders YouTube channel and you can find it there. And last thing, you'll hear us reference several of Jonathan's articles throughout. You can find links to all of these articles in the show notes at chatwithtraders.com/175. All right, let's get on with the show. I hope you enjoy this one. Here is Jonathan Shapiro. So you were saying something just before, and I told you not to say too much because I thought it could be a good way to start the podcast. You're working on an article at the moment or a series of articles?
Well, we're working, a company we covered pretty closely almost exactly this time last year was Blue Sky Alternative Investments, which was a stock market darling until GOLDENFlow, which is a US research group, published a short report and sent the share price tumbling. And on Monday or Tuesday, I think it was Tuesday, they went into receivership, so that it's kind of like a big moment that signals the end of Blue Sky. And as reporters, we tend to kind of use that as a marker to look back at what happened and how Blue Sky collapsed. So a few days ago, we kind of retold the story just in a kind of a chronology of how Blue Sky collapsed. But for the weekend, we're looking at all the hedge funds and traders that saw it coming well before it collapsed. What was it about Blue Sky that made them think this was doomed to fail? So that's what we're working on at the moment. There's about 3 or 4 hedge funds that had actually shorted Blue Sky long before GOLDENFlow had published their report, and they actually took a lot of pain. I mean, a lot of them were shorting Blue Sky shares at around $4, $5, $6, $7, $8, went up to about, I think it almost hit $15. So they took a lot of pain. They had total conviction in their position, but that's not enough. They were really hurting. I mean, the position was almost doubling against them. So the article we're working on is A, what made them so convinced that Blue Sky was way overvalued and due for a blow up, and how they managed their position going so much against them when they had conviction in the fundamentals, but the trading was going totally against them. So, yeah, that's what we're working on at the moment.
Now, a lot of people who are going to hear this probably aren't familiar with the Blue Sky story. And obviously, we can probably dig up a couple of articles of yours and put them in the show notes. But Just give us a bit of for some context. What is the Blue Sky story?
Blue Sky is a fund manager, the same way as Magellan or Platinum is a fund manager, but their point of difference was that they were not going to invest in listed equities or traditional asset classes that are easy to access, that mums and dads can almost get access themselves. They were going to focus on private or alternative assets, so things like investing in private equity, so investing in startups, small businesses that they thought were going to grow, property development, so being able to kind of commit capital to a residential property development, commercial property development. And one of their big sleeves was agriculture, water rights, investing in farms. So their pitch to wealthy Australians was, hey, we will get you exposure to this important asset class. It's you can get great returns from it. It's different. You can diversify out of listed equities, bonds, and we'll allow you to do that. So what they did is they created a whole lot of funds, they created a fund, raised the money, and they were effectively unlisted funds. So but they got so good at the marketing that they kept on creating fund after fund after fund after fund. So most private equity funds would raise a whole lot of money and then go and deploy it into anywhere between 5 and 20 companies. But Blue Sky decided, we'll do the Vinomofo fund, we'll do the Shoes of Prey fund, because they just created this conveyor belt of funds, and the funds took huge fees up front and then charged their investors fees over the life of the fund. But because these assets that they invested in were private and there was no real kind of stock market valuation for them, it could be argued, they had a lot of discretion to value those assets. And what those assets kept doing was being valued up. And as they were valued up, they pre-booked the performance fees they were going to earn from when they kind of closed out the fund and returned the money. So what ended up happening was their profits kept going up, even though their cash didn't go up, because, I mean, it was still costing them money to manage the funds. But that was kind of the thesis, is it all kind of relied on the private value of these assets being valued upwards. And that was kind of the big bear case, at least until Glaucus came along, is that this is just kind of, they're marking their own homework, and they effectively have discretion to determine their own profits and their own valuation. And then they went on a fundraising spree. So they just desperately tried to gather as many assets as they could, because it just helped with their earnings and helped with their valuation. Okay.
And this Glaucus report, did that mark the top?
The Glaucus, yes, almost. So I think it peaked at the end of, at the start of 2018, and Glaucus came around end of March, early April. So the stock had come off a little bit heading into that, and that's because Blue Sky went out and raised $100 million from the equity market. So literally about 2 weeks before the Glaucus report came out, Blue Sky appointed 2 brokers, raised $100 million. And at the time, a lot of the short sellers that had this thesis that Blue Sky was unsustainable had actually kind of tapped out and exited the trade, because they thought, well, look, even if we're right, they have $100 million of cash on their balance sheet, so they can plug any holes that could emerge. So I guess the share price came off a little bit because they'd issued more stock and created more supply of. So it had kind of come off, but it was still very high. It was in the $12.50 range, and it listed in 2012 at $1. So people got very wealthy off it, and announced zero.
Man. Now, you said before that you knew of some hedge funds, about 3 or 4 hedge funds that started shorting the stock around, was it $4 or $5?
Yeah, the big moment for the short sellers, or for the ones that we at least have spoken to either at the time or retrospectively, as we've kind of gone to them and asked them about their experience, their big moment was, I think in August 2016, the founder sold about 3.4 million of his 8 odd million shares, and they saw that as a catalyst. They thought, well, and he also stepped off the board, so that means he could sell shares without having to file any or under most conditions he could decrease his holdings without having to declare it. Yeah, so they saw that as a big moment. First, him stepping down, getting out, and stepping off the board. the conspiracy theorist short sellers thought, well, this is his opportunity to lighten his position.
Okay. Now, how do you know about the hedge funds that were shorting stock, around $4 or $5? Like, is this sort of part of your role as a journalist that you're out there actively speaking to these fund managers?
Yes, but we don't always know when they're short. Often they will tell you a lot more post the fact. Many years later, they'll tell you that. Often some of them will just tell you what things they see are wrong. Often we would look at a company that is either going up or going down and ring a whole lot of them and ask them what they think's going on, and get their theory and their thesis, and then. But we always follow quite a stringent process. So if someone tells us something, we'll never just kind of put it out there. We'll kind of check with the company, check with long-only investors, and try and triangulate some version of the truth. But I do remember actually not long after XAUUSD sold, there were a lot of other hedge funds that were trading that could be either long or short the stock, or just investors that had looked at it and didn't own it and steered clear, but had a lot of theories as to what was driving the share price up. So, yeah, it's a big part of our job is to just talk to all sides. I do like talking to the short sellers because they offer a contrarian view. You always get the long side from the company and from shareholders and from brokers. And actually, Blue Sky is a good example of I think what we see a lot, which is a lot of companies that raise a lot of capital aren't necessarily good investments because they're raising capital. I mean, if you're constantly having to dilute your register, go to the market for capital, it's not a hard and fast rule, but it tends to be that a company that needs capital isn't a great company. Like Amazon's a good example of the opposite. It never had to raise $1. It did its IPO and it never went back to the market for capital. But whereas there are companies that are constantly returning to the market to raise new equity, and the irony is those are the companies that the stockbrokers love because they make some money from trading, but they make a bulk of their money from helping companies to raise capital. So it's almost this convenient relationship of if there's a company that raises a lot of capital, the brokers will tend to gravitate towards them. You tend to see very positive research about the company. The stockbrokers are pushing it on their clients. So a Blue Sky, I think, was a good example of that. Very capital hungry company that all the brokers loved, and I think there's probably a few other examples.
Right. And when did you start reporting on the Blue Sky story? Was that after the Glaucus report, or you'd sort of become interested in it beforehand?
Well, I wrote something, I think it was in 2017. So the article's titled "How Bright is the Blue Sky Model?" And I'd summed up some of the short theses that had come out around that time around XAUUSD selling his stock. I can think of a handful of people that it raised a red flag for them, and I somehow got in touch with them and put together a thesis. I think it was quite a balanced piece. It was just saying these guys are onto something. There is a huge amount of superannuation money in Australia. Not a lot of it is invested in private markets, and they're offering a solution to that problem or a product that in a market that can grow. So I think it was fairly balanced, but it did raise a lot of questions around their revenue, around their how their profits were kind of growing more than their cash, and how they were how reliant were their profits on fees that they had booked but yet to actually have earned, or yet to have been paid out, because they were earning fees on the value of the assets going up, and that they were booking fees on the value of the assets going up. They hadn't actually been paid those fees. So there was a discrepancy between fees booked in an accounting sense and fees collected. So, but Blue Sky kept going up. So
yeah, that's incredible that you said there were hedge funds who were shorting it around $5 and it went up to 14. Like you said, they must have taken a lot of pain on those positions.
It is, this is also a very interesting thing. There are a lot of, and there's probably a few examples of, Tesla's actually a terrific example, and there's others. Afterpay is a company a lot of people have shorted. I think the jury's out on that one. Tesla, I think there's a lot of evidence to suggest, and I'm not an expert on Tesla, but it's a similar situation. Tesla has had a lot of short sellers and critics talking it down and suggesting that it's unsustainable. I remember actually having breakfast with a hedge fund manager in I think it would have been 2012 or 13, and Tesla. It probably was closer to 2013, but Tesla was at $35, and I asked him what he thought about Tesla because I thought I just met someone that had just started working there, working here in Sydney, helping to kind of build Tesla's profile, and I thought, wow, these cars look quite terrific. And his comment to me was, "Don't be silly. Every half intelligent investor is shorting Tesla. You should be long Volkswagen, short Tesla." So I don't think that's a trade that worked out. But I guess it just goes to show you that you can be an intelligent, smart, forensic investor, but you can kind of pick the wrong fight. And you can pick something that can either is onto a great trend that defies almost the fundamentals, and they've found a great idea in a great market, and the fundamentals sort themselves out. Or you can be up against extreme hype that the promoter of the stock can just do a better job of promoting that stock more than kind of the fundamentals catching up. So the lesson from talking to a lot of people that are brave enough to short shares is that it's more than just uncovering problems with the company. You've got to manage a whole lot of other risks.
Yeah, totally. Now you said Blue Skies, is it being delisted?
Well, it went into receivership this week, so I think it would be delisted. I think it was at 18 cents when it delisted. The interesting thing is, just over a year ago, it had a very strong balance sheet, had $100 million of cash, minimal debt, and now in May 2019, it's defaulted on a loan, which just shows you how quickly something can unravel.
So what happens to any investors or holders of that stock when it becomes delisted?
I'm not sure. I think I think it's a long process. You're just in line as a creditor. So you have a claim on the assets, and you have to let the receivership process work its way out, and then at some stage in the distant future, I think the receiver will say, you as an equity holder in the business will get X cents in the dollar, and it's most likely to be a zero. I think there'd be a whole lot of lenders that would have claims. So I think, I'm not an expert on this. I've seen a few of these situations, but I think you just get in line, and you're actually, as an equity holder, you're at the very back of the line. So,
okay, right. Well, another kind of high-profile case which you've covered was Big, and you're quite well known for that. So maybe we should talk about that and maybe go into that.
Sure.
And,
I can talk underwater about Big. It was a real adventure.
Right. Well, I mean, let's just start off by talking about what actually got you interested in Big, and maybe what was the company Big? Like, what did they do?
So, before I kind of explain how I got interested, the background on Big. So it was a kind of a micro cap / small cap / mid cap as it was inflating its way up the stock market. I think it was a favorite amongst a lot of small cap investors and retail investors. And the business itself made videos for small businesses. So if you were a cafe, Joe's Cafe down the road, someone from Big would at some stage would have given you a call and asked you if you'd be interested in them making a promotional video for you. They'd come and film your cafe and interview you and make a brief 1.5 or 3-minute video about your cafe. They produce it for you, and then if you paid them for the video, they would host it on their YouTube channel and help you kind of market your cafe through this video. Their whole thesis was that video was the future of the internet, and you needed to get on it. And it was a great way for small businesses to market themselves in the digital age. So,
they'd post the video on their YouTube channel.
Yeah, well, that's kind of the controversial thing. I mean, their pitch was that they had this YouTube channel that had a lot of subscribers, and if they produced a video for you, they would put it on your channel, and you would get the benefit of all those YouTube viewers, because they said they had hundreds of thousands of viewers, which I think in hindsight turned out to be, I think you can buy those viewers at a click farm, so I don't think they were real viewers. But also, YouTube is free, so you shouldn't actually. I think it's a breach of the terms of YouTube that a channel can pay you to host
Oh, okay.
So they had a YouTube channel, and their pitch was that their YouTube channel had a lot of traffic, and they would make the video for you and put it on their YouTube channel and bring a lot of eyeballs to your video and help promote your cafe or your florist or your beautician. So that was what the company did. I mean, the kind of the first discrepancy was they were charging $12,000 to produce the videos, which, we've got a cameraman here. Maybe he can tell us if that's what he's charging you to do this video. He's shaking his head. So, I mean, I think it's somewhere like $300-400 or somewhere in that, maybe either side, depending on the quality. So $12,000 is way out of whack. And small businesses are very tight with their dollars. They run tight margins. They've got a lot of costs. They're not going to be blowing $12,000. I mean, that's almost like that pays for a staff member for the full year over to work on a given day of a week. So it was kind of out of whack. And they said they would charge $1,000 a month throughout the year, and not just
hosting the video.
Yeah,
on their
so
YouTube
it
channel.
would all be kind of in the cost, producing the video and then hosting it over a year and using and running the marketing through the video. So that was the first thing, is that it just seemed like a very expensive product versus what people were willing to pay. And there are a few other red flags. One was the CEO had changed his name and changed it back. And that was actually, we thought we'd struggle to find that, but it was in the prospectus. They were forced to kind of make that disclosure in their prospectus. So we thought we'd have to go to births, deaths, and marriages we were told about this, but it was really just there in the open that the CEO had, for whatever reason, and I think as we kind of explored the story, it became more clear why he may have changed his name and changed it back. The other thing is they said they were making a lot of cash. So this is why the stock market embraced the stock so much, is because every quarter they would put out their 4C and it would show their cash was going up massively. So their cash receipts, so their sales. And a lot of startups say their revenues are going up or their user growth is going up, but it seldom translates into cash. So the more cynical investors out there are focused on cash. I said, if this company is making money, it should be becoming more valuable. And Big was showing extraordinary growth in cash. I think at one stage they were run rating over a full year $100 million of cash, which is an incredible amount of money. So the stock market was buying the story. But they were not paying their staff, or they were not paying a lot of their costs in cash. So they were making all the cash, but they were choosing instead to pay providers with ultra cheap options, so 20-cent options. When the share price was going from $2 to $4 to $5, they were still paying their staff with these very cheap kind of options to buy stock at 20 cents, which is highly dilutive and kind of makes no corporate finance sense. If you're generating all this cash, you should have no worries just paying cash rather than almost giving away your company for free, giving away a portion of your company for free. And they were doing this quite systematically. And yeah, that was kind of one of the red flags we had. The other one was that they changed the auditor. They had this auditor for a long time, for about 2 years. They had PKF, which is quite a reputable firm, and they decided to change and hire a single auditor, a single man shop on the other end of the country in WA. And it just didn't seem to make a lot of sense to us why they'd done that. It seemed like a strange move. They said that this auditor had experience with them, but when we looked up the history, all the auditor had done it did a backdated audit of at a period when they'd only operated for a month. So they said this company knew them better, but the existing auditor had a lot more experience with the company. So
are these the things which got you interested in Big, or are these the things which you started to uncover once you started looking into it?
No, all of those things were apparent from the start.
Okay.
So they were all like, that's just kind of like the ground. Those are all the things that didn't make sense to us. But for us, all of that in itself, to me, thought there is something going on here. But the real challenge, and this is kind of why I got so involved in this, is it was a real mystery. It's like, how are they showing all this cash? This is almost something that there's been a whole lot of kind of accounting shenanigans over the years, and most of them are well known to forensic accountants. They can spot things quite easily. They can see, oh, we've seen that before. We saw that with Enron. We saw that with Steinhoff. We saw that with a whole lot of companies. So the good forensic accountants have seen all the tricks on it, but this one was a little different because they were showing all this cash, and you can't fake cash. It's not something you can do. But my suspicion is that they were doing something that was overstating their cash, and it was how am I going to find out what they're doing? And it was quite difficult, and it relied on a lot of luck and a lot of very fortunate tip-offs at fortunate periods. But it was a really kind of fun, exciting, stressful at times journey to find out how were they showing $100 million. How were they showing that they were generating $100 million of cash but not actually generating anything?
Are you ready to get serious about trading? Then join Tasty Trade, Investorpedia's best platform for options trading in 2026. Stocks, options, futures, and more. Tasty Trade has everything you trade, all in one platform. Get low commissions, including 0 commission on stocks, so you can keep more of what you earn. Tasty Trade is packed with advanced charting tools, backtesting, a pre-built strategy selector, risk analysis tools, and more features to help you trade smarter. See equities and derivatives with high trading volumes, dividends, upcoming earnings reports, and more with their pre-built watch lists. Or create a custom watch list to keep an eye on the companies and sectors that matter to you. Manage your positions with speed and precision using active trader mode, one-click trading, and smart order tracking. Plus, Tasty Trade's stellar trade desk team offers live support during trading hours if you need it. Visit tastytrade.com/chat for more info. Tasty Trade Inc. is a registered broker-dealer and member of FINRA, NFA, and SIPC. Have you ever watched a stock explode and thought, if only I had the capital? Or sat on the sidelines because your account balance felt too small to matter? Good news, with Trade the Pool's limited risk platform, you don't need millions or even thousands to start trading the U.S. stock market. Bypass the PDT and tap into over 12,000 U.S. listed equities, from penny stocks to big caps, ETFs, even the newest IPOs, and short anything you like with 0 locate or hard to borrow fees. Start your evaluation, get funded with up to $200,000 in buying power so you can go big without risking your own savings. And now you can also have unlimited time to reach the profit target. It's a game changer. Not ready to trade yet? Trade the Pool offers a free demo and educational resources. Practice on live data, master the platform, and build confidence risk-free before you even pay a cent. Click the link in the show notes to start trading with Trade the Pool's capital.
So this might be a really naive question, but why is it so difficult to fake how much cash you're holding?
Well, because the auditor has to look at the bank statements. So the auditor has access to the bank statements. So if your bank account says 10 million in June and 20 million in July, $10 million had to have gone into the bank account over that period. So yeah, it's kind of, they're bank statements and you can track money, and that was the thing, that the money was going into their bank statement. So into their bank account. So that the cash was coming into the business.
Well, I'd love to ask you about how you went on that journey to uncover that cash wasn't, I don't know, was it there or?
Okay, well, I'll try and I could either tell you a 3-hour version or a 10-minute version, or I'll try to do it in even below 10 minutes. Well, the first thing I did, which is similar to what we did on Blue Sky, which is we just wrote a story saying what we know and what we don't know, so we called it Big Un, the most unbelievable stock of the year, because it was actually, in 2017, it was a stock that had done better than any other stock on the whole exchange. It had gone up 5 times, I think, or even more. I think 2,000%. So it had gone from 20 cents to close to $5. So it was the end of the year, and we thought, this is a fair story. How do we explain the best performing stock of the year where investors made 2,000% returns? So we just listed all those kind of red flags that I'd mentioned to you. And said, this is kind of curious, but you know what? The company says they're making money and cash doesn't lie, and left it at that. And it was almost, I was a bit ambitious. We thought we could solve it by just calling up a few good accountants, and someone might be able to pick something up. And we sent the accounts around, no one really picked up anything. So we didn't really solve it. So we just landed up writing, well, these are some of the things that are curious to us. But it acted as a bit of a calling card.
Right.
So there would have been people around the country, or whether they were investors, private investors, whether they were people with some knowledge of how the company worked or some experience with the executives. Some of them got in touch with us, and it was a long process after that of just people coming to us and us taking little bits of information and pulling it all together to work out what was actually going on. I think within a couple of days I think the next day we got a very good tip, which was that we needed to look into this company called Finstro, which is accounting payments company, that Big had partnered with. So the official line is that when we ring up these small businesses, we will cross-sell this Finstro accounts management product where you can factor your invoices, which means they'll help you with your day-to-day financing and your cash flows. Financier, basically. So they said, we need to look into that. And I thought, well, that's really interesting. That means perhaps they are factoring their invoices, which is...
What do you mean by that? What's factoring?
Well, factoring is, if you're a small business, a good example is, if I was a journalist at a dog food company and we would sell products to Woolworths, and Woolworths would not pay us for 90 days, and we'd have cash flow problems because we'd be sending them all our product and the money was very slow to come back in. So a factoring company will basically pay you 95% of the cash up front and collect the money from Woolworths and make the 5%.
Okay.
So our cash flow problems are solved because our margin is decreased a little bit. But so we thought that Finstro was probably getting the money from the clients and helping their cash look better. So that was our working assumption. It turned out not quite to be the case. But that was an important tip, and we started looking into Finstro and who owned Finstro. It was a Sydney financing company called FC Capital. And so we kind of had a suspicion that they would explain the extraordinary cash growth of the business. But we didn't know exactly what. We just knew it was a good clue because it seemed plausible that these guys were helping. And then we tried, and weeks went by, and I kind of looked at it and dropped it and looked at it, and you can't force issues too much because the information decides when it comes to you. As hard as you look, like the key insights don't just happen because you're forcing it. And then a big moment came when Ownership Matters, which is a kind of proxy advice, very good accounting, they're good on accounting and governance. They published a report on the back of the article we wrote to their clients, which just said that the company would actually not be profitable if they reversed you know how I was explaining about the options? They would give out cheap shares instead of paying people with cash. So they kind of back-solved that and said, right, well, the real cost they're paying for these expenses, if they were paying and accounting for real expenses, the company arguably wouldn't be making much money. So they were saying, basically they were insinuating that by not paying people with real money and using cheap shares, they are overstating their profits effectively.
These people who they were paying with the options, these weren't employees. These were people who were offering or giving services to
outside consultants, things like that. Yeah. So they said, look, if they were actually paying these people in cash, or sorry, not in cash, but in real money, rather than giving them options that were undervalued and then would appreciate to the current trading price, they arguably weren't profitable. And then they did a whole lot of work around the chairman and come to the conclusion that the chairman was not properly disclosing how much of the company he owned. So they just did a governance report for their clients and said, look, these are two governance issues. And that for me was like, well, maybe I'll write about that. And while I'm writing about that, I'll go to the company and ask them about their relationship with Finstro, ask them to clear it up. Because we'd also seen a copy of their sales manual that their call center people read out when they try and get a small business to agree to a video. And we'd seen that there was a lot of reference to, hey, if you sign up now, Finstro, you can get a free line of credit from Finstro and all that stuff. So we thought this is kind of not quite a smoking gun, but it validates our suspicion that the financing company is deeply involved, or more involved than they had cared to admit in the process of selling videos. So we asked the company, we thought, well, we'll ask them about the ownership matters, and then while we're asking them, let's ask them to clear up their relationship with Finstro. And that kind of set off a whole panic. It seemed like it set off a whole panic at the company because they took forever to get back to us. And in the interim, we found out that the financing company had actually been one of the parties that had been issued these ultra cheap shares. So that for us was a significant smoking gun, because it meant that the financing company that was advancing them cash was getting paid in cheap shares that were going up because of the cash that was being advanced to them. If you follow that.
Yeah.
So for us, we thought that was quite scandalous. We wrote about it. And then it was about a week where we thought we'd kind of cracked this case, or at least cracked it open in the public. And we thought that things would come to a head. We'd kind of provided enough evidence that something was not right at this company, and they were not being totally open with their disclosures. But that was when it got really kind of interesting for me, well, in a negative way, because I began to appreciate how many how many mums and dads and punters at home had invested pretty heavily in the stock, and they didn't take kindly to any suggestion that any suggestion other than that big was the future of video and the future of the internet and the next Google. Took a lot of exception, and it was kind of an eye-opener for me, because I'd covered situations like this before with Slater and Gordon and a couple others where you uncovered something that people were heavily invested in, and you get a lot of negativity and criticism. But this was kind of interesting and on a whole new level. And it was my first experience of it. I think it happens quite a lot now. It's pretty common, and you just need to have thick skin about it. But I was quite amazed at this army of I guess trolls, but trolls I don't hold anything against them, because they've invested a lot of money, they've done their work, they have a lot of faith in the business, they've put a substantial portion of their position in this company, so it's understandable that they'd be upset and angry. And
so how were they getting in contact with you?
Oh, Twitter, yeah.
Oh, Twitter.
Yeah, so
okay.
I mean, I didn't get too upset about it, but it was quite relentless and quite scary at times. Yeah, it's just a new thing, I guess, that journalists these days have to deal with, especially if they're trying to uncover things that are unkosher. I guess you've just got to be prepared for this. Maybe I was slightly prepared, but not totally prepared for it. And you just got to, I think in the past, if this was 10 years ago, the editor would get 2 angry letters of which one he might pass to me, and I would just crumple it up and throw it in the bin. But now you're getting like an army of so the big accusation against me was that I was working for short sellers, that a whole lot of people had shorted the shares, and I'd shorted the shares myself, and I was now basically putting out this ownership matters. It was the theory that they'd shorted the shares. So there was a conspiracy theory that ownership matters, and a whole bunch of evil dark hedge funds were making money off my reporting. And they'd found that some CFD report, which showed that volumes went up on the Friday before my article, or the Monday, I can't remember exactly. And yeah, for a few weeks, I just got these constant accusations that I was, and that ASIC was investigating, and
you didn't have a position?
No, absolutely
okay,
not.
Just clear that up.
No, absolutely not. And actually, when I started writing about the stock, the person that first kind of alerted me to this said, "Look, this is actually a stock that is almost impossible to short. It is not a lot of borrow, which means not a lot of stock available to be sold short, because it was tightly held by retail investors, and you could short some through." In CFDs, but it was very insignificant. So I remember hearing that and thinking, great, this is one where I don't have to be accused of.
Yeah. Okay. So why was it so difficult to short that stock?
I think there just wasn't much shares available to borrow. So I think the only shares available to borrow were from people that had bought big through contracts for difference, and the contracts for difference provider would allow someone to take the other side of that long position. So if you'd bought big through a CFD, you'd have a CFD position, a derivative position in big. And I think they would allow someone to take the other side of that trade.
Gotcha.
But most people were buying it on the stock market, not through CFDs.
Yeah. Now, I wanted to ask you just before, like through this process up to this point, how much had you actually been talking to Big, the company? Like, would you try and speak with them?
That was the other accusation that I never. Well, yeah, we before we wrote anything, we would. So when I did that article at the start of the year, we had a lot of detailed, sent them a lot of detailed questions, got a lot of detailed responses, incorporated it all into the article. I think they were quite grateful for that. And then throughout that, I would email them everything I was going to write about the company. I would email them. So every day almost. For the first two, until they stopped even acknowledging receipt of the emails. So after about 2 weeks, I just stopped bothering that. It was, I think I even sent them an email saying, look, given you're not responding, I'm not going to seek your comment anymore. So they had opportunities to, I think they were speaking through other people, through proxies on social media.
Right. What do you mean by that? They had alias accounts and...
I think there were some holders that seemed to be saying things that sounded like it would have come from the company. I don't know that for sure, but I got that impression.
Okay.
So I think I was sort of getting their view across to me. But no, the thing about at the paper, we always try. We have a no surprises policy. We don't want anyone, good or bad, to wake up in the morning and open the paper and be shocked to see them being accused of something or being suggested they've done something without the questions having gone to them. So, right. I think it's a good policy. It's right, but also we don't want to be wrong. So if there's some little thing we've missed and we send it to the company or to the person and they say, "Oh, you're totally wrong. Let me show you this document," or "Let me point you to this part of the accounts," and you go, "Oh, yeah, sorry."
Yeah, because your reputation's on the
totally,
line, right?
Absolutely, yeah. I think that's absolutely integral. Is often suggestions we're just trying to get clickbait, but it's not true. Like our overriding priority is our reputation, the credibility of the paper, credibility of the reporter. That overrides any desire for obviously, we want to write great stories and we want as many people to read them as possible, but overriding is our credibility. So we wouldn't risk it for an incremental fact or accusation or anything like that.
Yeah. Now, I don't know if I missed this just before or a little bit earlier, but I don't know that you explained how they were actually sort of fudging $100 million of cash.
Yep. Okay, there's a little bit before that, but it's probably not as interesting. So ultimately what we finally determined, and we got a tip-off that someone sent us a shot of an invoice and said, look, this small business, let's call them Jack's Cafe, this is an internal photo of their of their computer, and it shows that this Jack Joe's has been invoiced $12,000 internally. So in Big's accounts, there's $12,000 that this customer has agreed to pay, and they've been invoiced. But they said, go and ring Joe's and you'll find out that it's not the case. It was actually a beautician, and I harassed this poor lady for 5 days just to get her. I just wanted her to say, hey, can you just confirm that you've never used the service before? And she said, yes, they even called me on Friday. They want me to sign up, and I refused to sign up. They made a video for free, and I hated it. So I don't want anything to – I keep telling them, thanks, but no thanks. I'm like, well, that's interesting because they've invoiced you $12,000. Internally, they've booked you as they've achieved a $12,000 sale. So I thought that must be what's going on everywhere.
But they never sent the invoice to her?
No.
Okay.
What eventually came out after we – oh, the other interesting thing, actually, as an aside, is they had $30 million of cash on their balance sheet. So all this cash was coming in, was staying in Big's balance sheet. So they actually had a mountain of money. So that was the other thing we had to solve. Like, if that money, how do we explain that $30 million of cash? What I did find out is that, and I was at dinner with a friend who's a very good accountant, and I was like tossing and turning, and like it was really bugging me that we hadn't really been able to solve this. And I pulled out the accounts over dinner, and he scrolled through and he goes, oh, as an auditor, one of the tests we do is a interest test, which is we look at the interest income on the profit and loss, how much interest the company's made over a period, and we look at that as a percentage of their balance of cash. So if you have $1 million of cash, you should get something close to 2%. Because if you have all that money, you're going to make sure that you earn an appropriate return on it.
Right.
It's a meaningful. The 2, 3, 4, 5% deposit rate matters a lot when your balance is very large. So you'd expect that to be in a high interest earning, or at least a moderately interest earning account. And it quickly did the maths on that, and it was very low. It was like $10,000. So like you'd earn that in an afternoon.
So where did you see that $10,000?
That was just taking the $30 million of cash, $30 million of cash, and comparing that to the interest.
So that that $10,000 that was on sort of
over like 6 months or something like that. Yeah,
you saw that from
on the accounts. Yeah.
Yeah, so that was from an announcement.
There was the published accounts. I think either their full year or the half year accounts.
Okay.
I don't remember.
Yeah.
So it was their audited accounts, and just
that released to the market.
Yeah. It just showed that they actually were not making any interest on this $30 million of cash.
That's very interesting.
So what I did the next day is there's something called a PPSI register, which is every time you lend money that is secured against an asset, that asset effectively is registered. The lender registers that asset. So if you have a Toyota, a lease, like a car lease, Toyota there'll be a record that that their asset is secured. Toyota has a claim on that asset. So we did a search the next day, and I'd done this before, but I did it on Big Un, not Big Review TV, which is the operating company.
Okay.
And we found that FC Capital, the financing company, had security over all of Big Review TV's assets. So, which meant that they had security over the cash, which meant the cash was theirs, effectively. They had control over their $30 million of cash.
What do you mean by they had control over it?
It
was theirs?
It was theirs, yeah, basically. To dumb down the language, it was theirs. It was in a trust account that they had control over. So,
so that money hadn't come from video sales.
It had gone through Big. It had gone into Big's accounts, into a cash account, but that FC Capital controlled. So FC basically still had access to the money or control over the money. So that was a big red flag for it. I mean, that was a big kind of smoking gun. It just meant that all the cash that was going into Big didn't actually belong to them. In a full sense, FC Capital had total security over it. Then what came out not long after that is they finally revealed what they were doing, which is that every 12,000, like every time they would make an invoice, every time they would do a free video, they would write an invoice, and about some of that would go to Big so that they could manage their expenses and pay for their video guys and stuff like that. So they operate. So I think out of every 12 grand, maybe 3 grand would go to Big so that they could use in a working capital account. I think something like 5 grand or 6 grand would go into this trust account, which Big couldn't really touch. And the difference would go back to FC Capital Finance Company as a commission. So,
okay.
And if the customer decided a few days later that he wasn't interested in the video, all Big had to do was find a new customer to replace that contract.
Mm-hmm.
So they just had to find, instead of Joe's Cafe, they had to find Jack's Cafe, and they could drop Jack in where Joe was, and life goes on. So it was just a money merry-go-round, really, and it was fooling the market because the cash was going into the company looking like cash, but it wasn't. It was either being held there for safekeeping by the financing company, and the rest was going back to them as a commission. And FC Capital, the financing company, was getting shares at a deep discount. So they were benefiting from the process of the money going into the company, inflating the valuation of the shares they were being given. So that's how they did it. That's kind of how they faked the cash. They just came up with a very convoluted, uneconomical arrangement with a cooperative financing company that was prepared to push money through the company. So it gave the impression that they were generating a lot of cash.
So what do you think was the motivation of the management at Big? Like, do you feel as though they set out with the intentions of, I guess committing financial, it was fraud, right?
Yeah, I'm always reluctant to use the F word because,
Okay.
Okay,
well, let's not use that word, but let's say, did they set out, did they have intentions of doing things which were a little bit sketchy?
Well, I think they listed in 2014 and the share price went nowhere, just kind of bumbled along at 20 cents a share and they struggling. And then I think when I wrote about a big sum up story to explain how it all happened, there was a moment, I think, when they figured something out and they all got very excited and they raised some money and they all got very excited and the CEO was kind of came up with all these like payment plans. Like you could tell something was, they were on the cusp of something. And then this happened, and then they changed auditors. They came up with these new started issuing all these options. So I think at some stage they figured out a way to do this, or they figured out this financing arrangement, and they probably, I think my suspicion is some people told them, look, if you can convince the market that you can generate cash, the market will reward you, and your share prices will go up.
So you think they were aware that what they were doing could be deceiving to investors?
Well, unless they're accidental geniuses, unless they kind of like, unless they genuinely thought that this convoluted financing arrangement where the money goes in and it gets held in account and kicks back as a commission, which kind of makes very little practical sense, unless they genuinely thought that was the best way to run their business and they just accidentally got the benefit of the market thinking they were making a lot of money. Eventually, they restated their accounts, and after our coverage, they were forced to restate their accounts. It took them a very, very long time, I think over a year. And what they put out just showed the total opposite of how they represented. They were losing money. They were unprofitable. They were deeply in debt. It was a complete mess. So, I think it's just, to me, it's pretty blatant.
So when you were doing, reporting on this and when you were writing about it, how much thought went into about like how you were, like when you would release articles or was it just as new information came, or did you was it a planned kind of
No, it wasn't planned. No, it wasn't planned. It's just as the information came, and we benefited from help of a lot of whistleblowers, so we were getting a lot of good information. But I mean, for me, one of the big moments was when we thought we'd kind of cracked it. This was before we'd got the invoice, the fake invoice. We thought we'd cracked it, and we went to the ASX because they had their half-year results, and just chatting to someone there and about all the issues in the market, and they said, "Oh well, yeah, we don't think this is as egregious as you think, Jonathan." And that was a terrifying moment for me. Excuse me. Because I was like, oh my Lord, like people don't think there's anything wrong with this. They think this can all be explained with a few little disclosure fixes.
It was terrifying because people weren't aware what was going on, or
people
that you might have been wrong.
Yeah,
on this.
People that mattered, so Exchange didn't seem too fussed about it.
Okay.
I was really taken aback by that.
And you felt as though they should have been given things you had pointed out.
I don't think they saw what I saw, which was bleedingly obvious, is that something was going on here. And that was terrifying. I was terrified because I walked out thinking, my Lord, if I don't solve this again, like what I'd done up to that point wasn't enough. If I don't do it again, if I don't go all the way, like I've carried the ball 60 meters, I actually have to put it over the touchline, take the ball, and then kick it through the goals for people to actually appreciate what's going on. And I wasn't sure I'd be able to get there. I wasn't really sure I'd go the extra 40 yards. I didn't have the information at hand. I had to go out and gather it. And it was actually really difficult. And I was very fortunate to get that extra information. It relied on whistleblowers coming forward with extremely invaluable information, and then a few key insights like that accounting, like working out the cash on the interest cover, which was kind of fortunate that I knew someone that was so good at accounts, but serendipitous that they'd actually sat down with them and they'd kind of picked that up as an issue. So it could very easily have remained uncovered for many years. I think it was in the process of being added to the small cap index, which would have given it and legitimized it, would have put BlackRock and Vanguard would have piled into the register. People would have piled out. Small caps would have just fund managers. A lot of fund managers would probably just bought it just because they don't want to manage their tracking error against the index. They would have had a whole lot of dumb money would have come into it, and life would have gone on. And sometime in the long future, something would have come out. The share price might have fallen, but yeah, it was almost like Scooby-Doo style. It would have got away with it.
Right. So what was the sort of the outcome of Big now? Like nowadays it doesn't exist.
Yeah, it went into administration. It was a messy process, but it's gone into administration. Shareholders have lost all their money. And the ASX, we were quite critical of the ASX but to be fair to them, they explained their position on it. I think they have actually toughened up a lot on the smaller end of town. I think the same way the papers were about their credibility. I think the ASX probably felt they were doing the right thing and they were monitoring things correctly. I'm not suggesting they weren't, but I think after that, and I don't know if Big was a catalyst, but the sense is they've gotten a lot tougher. They scrutinise announcements a lot more. And I think the market's better for it. I think they just don't want to have another one of these situations again. So we've seen and noticed, and some people even think they've become too tough, but I think rather be too tough than not tough enough.
Mm. Is there any way that you can sort of measure the impact or the cost that this had on investors?
Well, look, once it went into administration, I did ring a whole lot of investors, some of them that sent me emails kind of making polite accusations, but I didn't mind that. I think, again, I totally understand where these people are coming from, and just explain to them. They thought I was very unfair to the company. They thought I was making light of a lot of things, which I do not believe for a second. I took everything very, very seriously, and a lot of colleagues of mine are very professional and seen this before, and always over my shoulder saying, "Look, don't get carried away on this." There are people don't get carried away about how absurd this is and what they're doing. Like, there are people with money, life savings invested in this company, and just you need to be sensitive. You need to be mindful and sensitive of them, and I think I always was. And when it did collapse, I did ring a whole lot of these investors and said, "Look, do you want to share anonymously?" So I wrote an article where I couldn't quote anyone by name because they just didn't want to be named. And there were some really sad stories of people that pensioners that didn't have a lot of pensioners might have decent sized balances, but they feel every loss because they aren't going to be working again. So the money they have is the money they have forever. So they feel every dollar they lose hurts them way more than it hurts anybody that has an income and can earn that dollar back. And there was someone that had saved like hundreds of thousands of dollars for a house, who was going to get married, lost it all, lost a big chunk of his money in Big, and it's really sad. I mean, when I wrote that article, people kind of got a good feedback, but there were other people, and I don't disagree with them, saying, well, these people need to understand their risk better. Like, why on earth have you got all this money in one position, a speculative position at that? And I think I agree. I think if there's a lesson from Big for retail investors, no matter how good the story is and no matter how mispriced an asset is, you've got to discount the fact that you could be 100% wrong, and it's not going to blow you up. So, yeah, I mean that's a lesson for Big. I don't think, but I think some people learn it. But there's always a conveyor belt of new fools that come and haven't learned that lesson and lose all their money, and they wiser for it, but they poorer for it, and then they disappear, and then a new breed of people that can be convinced by riches kind of fall into the same trap. So people learn, but it's different people learning at different times.
Yeah.
So.
No, I mean, I think you said that very well. And you won some awards, or an award for this story, didn't you? Or this series?
Yeah, Walkley in last year, which was pretty cool. Yeah. I'm glad. It was nice because there were all these people that helped me in the background that I couldn't name them, but it was good for them because they'd be able to feel some sense of that they contributed to something that was recognised. So, I mean, I'm lucky I get my byline on there so people know I wrote the story and get congratulated. But there's kind of made me think about all those people that helped me. There were at least half a dozen that were invaluable, but there were probably a dozen that were valuable. And yeah, a lot of them, I don't even know their names. They're still anonymous to me, but like I feel quite close to them because I had a lot of interactions with them. And then there's probably a handful of people, two in particular, that aren't anonymous. Well, I know them very well, but they have busy day jobs and plenty to do, but they invested a lot of time to help me, just I think because they're just helpful people and they had the knowledge and the intellect of solving these things. And I think a lot of them just don't like these things. Like when they see something that's wrong in finance, where people are being taken advantage of, or the system's being abused, the accounting rules are being abused, the market's being abused, they take it they get fired up, and they will spend those 3 hours every night kind of helping me. And yeah, actually, the thing is, people think a lot of people in finance are greedy, but that's not true. There's a tiny sliver that are ultra greedy, I think, and most people are good people, and they just want the system. They just want the system to be as fair as possible, and hate manipulation of prices and of accounts, and so that's actually kind of what keeps the paper going. I think what keeps me going is all this silent army of people that want to make sure that everyone is kept honest.
Yeah. Actually, something I did want to ask you, I guess, in regards to this is, obviously the information that you release and publish has great impact on the stock price. Or
sometimes,
can do,
yeah.
Depend, in this case, 100%.
Yeah.
Are there any kind of regulations that you've got to abide by, or is there any sort of governance over that?
Yeah, well, yeah, there's a code of conduct that everyone at the paper, it's part of our employment, and it's been a while since I've read it, but generally the reporters are ethical. They know what their responsibilities are. They know what's appropriate, what's not appropriate, and managing conflicts is kind of important. Again, it goes to our credibility. Look, if I was trading something, I would never in a million years consider it. But if I was, it wouldn't be hard for someone to go onto a share register and see my name there, or someone to complain to ASIC, and ASIC just makes one call to some brokerage firm and sees my name there. And it'd probably be more likely to be like a company. Let's say I was spruiking a company and I had shares, or then someone found my name there. There's information is out there. So I think reporters know their responsibilities very well, and they're not there to. I can't think of any reporter that's in this industry or in this profession to try and scalp a few dollars here and there. Like we're all about, and we're holding people to account. So why would we? If we're holding people vigorously to account, it'd be very hypocritical of us to do otherwise.
How do you feel about the activist short sellers and the sort of the short hedge funds and that, who will take a significant short position in a company and then release a hit piece on them? Like, how do you feel about the ethics of that?
It's an interesting question. I don't know. I'm kind of divided on it. Like, my view is, there's short selling and there's market manipulation, and you need to totally separate those two things. They are completely opposite. They don't go hand in hand. I mean, they are two different things. There's manipulation, market manipulation of a stock up or down, and there's activism long and short. So whenever there's market manipulation, I think that's wrong. I think if you're manipulating something on the short side, that's wrong. But if you're manipulating it on the short side, on the long side, that's wrong too. Short selling, I think, is really important. Has a really important role. But I guess the information has to be right, and I think short sellers also live and die by their credibility. So if they put out reports that are not credible, over time they will lose their impact. So they have an interest to make sure that whatever they're putting out is credible. I think we've seen some kind of copycat activist shorts. I think the company was Credit Corp on the ASX. Yeah. And we took one look at everyone took one look at that and go, this is just amateur hour, and I don't think it impacted the stock at all. In terms of, I think the way where there's a very grey area, and I don't know the answer to this, but I think is interesting, is is like the timing of issues. You know, like if people are taking a position and then the report comes out, you know, obviously like Glaucus, I think they were quite open. We took a position and then we put out our report and we made money from that.
Mm-hmm.
Then their credibility matters whether they're right or wrong. If they're wrong, then they can rightly be accused of just doing a kind of a hit job, you know, to drive the price down. But if they're right, then it's hard to argue too much about it. What is interesting is then if other people are aware of the report coming out, I think these guys do, the credible ones go to great lengths to make sure that they're not telling the world that they're about to put out a report, and they, just to protect their own reputation, I think they keep it secret, the timing of their reports. But you know what's interesting, and we're seeing this in the UK and Germany with Wirecard. I don't know if you followed that situation. So Wirecard was the subject of a lot of activist shorting. The Financial Times has also done a lot of very good detailed reporting on it. But the FT is being accused of, by German regulators, which they stringently deny, of I think, and I might get this wrong, but broadly my understanding is they're being accused of making people aware of when their news reports are coming out. So they've said that people have been aware that the FT will publish something on the Friday. Now that's an interesting one, because as a reporter, I think it is difficult to manage that. I think it's important you don't say when you're going to publish something, but if you've rung someone for a bit of information or to check a fact or to get their view on some accounting or something like that, then someone might be able to work out, oh, well, they're on the verge of writing a report. So it's a bit like ASIC. Let's say ASIC goes around and interviews a whole lot of traders, and those traders might know, hey, ASIC's looking into this issue, you know, and they're going to put out a report, and maybe I should short that industry or something like that. So it's a difficult one, and I think I don't know what the right. I think any manipulation is bad. Any kind of trading on that front, it's not right. I think good ethical people know what's right and wrong. Good ethical reporters know what's right and wrong, and
no, I think
it's a tricky
one.
It is a tricky one.
Yeah. Now, obviously, we've spent the majority of the time here speaking about Beg, and we spoke about Blue Sky a little bit at the beginning. There's also been a bunch of other cases that you've worked on. You mentioned it before, Slater and Gordon.
Yeah.
Get Swift.
Yeah, Get Swift was more my colleagues, so I was just in the background cheering them on. But that was I didn't have anything to do with Get Swift other than piping in with a few comments there. But that was a very interesting one as well.
Has there been, as a reporter, obviously you get sort of highly recognized for certain things, and there's probably some things which don't get as much attention, which you're quite proud of. Like I do some podcasts, which I think are awesome podcasts, but they're maybe not as popular as some of the ones which get a lot of traction.
Totally, yeah. I get that. There's a lot of that. I feel a lot of that at times. Yeah, yeah.
Are there any examples of that which stand out, or anything on the top of your mind?
I tell you what. One article that the one article that I keep referring to, it's got nothing to do with finance, but it's like really stuck in my head, and like every time I watch sport, it sticks with me, and it's totally changed the way I watch sport. I interviewed this former Wallaby called Ben Darwin.
Okay.
He'd actually be good on the podcast. I reckon people would listen to it. He's a former Wallaby, and he went into data. He accidentally fell into data science, and he's come up with this whole theory, which ever since he's told it to me, I see it in play, which is cohesion and teamwork, which is the more a team is together, the more team is assembled and plays together and reinforces each other, the more successful they are, the more they understand each other. He studied the Crusaders, and he said they all came from the same high school, so by the time they played for the Wallabies, they're all very cohesive and well integrated. And he's maybe I can send you the link so your readers can see. But and I'm an Arsenal fan of English football, and I remember a couple of years ago he told me Spurs and Liverpool would be the top teams in England because they were the most cohesive and they had built their whole club around the directors had a vision of the club and building it from the ground up and making sure that it was sustainable and not just over investing in talent that wasn't sustainable for short-term fixes. And he was right. I think Liverpool and Spurs, unfortunately, as an Arsenal fan, are playing in the Champions League. So there's things like that I like when I'm often writing negative stories and takedowns. Not often, but that's a big focus. And it's nice to be able to identify, and this is something you do way more than I do, is identify these great intellects and talents and insightful people and draw it out of them. So every time I do that, kind of offsets the fact that I've caused trouble somewhere. I feel like maybe they can keep the universe in zen when I interview a very good fund manager and he rings me up and he said, we got a call from so-and-so on the back of your article and they're interested in investing in us and things like that. That's when I kind of like those articles.
Okay. Yeah, cool. Yeah, I'll make sure to grab that link from you and I'll put that in the show notes.
I think he's been right. And I think he applied it to finance, Ben Dolan, and he said, look, a company, it's so important to have a good board of directors governing it from the top with a long-term view rather than, that's more important than the coach or the players. It's the board. It all stems from governance. And yeah, you see it a lot. You see like the best teams are the ones and the best organizations are the ones that have a good culture and it's set from the top and they're not trying to get somewhere too quickly. They're trying to build something. So,
yeah. Okay. All right. Cool. What are your thoughts? I don't know if you'll have what sort of answer you'll give on this, but what are your thoughts on the current state of financial journalism? You know, you've been doing this for, is it about 10 years now?
Yeah. I think it's healthy. I really do believe it. Like from the paper's point of view, I think almost 10 years at the AFI, I've begun to appreciate. I think as valued as brands like the AFI, I think they're almost undervalued as to these long-serving mastheads because we've got a brand, so we've got tens of thousands of readers. So we have reach, which means people have to take us seriously when we ask them questions. We've got lots of experienced journalists. We all gather together in one place every day or online every day and can share information. So I'll know tons of people and then my colleague will know tons of people. And so we can, like a real node of information. We've got access to a whole lot of things. We've got legal support, which allows us to push stories further than other people might. Tons of resources. So I think like that, and we are unbiased effectively. We're not pushing any agenda. We're just out looking for good stories and information. Like we're trying to address that information asymmetry that's out there, you know, where someone knows a lot. And so like that's where we so I think the thing I've come to appreciate is just the power of a very well-resourced brand with credibility and reach. And I think whether I'm there or like it's like me driving a car. If I leave, I think someone else would come in and drive it I'd like to think almost equally well, probably better. So I just think, and that's something why I always don't get too carried away with my own abilities, because I think 90% of what I do is just the fact that I'm in the right seat at the right organization with the right reach. So it's just like have all the tools and do you use them well? And I think there's tons of people at the paper that use them. Like I guess my overall point is it's the AFR that's really kind of it's the brand that's allowed these stories to get written more so than me. I think I'm kind of just in the cockpit and I didn't design the plane. But I think one thing that's changed is there's a lot more voices out there. Social media is a good and bad. I think overall it's a good if you want the truth. The problem is there's just more information out there, almost too much. But if you know who's credible, it's up to us journalists to there's so many voices in the blogosphere, of which some are extremely intelligent and valuable and find things out. And it's I feel like our role in this new age is to find the good ones and screen out the bad ones and use the information they provide us to take it to the next level, whether it's they've given us a tip and we can get it all the way, or we can take what they've discovered and broadcast it to a wider audience. So what worries me a little bit is that there are platforms where they aren't as credible, I think. I'm not saying they aren't as credible as I don't think they governed well. And I just worry that the wrong information is getting to a lot of people. And there's this whole, don't believe the mainstream media, or, that worries me a little bit. I mean, we're not perfect, the mainstream media. We do get things wrong, but we have good process and credibility and brand and access and almost all the time, I believe we're on the money, or we've at least done what we can to make sure that we're writing is true. So my one concern is that I just hope that we can't. I think we're doing well in this age, and we'll continue to do well in this age, and we're benefiting from a diversity of voices. I think, like, I learn so much from podcasts that have no affiliation to any brand. The content is terrific, and that's good. I think more information is better. I don't think anyone should try the monopoly on good info. So it's good. I just do worry that sometimes people with self-interest might be able to use this new digital social media age to kind of attract attract people to their schemes.
Yeah, I know what you're saying. I know exactly what you're saying. Cool. All right, Jonathan, well, let's leave it there. Let's call this a wrap. If someone wants to follow you, I know you're pretty active or reasonably active on Twitter.
Yeah. Johnny Shap, yeah. JOHNNYSHAP. But read the AFI, I reckon, is your first port of call.
If someone wants to specifically find your articles on AFR, is there a way to do that? Like, is there an author page? Or
yeah, you can go on my Twitter. There's like a link just to on the Twitter bio, just the ones I've written. But yeah,
okay.
But there's plenty of other good articles in the AFR. So
great, and I'll put a bunch of links from different things we've referenced throughout this in the show notes. All right, Jonathan. Well, I really appreciate you taking the time to do this and allowing us to come in here, and
absolute
it's been a
pleasure.
great conversation. So thank you.
No worries, my pleasure. Thanks.
You've reached the end of this episode of Chat with Traders, but rest assured there are more episodes loaded with real market insight and zero hype on the way soon. So to stay updated with each great new release, subscribe to the podcast in iTunes, and we'd love it if you'd leave a rating and review. We'll catch you next time on Chat with Traders.